Bank earnings coming in. Among our top stories, Iran's crackdown on protests. President Trump now encouraging Iranians to keep protesting, saying the U.S. is ready to step in and help. So we're going to see what happens next. A U.S.-based rights group says it has verified about 2,600 deaths. Meanwhile, the president is also defending his proposal to cap credit card interest rates at 10% for a year. He told reporters he wanted to protect people from being charged high rates. And Senator Elizabeth Warren says she's ready to work with the president on things like capping credit card rates. The senator is going to join us later on Squawk Box. Of course, Wall Street trying to fight back on that effort. Meantime, Netflix reportedly considering an all-cash bid for the streaming and studio assets of Warner Brothers Discovery. A cash offer could be a faster way to close that deal. Warner Brothers Discovery is facing a competing bid from Paramount Skydance. Meantime, in Washington today, officials from Denmark and Greenland, they're set to visit the White House and meet with Vice President J.D. Vance, also Secretary of State Marco Rubio. President Trump just posting on Truth Social the following: the United States needs Greenland for the purpose of national security. It's vital for the Golden Dome that we are building. NATO should be leading the way for us to get it. If we don't, Russia or China will. And that is not going to happen! Exclamation point. Military without the vast power of the United States, much of which I built during my first term, and I'm now bringing to a new and even higher level. NATO would not be an effective force or deterrent, not even close. They know that, and so do I. NATO becomes far more formidable and effective with Greenland in the hands of the United States. Anything less than that is unacceptable. Thank you for your attention to this matter! Exclamation point. President DJT.
I don't see that. Oh, is that at the end of the, he usually does do that, right? He puts DJT.
Yep.
There we go. I wonder what happens today, because the last thing I saw was that the Greenland officials said we've talked about it with our people and they don't want to do it, even if it is $100,000 per person. I don't know whether that's
I don't know if you think this is like one of those meetings, you know, remember when President Zelensky showed up at the Oval Office and that turned into a wild affair. You remember that?
Yeah.
With Trump and J.D. Vance and everybody picking him apart.
There's definitely pressure. I don't know whether, and he never shows his hands. That's the thing, and you just never know. But because he does sometimes do things that people say he would never do, but that allows him to, on the front end of bargaining, to have people take what he's saying seriously. We'll see. Checking the futures this morning for a lot of reasons. Maybe they're in the red. Some of the same reasons that caused the market to trade down yesterday. You can see the Dow. At one point yesterday, Dow was down over 500 points. Closed down 300 and change. Today, you can see giving back 160 or so. But these numbers are from. A lot of them are just off all-time highs for the averages, which you know. Treasuries saw 420 yesterday. CPI came out and moderated a little, 415 this morning. Let's get to Dom Chu with a look at this morning's pre-market movers. I think Dom is a happy, self-actualized person in most respects with really good tempo with his golf swing. Maybe that's why you're happy.
It's not just the golf swing. You got to change that. You got to put that tempo focus in all parts of your life. Exactly. And then you kind of find your way through. Yeah, you get a lot more of that self-actualization, as you point out, too. Anyway, Joe, Becky, Andrew, good morning to all of you guys. Let's start with some of the non-earnings related catalysts that are moving things in the market. We're going to start on cybersecurity. Names like Palo Alto Networks and Fortinet, you can see, are both falling. Palo Alto down 3%, Fortinet down about 4.5%. That's on a Reuters report, citing sources familiar that Chinese authorities have told domestic companies to stop using cybersecurity software made by roughly a dozen firms from the U.S. and Israel due to, what else? National security concerns. Now, Fortinet and Palo Alto Networks were also among the companies mentioned, along with Broadcom-owned VMware, so keep an eye on the entire cybersecurity space on that. Meanwhile, on the defense side, shares of Huntington Ingalls is rising just about 3% right now after the defense company announced it was awarded a contract with a ceiling value of roughly $151 billion from the Department of Defense's Missile Defense Agency. The contract is part of the agency's SHIELD program, which focuses on developing missile defense capabilities. That stock is leading the S&P 500 gainers, all of them in the pre-market trade, up about 3%. And then you got shares of Rivian dropping just about maybe 3.5%, due in part to a UBS downgrade to sell from neutral. Analysts there say that while the market has assigned a lot of enthusiasm to their AI potential, most of that AI-related news is already out already. They also say that enthusiasm for the R2 electric vehicle may be too high, and they cite risks to R2 deliveries in 2026, including the absence of things like EV tax credits, cost pressures from lithium pricing, and everything else. So keep an eye on Rivian, down 3.5%. For more on those and other top analyst calls of the day, just head over to cnbc.com/pro, where subscribers get all the context and detail. As always, Joe, around those notable upgrades and downgrades. I'll tempo it back over to you.
And I didn't mention the 49ers to you. I did have the 49ers. I think that guy is just McCaffrey. What
McCaffrey, Brock
How does that-
Purdy, the quarterback, they're
I know,
amazing.
but you watch McCaffrey. I mean, he's like, I think I might be the same size as him. But obviously, it's very different in terms of the muscle fat components and everything else. I understand that, but I'm just surprised at his abilities. You know, I think it might be talent. Is that what it is?
I think God-given talent's probably one of those things, Joe, in my mind. But not just that, he stayed healthy this year, right? So that's a good thing too. That
Well,
just
you see the
speaks to
stuff he
just
does.
And had hard work. Nobody gets that.
Yeah, but you see the stuff he does. You saw that. And did you see how many times he had to run until he finally started softening him up, and then then you can't stop. And that catch.
Let's hope though. And by the way, Jawan Jennings, former high school quarterback that's now a wide receiver, made that throw. Great throw, right?
That's
Channeling his
right.
high school quarterback days. But now they have to take all of that and the short week to Seattle, and they are going to be, I think I saw somewhere this morning that they're touchdown underdogs, which also means that it'll be the biggest playoff underdog spread in like 40 years.
You gotta be kidding me.
Yeah. So
Is that true?
yeah, I mean, just check the line. I'm pretty sure it was 7 points the last I checked, or thereabouts. So
A full touchdown.
in Lumen Field,
7.5.
in Seattle, it's a tough place. to play.
7.5.
Yeah.
7.5. Big under over. No, it's not. All right, thanks, Tom.
I got faith. Don't worry, Joe.
You do? You got you and George Michael.
There we go.
That was quick. All right, weekly mortgage numbers just out. We want to get over to Diana Olick for those numbers. Diana, good morning.
Good morning, Becky. Yeah, and mortgage demand spiked sharply higher last week after President Trump's post on social media that in an effort to lower rates, he would order Fannie Mae and Freddie Mac to buy $200 billion in mortgage-backed bonds. Now, just on that news, the average rate on the 30-year fix sunk briefly below 6% on Friday morning before bouncing slightly higher again. But the average rate on the 30-year fix for all of last week, that's the average on the Mortgage Bankers Association survey for conforming loans, dropped to 6.18% from 6.25%. Again, that's the weekly average, but Friday it was much lower, and as a result, refinance demand surged 40% higher for the week and was 128% higher than the same week 1 year ago. The average loan size for refi applications also higher because borrowers with larger loan sizes are typically more sensitive to those changes in rates. Now, applications for a mortgage to buy a home, which are less sensitive to sudden rate changes, they increased 16% for the week and were 13% higher than the same week 1 year ago. The increase there probably driven more by just people returning from the holidays, easing home prices, and more inventory available for sale. Now, mortgage rates, they moved a little bit higher to start this week. That's according to a separate survey from Mortgage News Daily. Becky?
Diana, that's really amazing. That surge that came in, would you say 40% higher on the refinancings just because it dipped below slightly on Friday? I mean, that tells you a little bit about the pent-up demand there is for people who are hoping to get access to lower rates.
Absolutely, because if you remember a year ago right now, rates were over 7%, and if you can get 75 basis points on a refi, you're good to go. That's going to be some solid savings. So you know that phones were ringing off the hook on Friday when we briefly touched 5.99% just for that day. It is really amazing to see that people really want to get any savings they can get on that monthly payment, even if it's just a couple of $100. We'll wait to see how it goes next week when we see that mortgage rates have moved back over 6%, but they are still far lower than they were last year.
Okay. Diana, thank you. We'll see you later. In the meantime, we're getting more bank earnings this morning. We've already heard from Wells Fargo and Bank of America so far. Citi still to come a little later this morning. Joining us right now to talk about it all is Stephanie Link. She is Hightower Chief Investment Strategist, also a CNBC contributor. And she owns stuff. I think it's definitely Bank of America and Wells Fargo. Those are the financials that you really are focused on. So let's talk.
And Morgan Stanley tomorrow.
And Morgan Stanley tomorrow. So let's talk a little bit about what we've heard this morning. You want to start with Wells Fargo?
Sure. So with Wells Fargo, the net interest income certainly is a little bit disappointing because they missed. But in just digging through the overall details, it was a really solid report, Becky. And I think you want to use any weakness to be buying because the story really gets interesting in 2026 and beyond as the asset cap has been lifted. The company then is going to aggressively invest to grow, and they're going to increase market share. That's the story about Wells Fargo. Now, in terms of the earnings report, solid as I mentioned. Profits grew 6%, net charge-offs fell. Corporate investment banking grew 14%, year over year up 6% sequentially. Wealth management grew 6%, and ROTCE, that's the profitability metric, rose 15%. And their target of 17 to 18% over the medium term not changed. They bought back $5 billion worth of stock in the quarter. They had a $31 billion program, that's 10% of the market cap. They're going to continue to buy back. So I think this is a solid quarter. The reason it's down is the NII miss, I get it, but the stock's also up 31% in the past year. So
That's
any
what I was gonna
weakness,
say.
I use it as a buying opportunity.
What you're talking about this being the year where the shackles really come off and they can take off, that's been kind of well telegraphed to the street, being up almost 30% even after these declines this morning.
Yes.
Is this your favorite name, or do you think a lot of this has kind of been expected by the street at this point?
This is my favorite name because I think that there's so much more growth ahead of them. You know, they really have had their hands tied behind their back since 2018. That's when the asset cap went in place. So now all of a sudden they can grow. And the numbers I just cited in terms of the quarterly report and the full year numbers, really solid in the face of all that, right? So now, just imagine what they can do. And I'm most excited about the profitability improving between now and over the next several years. I think actually the ROTCE at 17-18 probably gets bumped higher as they continue to invest and grow more.
All right, let's talk about Bank of America. I don't know where the stock's trading right now, but it beat on the bottom line. It beat on the top line. The charge-offs were down sequentially. Investment banking better than where they had guided to just a month ago. What do you think of, and that stock actually right now up by about 46 cents.
It should be up much more, and this is by far the best of the big three so far. We'll see what the others do later this week. They beat on net income. The total revenues grew 7%, and then I'm going to say there's the tens, the magical tens, right? It's net interest income grew 10%, global wealth management grew 10%, sales and trading grew 10%. These are really good numbers. They all beat, and their average loans grew 8%, and they're saying across every business, average loans grew. So they really did, to me, it was a surprise to the positive side. They really did outperform relative to expectations, and this stock trades at 1.4 times book. That compares to Wells Fargo at 1.8 times, so Wells is a little more expensive, but Bank of America should see a catch-up if they continue to outperform, and the results today very, very encouraging.
Okay. Stephanie, thank you. It's good to see you.
Thank you. Good to see you.
Coming up, Iran's crackdown on protesters with President Trump saying help is on the way. We're getting into what this all means, or could mean, for stability in the region, potential oil market disruptions with former Biden senior advisor Amos Hochstein, and later this hour, House Financial Services Chairman French Hill on President Trump's latest attack on Chairman Jay Powell. Clock returns in just a moment.
Welcome back to Squawk Box. President Trump taking to social media to once again warn Iran. Ready to step in. He's writing the following: Iranian patriots, keep protesting, take over your institutions, save the names of the killers and abusers. They will pay a big price. I've canceled all meetings with Iranian officials until the senseless killing of protesters stops. Help is on the way. And then he says, MIGA, meaning make Iran great again. Joining us right now, former Biden senior advisor, Amos Hochstein. He's a managing partner at TWG Global. Good morning to you.
Morning.
What do you make of that? Or what do you make of what is happening on the ground?
Well, first, it's extraordinary. This is not the first time there are mass protests, but I think the biggest difference is not the size and the duration, but the fact that the Green Revolution and then the hijab women and freedom ones a couple of years ago were about ideology and things the regime could do something about.
Right.
So you can, on the hijab, you can say, I'm going to relax a little bit on the religious beliefs on the streets. That worked. But here it started by the economics. It started when they devalued the currency. People are hungry, and when you have a regime with no money, what do you do about protests about an economy that have no money? I think that from the perspective of the U.S., we've seen a lot of elements of regime collapse here, but what we have by the protests, but there's no actual opposition, and there's no signs yet that any parts of the regime are collapsing. If you remember at Tahrir Square during Egypt, they gave the order to shoot, and the soldiers and officers refused to shoot.
Right. So you don't see
here they are.
So do you see an opening, or you don't see an opening here?
I think it's too early. I think it's too early to see this yet. I mean, remember with Assad, it took months of protests. We're on week 2, and we're not seeing any part of the regime saying that they're no longer supportive, any cracks of any kind there. And remember, without boots on the ground, even if you do airstrikes, unless you take out the supreme leader,
right.
Even then, what comes in its place is unknown. We don't have boots on the ground. We're not nearby. It's not a Caribbean state nearby. The IRGC is well equipped, the Basij, the military, the police, the intelligence. They have little different agencies there. So I think a day after plan has to be much more carefully articulated.
How is that different than the Venezuela scenario in your mind?
Because in Venezuela, you went in with an operation to kidnap one person. There's no regime change. The regime is still intact. It's just a personnel change at the top. It's one person who's gone, and the regime stayed. It's hard to imagine
but
this regime.
But there's a view, and I don't know if you think it's working or not, there was no regime change, but that somehow we now have enormous influence over this country. We don't.
Absolutely. I mean, we basically have a puppet regime that is now going to do what we want on the issues that matter to us and on all other
in Venezuela.
Yeah. In Iran, it's hard to imagine taking out the supreme leader and it having the same effect. It's not a monolithic. It's a much more complicated and strong regime, as you can see from the evidence on the ground. They're acting with different kind of resolve. So I think that just taking one person out is not going to give you the answer. I think I support the president encouraging the protesters to go out and say we're going to support them. I think if you're going to say help is on the way, help has to come in some way. I just don't know what that way is. And I know throughout the region, people are not entirely sure that airstrikes do it, because what do you attack?
You can't do nothing, but it's really difficult to figure out what you should do. And as you point out, there's no one waiting in the wings. The Shah's son is not. That probably is.
Yeah, I think outside of Tehran in certain circles, I think it's hard.
But I was thinking about, and it's not analogous to Iraq in any way, but there were a lot of dead enders that we thought were going to be throwing flowers to our troops. That's not the case this time, is it? Don't the people really, are they not, if it wasn't for the military and the iron grip that the mullahs have, would there be dead enders in Iran that pine for the thugocracy, or whatever you want to call what they have right now? Wouldn't people embrace an end to this regime?
I think, as you see in the streets, there's the majority of Iranians.
Is anyone not in this? Does anyone not agree with that there, other than the?
I'm sure. Yes. I mean, in the last election, while positioning won, the hardliner still got a lot of votes. There is a core. we shouldn't fool ourselves.
That's what I
Everybody wants it out.
Right.
They have their own core of support, but I think the majority.
If your
but
finger was
not
on the button,
everybody-
what would you do? Right.
But if not
On the hit button.
everybody who's against the regime is pro-America. Not everybody
If
against.
the president called you, what would you tell him to do?
I don't know what the options that the military, that CENTCOM has given the president on it, but I would continue to encourage the protesters. I would try to get internet connectivity back on as they're doing. I think there are a lot, and that's what they're trying to do.
Let me ask you, just pivot for a second. Later today, a whole bunch of folks from Greenland are going to be inside the White House talking to J.D. Vance and Marco Rubio. And I'm so curious what you think of that as it relates to sort of the broader geopolitical issue, as it relates to NATO, this argument that the president's making online, effectively around NATO, and this idea of an Iron Dome, the idea that somehow China
We're gonna have a gold dome.
and Russia are
an
going
Iron
to
Dome
be
it is.
otherwise taking Greenland if we don't.
So there's
Israel's the Iron
so there's been no indication that Russia and China are planning some operation to take over Greenland, and if there was some intelligence around that, I think the situation would be different. Look, Greenland is part of Denmark. It has been their independence movement in Greenland. They should figure out what they want to do for their own fate. I don't think that we should be going and invading Europe or invading our allies. And I think it's very hard. To what we really need in Greenland. I mean, yes, anything we actually need in Greenland, they'll probably give us. If we ask for mining rights, if that's what they want for critical minerals in Greenland, we've had teams there for years. I ran the Energy Bureau 15 years ago, and I sent teams out there. We can do whatever we want. If we wanted to have a base of operations there for intelligence purposes, I'm sure they'll let us. These are allies. They're NATO allies. They'll let us do whatever we want. Why do we need to own it? I don't understand. I think it's a friction point that is completely unnecessary.
Everybody says that, wow, $50 oil would be great unless you live in Midland, Texas. There's an article.
Look, I think that right now oil prices are going up despite Venezuela because one, the market knows that Venezuela is not going to yield any more oil anytime soon.
Sure.
Two, the Iranian
Right.
protests are really putting that pressure there. But right now, $50 or $60 is not a price that you can go and invest in.
So even
Venezuela.
60, you can.
But even 60, it is very expensive to go into Venezuela right now. And also, who are you doing deals with? A government that you have no idea if they're going to be there. And what if they say a few years from now, all these contracts are null and void because they were done under duress by an occupying power?
Which they've done
Which,
repeatedly to the
in the
nations.
past,
Right.
yeah.
ExxonMobil says they own $20 billion.
Conoco is trying to
Do you
get
think
money
President
back.
Trump knows that there's a downside to $50 oil? Do you think he cares?
I don't know if he knows. He doesn't seem to care because he really wants the $50. I think he wants lower gas prices. I think that in America, the gas prices at $2 or $2.50 doesn't really make a difference politically. I can tell you that. And therefore, going to 50 at 50, once you go below 50, and if you engineer prices going down, sometimes you don't get to stop them where you want to stop them.
Yeah.
And if you go below 50, there's large parts of the shale patch that start becoming that have to shut in. And by the way, that has an
Brings
impact
job losses.
on
Yeah.
natural gas
Yeah.
because that gets shut in with the oil. Then you have issues with AI and data centers who are relying on the gas in the Bakken to come to those new power plants. So it's a very sensitive ecosystem. You want oil prices to be low, but there's a limit to how low you want them.
Amos, I want to thank you. It's great to see you, sir.
Good to see you.
Appreciate you for coming in. No tie.
Private sector.
Private sector is not standing on
I'll
the
dress
White House
up next
anymore.
time. I'll dress up
No,
next
no,
time.
it's all good.
All right, when we come back, the philanthropic challenge Warren Buffett is leaving to his 3 children. Robert Frank will break it down for us next. Squawk Box, we'll be right back.
Time now for today's AFLAC trivia question. What is the lowest natural temperature ever recorded on Earth? The answer when Squawk Box returns. now the answer to today's AFLAC trivia question. What is the lowest natural temperature ever recorded on Earth? The answer? Negative 128.6 degrees at the then Soviet Vostok station in Antarctica in 1983.
Warren Buffett's 3 children are facing one of the toughest and most important jobs in philanthropy. Robert Frank joins us right now with this week's Inside Wealth Report. Good morning, Robert.
Becky, great to see you. Well, you could call it the ultimate philanthropic challenge. Warren Buffett is giving away his fortune after his death to a charitable foundation that will be run by his 3 children. That's Susie, Howie, and Peter. Now, today, Warren Buffett is worth over $150 billion. They will have 10 years to give it all away. And just to add another twist, every gift has to be unanimous for the 3 of them, so any one of them can veto the others. Now, for most families, this would be a complete disaster, but for the Buffetts who grew up under Warren's values and financial lessons, the new trust will be a chance to make big bets that other foundations today largely avoid.
Silicon Valley is filled with venture capital. I mean, that's why
Well, that's venture capital.
this country is built on venture capital, for better or worse.
Yeah.
And the fact that a sector that doesn't actually have to have a return isn't doing the most adventurous things is crazy, because we're not beholden to shareholders. We're not beholden to some kind of return, and yet they're often the safest. And so many foundations, live on some kind of legacy, and everybody there feels great about doing good, but they don't work there to try and lose their job tomorrow,
Right.
which is what they should be doing.
That's
We
so
have a
true.
sunset clause in our foundation, and I think it's 2045, but I'd be 90 anyway, but if I make it that long.
You better make it.
But I mean, we just, we can't say what we believe in if we aren't doing it.
So if they have 10 years to give away that $150 billion, they will have to give away more than $15 billion a year. So right now, that would be 4% of all the charitable giving in America. And of course, it adds to the more than $50 billion that Buffett has already given away. Now, had he not given away those shares, which of course would have appreciated, Warren Buffett would today be worth over $300 billion, and he would be the world's 2nd richest man. Now, to watch the full interview with Susie, Howie, and Peter, you can go to cnbc.com/videos. And for a deeper dive on what other wealthy families and philanthropists can learn from the 3 Buffetts and how they're going to give away their wealth, you can sign up for the Inside Wealth newsletter out tomorrow morning at cnbc.com/insidewealth.
Hey, Robert, the idea of giving it all away in 10 years, I think that's something that they want to do, but they have this dual mandate, much like the Fed, which is give away all this money in 10 years, but also make sure that they maintain some control at Berkshire to a certain extent to protect and build a fortress around Greg Abel, the company, make sure that nothing comes in until that company is under very steady grounds with any of those things. And what I've heard and what they talked a little bit about in this interview is that there is some flexibility on that. If they feel like they need to slow down the giving, they can do that if it is to protect Berkshire. So they've always got this dual mandate in mind.
Yeah, and what's great about both the philanthropy and the Berkshire piece is that Buffett has set them up, and they know this, for whatever happens. He knows throughout his life, and it was so well portrayed in the documentary last night, that the world changes dramatically. When he first started thinking about philanthropy, he started thinking about nuclear weapons. Now you've got 8 or 9 countries that have them. It's hard for philanthropy to change that. So with both, and they call it that balance between dealing with the voting control and selling down to fund the philanthropy, and there may be conditions at the company they can't think of now that change. But what I thought was really interesting, and that you pointed out last night in the documentary, is how similar their approach to philanthropy is to how he runs Berkshire.
Yeah.
It's all about the effective and efficient allocation of capital. And that's how they see philanthropy. And whether it's through osmosis or consciousness, they've done for the past 20 years that they've been philanthropists, that's how they've done it. They run very lean organizations.
That's what I was going to say. The focus on anti-bureaucracy, not wanting to get bloated and having a big foundation that is just there to run it. I think that's key for them too. And they can look to the headquarters of Berkshire Hathaway, which is run by about 24 people.
And to make these big, quick decisions, that's what, as Peter was just saying, that's what philanthropy should be, to really make a big, quick decisions, because the private sector won't.
Yeah. Robert, thank you.
Thank
very
you.
much. Appreciate it.
Coming up, Kalshi and Robinhood among several companies forming the Coalition for Prediction Markets to make sure the federal law sets the guardrails for the industry rather than state regulations. Former Congressman Sean Maloney is going to be leading that charge. He will join us in just a couple minutes right here on Squawk Box when we return. Do you think the Supreme Court?
Coming up, President Trump continuing to blast Fed Chair Jay Powell. House Financial Services Chairman French Hill says the investigation is, among other things, an unnecessary distraction. He'll join us next. We'll also get the latest on crypto regulations. Squawk Box will be right back. President Trump taking yet another swipe at Fed Chair Jay Powell, calling him incompetent and crooked. Joining us now, Congressman French Hill is the chairman of the Financial Services Committee. And Congressman, it's good to see you.
Joe, Happy New Year. Good to be with you.
Yeah, you too. I was doing the math. So you worked with Jay Powell going all the way back to the first Bush, which was, I was trying to figure that out. It's at least 35
A few
years.
semesters ago.
Yeah.
Exactly.
Many moons ago. I think your comment was he's a person of the highest integrity, and the subpoenas could undermine this and future administration's ability to make sound monetary policy decisions. Across the board, I think on both sides of the aisle, heard a lot of things. I guess even Treasury Secretary Scott Bessent reportedly talked to the president and said there's a lot on the plate of the Treasury Department. We don't need this. You think there's anything to this at all? I read one Republican lawmaker who said that I'm sure I doubt he hasn't done well and he's been evasive and he didn't think he was a great Fed chair, but he said he probably hasn't done anything criminal. That's about the worst thing I could find anyone to say.
Well, look, Fed independence doesn't mean the Fed or the Fed governors or the chairman are immune from criticism. That's absolutely the fact, and I've disagreed with Jay over many years about the direction of bank supervision, or certainly the direction of monetary policy as we came out of the pandemic at the end of 2020 and early 2021. I think they were too slow to take their foot off the gas, combined with Joe Biden's excessive spending, and I think that contributed to the 40-year high in inflation. But with that said, the Congress does oversight of the Fed on a regular basis, and the idea that we want to get to the details of the construction project at the Fed and understand that completely, that's a perfectly good oversight set of questions. But in terms of being evasive, following that Senate testimony last year, the Fed released a whole series of frequently asked questions and a chronology of all the steps they had taken regarding those Fed building projects, which are expensive. And building anything is expensive after Biden's inflation, and building anything in Washington, D.C. with all the government regulations and environmental reviews and historic preservation issues, of course, is colossally expensive. And no one in Congress has a lot of patience for high construction costs. But that doesn't, in my judgment, rise to the level of accusing someone of a crime.
So we don't know how this how this plays out. I guess at this we don't know what Department of Justice might.
But we should be focused on
to do nothing.
I think Scott Bessent's right. It's a distraction. Scott Bessent's right. We should be working in the executive and legislative branch on the goals that President Trump has and that we have, which is how do we recover from that Biden inflation, lower the cost of living for American citizens through, like my bill, 21st century housing that literally cuts the cost of constructing housing, makes housing more accessible, more available across the country. That's what we ought to be focused on.
Yeah, I was going to ask you, a distraction from what? What else? Things with crypto too, I guess, in your view.
Yeah, we've got, it's a good week in crypto in the sense that Senator Tim Scott is having a markup this coming Thursday, tomorrow, on the crypto legislation that we sent to the Senate last July. This is the market structure. This is the rules of the road for dealers, individuals, on how they will use digital assets and what the fit-for-purpose regulatory structure would be. So I'm really looking forward to that debate in the Senate tomorrow, and I hope this means that we're moving closer towards having a law that President Trump can sign, which is one of his commitments, to have both a stablecoin bill signed into law and a market structure bill. And then we can turn to community banking. How do we make community banks successful, more successful in this country? Because, Joe, when it comes to housing, banks under $10 billion, they make 60% of those 1 to 4 family housing construction loans. And so to me, housing and banking are linked as we try to come out from underneath the Biden regulatory system, the Biden inflation, and get this economy moving again in 2026.
The president, I don't know, he says he didn't know about this, but he's aware of what he wants to get done too. Do you expect that this gets put to rest pretty quickly, and that's what a lot of people would like, Republicans as well.
Yeah.
That it's just put to bed, and there's nothing here.
Well, we need to put it to bed quickly, and I'll tell you why. Because it's disrupting our work of oversight of the Fed. I anticipate Chairman Powell will not testify before the House and Senate in February because of this grand jury impanelment accusing him of perjury. And I think that's going to cause him to not come before Congress for his biannual statutory obligated hearing, the Humphrey Hawkins hearing, where he comes to the House and comes to the Senate and talks about the economy, bank supervision, the important changes that we need to make in both those areas.
Congressman, let me ask you a very specific question. I don't know if you saw yesterday that former President Clinton and Hillary Clinton wrote a letter to Representative Comer about their investigation about Epstein and his efforts to try to get them to testify. And you'll see the connection in a moment. In the letter, they say, quote, "The Justice Department has been used as a weapon at the direction of the president to pursue political opponents." Do you believe that to be true?
I think the Epstein case is, and the Clintons' involvement in it is just another, what I think is a big issue in Congress and around the country. People want these files released, and the Clintons are involved in it because the American people demanded Congress open every single file and have the least amount of redactions so that they can find out who was going back and forth with Jeffrey Epstein, a convicted pedophile. And you know, this is transparency that the American people wanted. I don't think that's geared towards the Justice Department engagement there and being used as a weapon at all.
Maybe not in that case, but I think Andrew's point is that do two wrongs make a right? Should the president be looking for retribution based on the weaponization of the Justice Department under the Biden administration? Or should he say, yeah, it happened then, but I'm not going to fall privy to the same thing now? Because it almost looks like it's a tit for tat that he's attempting.
Yeah. Well, fair point. And I've always said, look, the best way to have retribution against your opponents is deliver on the promises we make to the American people, that we want to make the cost of living go down, that we want a more competitive system, we want more jobs, more careers, more housing available. And President Trump, when he was campaigning in 2024 and as he got elected, said that is what he was going to do. He said that my biggest retribution is going to be winning on the policy proposals I've made in the 2024 campaign. I think that's the direction we should take.
All right, Mr. Chairman, I appreciate your time this morning. Thanks.
You bet. Good to be with you.
Just worth mentioning on the Comer investigation, the 8 people, he subpoenaed 8 people, 7 of which he accepted effectively affidavits and statements from.
But he wanted them there.
Yeah.
So was willing to accept nothing from anybody else except the Clintons.
And said that he's not going to go out, not going to seek a sitting president.
Did any of those other people, was there a picture of them in a blue dress in Epstein's apartment in New York? That's an actual part painting?
Recall. But look, if you just want to embarrass people for fun, which is...
I think Bill's got a lot to answer for.
Which is fine. I think the question
Bill's
is...
got a lot more to answer for than Trump.
If you recall, there was an argument made by the former president, meaning President Trump, when he was not in office,
right,
that he could not actually be called for such a hearing, and so that argument was made then, and now this former president. This is why it's like, you know, what's up is down. We're coming back after this.
Welcome back. The popularity of prediction markets is booming, and the industry wants to make sure it's under federal regulation rather than play by state rules. Former Representative Sean Maloney is leading that charge as the new leader of the Coalition for Prediction Markets. He'll join us next. Squawk Box will be right back. Prediction market companies like Kalshi, Robinhood, and Crypto.com have formed a new coalition. Its focus is to ensure that federal law, not a patchwork of state regulations, will govern that industry. Leading the group is someone who's familiar with Capitol Hill, former Congressman Sean Maloney. He is now the CEO of the Coalition for Prediction Markets. We want to point out that CNBC does have a data sponsorship with Kalshi, but Sean, thank you for being with us today. Let's talk about your joining at this moment in time. It's a pretty big move for an industry that I think feels like it is under attack.
Well, thanks for having me on, and thanks for pointing out that CNBC uses Kalshi data. I mean, you know, one of the things that's amazing about prediction markets is that Donald Trump could tell you that prediction markets predicted his election when the polls didn't, and Zoran Mamdani in New York City is a big fan and brags about his Kalshi odds. So what we know is that these markets have excited Americans. Millions of Americans find them useful, and there's a really interesting policy conversation going on, and I want to be part of it.
Lobbying groups typically are pretty low-key. They just say they're there for the promotion of the industry. If you go to the website for you all, though, on the very front page, it says the framework, the federal framework that you all operate under is under attack by state casino regulators seeking to block consumer access and extend their own authority. That is your #1 mission right now, and it sounds like this is a critical time, you think.
Well, look, this is a derivatives market, and it's federally regulated by the CFTC. We think that's the best system, And we know that because we've got a century of experience on this. I've served on that committee in Congress. I ran a derivatives software risk management company at an earlier part of my career. We want strong federal regulation by the CFTC, so there are clear rules and clear protections, and we have the types of things like bans on insider trading and know your customer rules and money laundering protections, just like we do in other markets. And we don't have a race to the bottom in these state-by-state, more easily influenced venues. And we know there are people out there who don't like that, but they have an economic reason to feel that way. And we just want to be part of the conversation because we think that millions of Americans every day, and I'm sure a lot of folks watch the show, love prediction markets, find them useful tools in their lives, and we think it should be federally regulated, and that's the point of the coalition.
All right, Sean, let's talk a little bit about Polymarket and this person who opened an account there made $400,000 on the Duro being taken out. I realize Polymarket is not part of your coalition. I realize they are not monitored by the CFTC, but what do you say as an industry organization looking at all of this to try and reassure people that there aren't insiders who are trading on these things, that you are watching this closely? How do you address that issue?
What I say is that's a very serious concern, and it is exactly why you want U.S.-based, federally regulated, responsible actors in this space who already ban that type of activity, who have the type of know your customer rules that would tell you who made that trade so y'all could know. And if there were insider connections or improper activity going on, it would be illegal under federal law. That's a good system, and that's what we're fighting for. You're right, that trade happened on a platform and an entity that's not part of this coalition, and it's for a reason. It's because we represent the folks who are here in the U.S., playing by the rules, and we think that's the best way to go.
So there have been people who have wondered in the media, is Polymarket going to join your coalition? It sounds like they're not welcome.
Well, look, I mean, I think that what you're seeing in the space right now is you're seeing a lot of companies decide that the model of federal regulation as a U.S.-based platform makes the most sense. So I think you'll see a convergence around that. And it's important that we encourage it because we don't want to push folks who are using prediction markets to offshore platforms where there are not the protections we have under U.S. law. We want good, clean markets, just like we have in other contexts. It's an evolving asset class, and we want it done the right way. And so what you'll see, if we get the policy right, is you'll see it converge around the healthiest form of activity that's here in the U.S., well regulated at the federal level.
The American Gaming Association, which is a casino and sports betting coalition and lobbying organization, has launched this kind of attack on what's happening with some of the very prediction markets you're talking about. It's caused a falling out with Fanatics, FanDuel, and others. I think DraftKings, all three of them, have quit recently over that issue. What do you think of what the American Gaming Association is doing?
Well, look, I mean, they have a business to protect, and they're trying to stick up for their model. But look, this is much bigger than that. You have 45% of Americans, I think, under 50 who are now using prediction markets, or it's millions of folks. And the fact is that it's much bigger than the traditional old gambling model. It's not gambling at all. These are event contracts traded on federally regulated derivatives exchanges. There are attacks coming from people who see this as a threat to their business. That's not a surprise. But the fact is that millions of Americans love prediction markets. They find them useful in their lives for all kinds of reasons. They can trade on their expertise in ways that they find really meaningful. And the fact is that these are derivative contracts that are federally regulated by the CFTC. And there'll be room for casinos in the future. There'll be room for sports books. But the fact is that this is a different type of asset class that deserves good federal regulation. And there'll be some economic disruption, but that's the American economy. There's nothing new.
Just very quickly, are there any lines that you don't think should be crossed in terms of what you can make a prediction on? Should you be able to do that if it comes to war, to terrorism, to coups, specific acts of violence?
Well, absolutely. And the CFTC has very strong standards on that. And the fact is that every contract that's listed on a prediction market in a U.S.-based platform has to be approved by the CFTC or done under their regulation. And and there's a very fair conversation about what types of contracts should be listed, and that is the role of a strong federal regulator. It's one it's used to playing, and one that will continue and that we support.
Okay. Thank you very much for being with us, Ambassador Maloney. We appreciate it.
My pleasure.
Meantime, Citi just out with its quarterly results. Want to get straight over to Leslie Picker, who joins us with the latest. Leslie.
Hey, Andrew. Yeah, Citi shares somewhat volatile in the pre-market as investors digest these results. Currently hovering around the flat line, but it's kind of vacillated between lower and higher. Citi's fourth quarter results impacted, though, by the sale of its remaining operations in Russia. So that resulted in an impact to EPS of about 62 cents per share, which would have otherwise been $1.81 per share, and an impact to revenue of $1.2 billion, which would have otherwise been $21 billion. Citi saw net interest income, that's that profitability metric for loan making, rise 8% to $12.8 billion in the quarter, and the firm expects NII ex markets to grow between 5 and 6% this year due to loan and deposit growth. So that's the 2026 guidance there. Each of Citi's 5 businesses generated record revenue in the full year 2025. For the quarter, investment banking fees at Citi surged 35%, and that's largely due to the business that advises on M&A transactions. Markets, though, they came in lower, with fixed income and equities each down 1% for the quarter. Services up 15%, wealth up 7%. U.S. personal banking, that was up 3%, driven by higher loan spreads and high interest earning balances in their branded cards unit. Return on tangible common equity was 5.1% in Q4, but excluding that Russia sale, it would have been 7.7%. So in her quote in the release, Chair and CEO Jane Fraser said, the firm is committed to reaching its target of 10 to 11% ROTCE for the year, and quote, positioning Citi for improved returns above that level in the year ahead. So kind of reiterating that medium-term target that the firm set a couple years back of 10 to 11%, guys.
Okay, Leslie, appreciate it very, very much.
Mm-hmm. Futures still down on this morning. We'll see what happens by the end of the session. Let's get more on the markets now with our Mike Santoli at the New York Stock Exchange. Hey, Mike.
Hey, Joe. Yeah, a little bit of pressure. Yesterday, modest losses in the S&P 500, though there was a bit of a late day comeback to minimize the downside. The S&P 500 index fund here, the SPY, you see it's sort of curling a little bit lower. We got up near the 7,000 level on the index. That would be 700 here. And we haven't really broken free of the upper end of this range that's been in place since just before Halloween. We got above 6,900 right around the October 28th or 29th. However, the average stock's done better. Cyclical stocks have done better below the surface. It's really been the mega cap tech stocks that have not really been able to push the index higher as a group. Take a look here at the NASDAQ 100 ETF, the QQQ, relative to what I would call the junior varsity of the NASDAQ. The QQQJ is the stocks that are just below the top 100 in size. It's the 101st largest NASDAQ stock down to the 200. And you see that JV ETF actually kind of eclipsing the QQQ on a one-year basis. So it does show you this is the kind of broadening action that everyone's looking for. It's just not really manifesting in the headline market cap weighted S&P 500, at least not yet. That AI trade has been very mixed and choppy. In fact, it's kind of moved to Asia in a lot of respects. That's where the excitement has been. Finally, commodities, been a big story. Metals just ripping once again. Obviously, oil has now started to contribute to the upside too. This is a fund that just tracks the Goldman Sachs Commodity Index. And you see it's making a one-year high. It's actually at levels that go back to just after the invasion of Ukraine. Now, this also gets the income from the treasuries that you would own if you own futures and the futures roll. So it's not just the outright cost of the raw goods, but it does show you that there is a reflation trade going on, even as the measured inflation gauges don't really show a lot of upside to consumer inflation at the moment, guys.
Okay, very good. Thank you, Mike Santoli.
Okay, when we come back, some breaking news from Airbnb, the company hiring a chief technology officer with a long history at some major tech companies. We've got a first on CNBC interview. Just a moment with the company's CEO, Brian Chesky. That is right after the break. You don't want to miss it. Come right back. Welcome back to Squawk Box. New this morning, Airbnb announcing it has now hired a new chief technology officer. Ahmed Aldaleh is joining the company from Meta, where he launched Llama for Meta. And I spoke with CEO Brian Chesky first on CNBC about how this hire came about and what it means for the ambitions that they have for artificial intelligence.
I mean, a couple of years ago, I wanted to meet some of the best AI people in the world, and a few names kept coming up over and over again. One of them was Ahmed Aldal. He was obviously leading generative AI at Meta, created the Llama family of models that were downloaded over 1 billion times. And I met him, and one of the things that really stood out to me was not only was he an expert in AI, but he also worked at Apple for over 12 years, and he really understood that sense of design, craft, worked on the original iPhone, and we became friends over the years. And as I was working with my current CTO, we thought about passing the baton. I thought, well, I really want a CTO that is at the frontier of technology, and Ahmed was that person. So we got really, really excited about working together.
So we've long talked about the role of AI in the future of technology, but I think, and I don't know, you can correct me if I'm wrong, you've been a little bit hesitant about how AI is going to ultimately get integrated into Airbnb, and we've had conversations about, how to integrate, for example, with some of the large language models like ChatGPT. So what does this mean for you?
We have a unique philosophy at Airbnb. I think a lot of people in Silicon Valley start with the technology and they try to find uses for the technology. In other words, they have a solution, they're searching for a problem. I think one of the things we try to do is we start with the customer and work backwards to technology. And so because of that, we have been very serious about AI, but we've not been wanting to rush into implementations that are novel but not really good for the user. We really want to make sure things we do are excellent. So with Ahmed, I think I'm really, really excited because I think we have an opportunity to do AI right for travel and do AI right for e-commerce. People use chatbots a lot right now. They're not using them a lot for commerce. I think a conversational search is a little clunky for e-commerce.
How much do you worry, though, that some of the large language models are moving so fast that you're not able necessarily to actually beat them, or they're able in some ways to beat you at your own game? And I say that because, ChatGPT now is allowing you to actually make purchases through it. Google doing the same. Now Google partnering with Apple. And so even if you don't want to do it, do you ultimately have to sort of live inside that ecosystem?
Both can be true. We are happy to integrate Airbnb into ChatGPT and to Gemini and to other platforms. I think that's great for us because Airbnb, first of all, is much more than a booking app. First of all, Airbnb is a community. 90% of people who book at Airbnb send a message to the host before they book. Everyone who books has to have a verified ID. So there's a lot more to Airbnb than just a booking app. Point number one. Number two, we have access to the same models as Google, OpenAI, and Anthropic. But we can do things they can't do. We have the benefit of specialization. I do not believe that people want to use just one agent to do every single thing in their life, just like they don't want one person in their life. I don't think we want thousands of agents, but we're not going to have a single agent. We're going to want to have some specialization. And so where we will win is that we will be specialized for traveling and living. We think people come to us for that.
How are you using AI, by the way? Talking about enterprise use case versus the consumer use case.
The enterprise, we're using, Cloud Code, and we're using different tools, and I think AI is fundamentally great for workflows. Every function in the company is becoming more efficient because they have AI tools, and these basically superpower tools. And then on the consumer side, we're using AI for customer service. So our AI agents are able to handle a huge amount of questions. AI is 24/7, it speaks every language. It can learn from millions and millions of customer actions to help you. And so we were able to reduce customer service contacts by like 15% in English. And with Ahmed, we're going to be able to move up funnel to travel search. And imagine one day Airbnb is this travel concierge, this companion that's with you the entire trip. That's where we're going. And I think ultimately, just to zoom out, Andrew, the superpower of Airbnb are two things. Number one, I think that Airbnb was founded by 3 founders, 2 of them were designers. So where we can win is design, mirroring great design and great craft with AI. And I think that's especially important in consumer. The other thing is we're really good at picking people online, offline, into the real world. AI stands for artificial intelligence. In a world of artificiality, people want what's real. Real life, real people, real experience in the real world. And I think that's where we can win.
Has AI changed your hiring plans at all? Has it shifted sort of how many people you think you need?
Not as much as I thought. But because, on the one hand, you don't need as many people with AI to do a job. On the other hand, AI accelerates the growth of your business, and so therefore they kind of net out. So I think on the one hand, we need fewer people for every $1 million of revenue, but we are expecting AI to increase the growth of the company, and so they're kind of balancing out.
As somebody who I always think is a barometer of the economy, and just, I mean, the travel space, I think, speaks to sort of what's going on, at least in the U.S., if not more broadly. What are you seeing right now?
We're seeing like really healthy travel demand, and there's been a lot of discussions around tariffs. There's been a lot of discussions around a lot of things related to the economy the last 12 since the pandemic. What I would say is the economy and travelers is incredibly resilient. For every like $1,100 or so spent in the world, about $1 goes to Airbnb. So we're about 0.1% of the global GDP. So we are a decent barometer, and we are the ultimate barometer on discretionary global spending. And what I'll tell you based on that is it is very stable and very resilient.
You're coming to us right now from California. You have not left California. By the way, given that you guys are, sometimes a remote business, you could be doing this from anywhere. You know where I'm about to go with this.
I know.
California weighing this wealth tax, which is going to hit people like you in a very big way. So what do you think?
I'm staying in California. I'm here in San Francisco. I'm not leaving San Francisco. I'm not leaving California. I think when the pandemic occurred, there was this question of, will tech migrate away from San Francisco? It looked like it was going to. And AI, I think, firmly planted a flag that tech is here in San Francisco. And so regardless of that outcome, I will stay here.
Brian Chesky staying, by the way, along with Jensen staying and saying so publicly and excitedly about it. We had a conversation about where AI is. I don't know if you remember, we sort of had a viral moment at the table when Brian was here earlier this year, and we said, where are we in the cycle? And he said excitement, and then I said, where in excitement? He said, well, maybe leaving excitement, meaning like it's getting a little bit too much. He said, we're still there, so we'll see where we end up. But really? I think a real shift in terms of what they're doing. The other piece of it that I thought was interesting is the idea that he's actually not changing the hiring plans. A lot of companies have come on and said, look, AI is going to change our hiring plans. He said not as much as he expected, which I thought was sort of a surprise just in terms of everything else going on.
Well, he's such a smart guy, and to hear his thoughts on where AI is headed, why he's hiring, and what he sees in the future, fascinating to see.
Oh, one other thing that's actually, I thought that we didn't get to show the tape of, which is interesting, talked about how so many of these consumer large language models, ChatGPT and the others, he thinks are going to need an advertising model or something else to effectively make them work economically for free. That the only ones that actually work are the enterprise ones, meaning people who can do this for business, expense it, or the company's buying it for their employees. That makes sense.
Gets back to the question of who will pay. Will consumers
Will consumers pay? And I think his view is actually they won't pay. And then the question is, if they won't pay, what does that model look like? We talked a lot about, obviously, Google search and how he's never felt that when you see a Google search ad, you don't think that it changes the trust that you have for the other links on Google. But that in an AI world, would it change your trust of what AI is telling you if you're also seeing either links or other ways that they would be because you're asking what's the best sneaker or whatever the thing is, and you want them to tell you what the actual best sneaker is.
Not what they paid to tell you.
And so, right, so if Nike or Asics or whomever
that's
throws in, how does that actually work?
Right. I no longer trust the information you're giving me because I feel like it's biased.
We'll have to put some of that part of the video online because it's pretty interesting stuff.
Makes it tougher to monetize, all of it. All right, when we come back, we're going to take a look at where the big banks are trading following earnings this morning. Then former Fed Vice Chair Roger Ferguson says that the investigation into Jay Powell is ratcheting up the fight for Fed independence. He will weigh in right after the latest inflation data. Squawk Box will be right back. Welcome back, everybody. Let's get to Dom Chu with a look at this morning's pre-market movers. Hey, Dom, what's on the move right now?
All right, good morning, Becky, Andrew, Joe. So a lot of bank earnings to recap this morning. I'll try to be as expeditious as possible. Citi just out this hour here, beating on the top and bottom lines as the lenders set aside less money for troubled loans than analysts had expected. That stock is hovering just around, you can see they're up maybe 1% or so. Bank of America also topping estimates this morning, posting better than expected net interest income on gains in equity trading as well. That stock you can see there, maybe down about 1.5%. Wells Fargo is the biggest decliner so far, sinking by just about 2% on a revenue miss as severance costs drove up some of those expenses. So that's the bank side of things in a nutshell. Meanwhile, you got Netflix shares higher by just about almost 2%. The streaming giant is considering an all-cash bid for the streaming and studio assets of Warner Brothers Discovery. Sources say the changes are designed to expedite a sale amid a rival bid from Paramount Skydance. On Monday, Paramount sued Warner Brothers for more information about its deal with Netflix. So Netflix shares up about 2%, and shares of BP are dropping right now just about 1% after the London-based energy company flagged a write-down of up to $5 billion in its gas and low-carbon energy segment for the fourth quarter. It also warned its fourth quarter oil trading performance would be weaker and could drag on earnings. That echoes a similar forecast from British peer Shell last week. Shares are just up about 12% on the year so far. So those are your headlines on the market mover side. In a nutshell, Becky, I'll send things back over to you guys.
All right, Dom, thank you very much.
You got it.
Coming up, producer price data, for December, and some delayed retail sales data. That is coming up next. Then Democratic Senator Elizabeth Warren joins us on potential common ground with President Trump on capping credit card rates. They also, it sounded like with dividends, buybacks, God, it's a real, it's touching. Real meeting of the mind. Squawk Box will be right back. Got some time, but in a couple of minutes we are going to get the producer price index data. Also, November retail sales which was delayed by last year's government shutdown. The futures are in the red a little bit after some losses at the end of the day. And I do mean at the end of the day. I don't mean at the end of the day. I meant that by the end of yesterday's day. Never mind. Treasury's 4:15 or so. Rick Santelli is going to talk to us going forward, because going backward would make no sense at all. He's at the CME in Chicago. Hey, Rick.
Hi, Joe. So what do you think? What do you think, Joe? All these moving parts, the pivot by the administration towards affordability, all the focus on the midterms. I don't know. What's your sense on the economy? I get the sensation that we are definitely re-upping on the growth story. What's your thought?
I think that as well, and I saw something earlier today. What is the affordability problem? Wages still aren't growing quickly enough to even keep up. They are, but it doesn't feel like it. 2.7 yesterday, you pointed out, stable, but still too high. Could be 3% in the future, which is something I think you said we need to get used to. My question to you is, what about the report today is going to be different or nuanced versus the CPI yesterday to try and get a read on where we really are?
I think that you're going to see the wholesale numbers coming down a little bit more aggressively. So I'd pay particularly close attention to the most core aspect, the ex-food, ex-energy, ex-trade year over year. If we could get that a little further under 3%, in my opinion, that would be the biggie. And in terms of retail sales, well, retail sales, I would like to see the ex-autos and gas number over half of 1%. I think those are the two metrics I'm paying closest attention to. And here we go, getting very close to the release, and it's hitting the wires now. On the producer price index, this is November. I don't have October, so the comps get a little weird. Up 0.2 as expected. Strip out the all-important food and energy. Good news. Unchanged. That's definitely much cooler than we were expecting. And without the October read, what I would say is that unchanged would be the smallest going back to August when it was down 0.1%. Let's strip out food and energy and trade, and it's up 0.2 as expected. Now, here we go on the year-over-year numbers, in my opinion, the most important. Year-over-year final demand, 3%. Hot. 3%'s hot. I don't know what October was, but that would be the hottest since July when it was 3.2%. If you strip out food, energy, and food and energy on the core, it's also 3%, much warmer than the 2.7. Strip out food, energy, and trade, the one I wanted to be more under 3%, exactly the opposite. It gooses up to 3.5%. That would equal March, and to find a higher number, you're going back to Feb when it was 3.6. Asterisk, I don't have October, so I have 1 month missing when I'm doing the comps. That's the Moneyball number in terms of the negative aspect of this report. Retail sales for November, a powerful up 0.6 on the headline. That would equal July to find a stronger number. You're in June of last year when you're up 1%. Strip out autos, it still remains rather strong, up 0.5%, stronger than we were anticipating, much stronger than the revised up 0.2 in the rear view mirror. Strip out autos and gas, and it's still hot, up 0.4, better than expected, equals the slight downward revision to last month from 0.5% to up 0.4, and the core retail sales number up 0.4. That's also strong. Now it's as expected, and it's definitely weaker than the 0.6 in the rear view mirror, but this series has been running pretty strong of late, so we want to pay attention to that. Now, I'm not quite done yet. The cousin to the trade balance, the current account balance, expected to be a minus sign of 238 billion, comes in roughly in that area, minus 226 billion. Last month ends up slightly under 250 billion at 249 billion, all minus signs. Now, what is the absolute record in this series? It was the first quarter, March, the quarter ending in March. It was minus 439,000, Joe. This metric goes back to 1960, and of course, that was the biggest ever. So even though minus 226 doesn't sound good, it's significantly less than minus 439,000. Now, after all of that, Where are we? Well, we're hovering right now at 416 on a 10-year. Where were we before that litany of numbers? 416. So we did see some volatility, but not a lot of attention was paid to those much warmer PPI wholesale year-over-year numbers. I'm a little surprised, and just because it's not affecting the market right now doesn't mean it's not going to affect it as time goes on. I would definitely look for these numbers to once again push that 10-year to test that 4.20%. We haven't closed above it in over 4.5 months. It really has been a tight range in long-dated treasuries. Joe, back to you.
You know, I hope I didn't have my heart set on more rate cuts. I don't know how weak the labor market would have to appear to get any this year with numbers like, if it were to continue, the numbers that you just gave. There's just no way.
I couldn't agree more. And you know what? In many ways, this may be at the epicenter of everything going on with the Fed chairman. Listen, I'm not going to weigh in too deeply. I have no idea who's innocent, who's not innocent, who did what, who brought it. All I can tell you is that if I was chairman of the Federal Reserve, I'm not sure I would have played 2025 much differently than the current chairman. And as far as your comments right now, I couldn't agree more. With these numbers on the warm side year over year, you got to kind of run in place for a while until you get better data on the labor market, which looks like it's re-upping to many anecdotal facts.
Yeah, what did this time, Rick? I mean, if you had to point at something and say, aha, for why it was hotter than you thought for sure, what is it?
Yeah, you know what, Joe? I don't know that I could even make a guess on this on the wholesale side. I'm sure that somehow they're going to connect the political dots to issues that may be due to tariffs or whatever.
Yeah.
But in my opinion, I really do question some of the accuracy of some of these numbers. But boy, that's well outside the realm of expectation. So most likely there is some smoke where there is fire.
Okay, thanks, Rick. Join us now.
Thank you.
Roger Ferguson, former vice chair and a CNBC contributor. And Roger, I knew you'd be smiling, but I did not have a picture. I wish I would have had a monitor when that was coming out, because you would have been going, here, they're not taking me, otherwise you can't. You would have been going, that's what, did you do that? Did you do that? This is exactly your biggest concern and your reason for being hesitant about cuts and everything else. You have been stubbornly in the camp that inflation is not laid to rest yet, and these were not good numbers if that's what you were hoping for.
Well, I was hoping for better numbers because I want inflation to be laid to rest. But
you like to be right. But you like to be right, and you once again. You didn't do it. You weren't doing that. I didn't see you on the monitor, but I think we're like.
Oh, no, I was not doing that, Joe. I was weeping a little tear coming down my eye here because I think we really need to. No, very seriously, we need to get inflation under control. And you know, it unfortunately is not happening. Now, I'd also say the labor market looks a little stronger, which is a good thing. The retail sales, in some ways, we should be happy. You know, it's good to know that our consumers are still hanging in there. So, you know, the market sometimes says good news is bad news. Let's also recognize the good news that the economy is not falling off. And the challenging news still remains that inflation's higher than it should be. So the Fed needs to be on its game and needs to be awake, and I think it will be.
On its game means don't do anything. And maybe the last cut was not necessarily the. A lot of people said it at the time. I would not have done one more. But what you just described, stubborn inflation and an improving labor market, that's not cut worthy. That's not asking for more easing at all. It's asking for the opposite.
Yeah, look, I agree. And on the last cut, you know, the minutes showed it was really a close run thing. You know, using Fed language, there are a number of people who went along who maybe would have been equally comfortable not moving at the last time. But you know, that's in the rearview mirror. I wouldn't say it was in any way, you know, a disaster whatsoever. I think the Fed is very well positioned, and they've been quite clear that they're going to wait and see the data come in. They're not going to be pushed around by external forces. And I think the market and the Fed now are probably going to be pretty aligned that January at least is a wait and see meeting, and then let the data tell us what happens after.
Well, Roger, if you care about affordability and if you are of the opinion that wages need to keep up with inflation, and inflation is hotter than you thought, Fed independence is absolutely essential here, because the last thing you'd want to do is be pressured to cut rates if inflation is going to be the problem.
Joe, as always, you and I are totally aligned. Fed independence is absolutely critical here. It is, on the table, so to speak. It's on the table with the Supreme Court next week, the week after the Lisa Cook hearings and opinions, hopefully thereafter, that validate Fed independence. And then obviously we see some of the more recent things that have happened over the last week or so vis-a-vis this criminal investigation. So, the world, the market is abuzz. I'd say even the world is abuzz around questions of Fed independence. We saw central bankers from around the world sending in a letter of support for Chair Powell. So this is a very important issue that has to be taken quite seriously. The Fed was not always independent. There was a pretty tough fight at the end of the Second World War around 1951 to create Fed independence, and we should not take it for granted. And so I think that's going to continue, unfortunately, to be an important topic until we get this behind us.
Hey, Roger, do you think this helps strengthen the hand potentially of a Kevin Warsh over a Kevin Hassett? And the only reason I ask is, given this question of independence and the possibility that there are folks in the Senate and others that could try to hold up a potential Fed nominee, and this issue of independence will be the central question, whether the president will actually be better off picking somebody who is not considered as much an insider with him.
So I think you're right. Kevin Hassett was certainly a front runner. One of the reasons he was a front runner was a perception that the president was going to put a great deal of weight on what we can describe as loyalty. And now the notion of being independent has become much more important, and maybe the pendulum, as you point out, will swing to one of the other candidates. And so we'll wait and see. But I think a couple of the senators, including Republican senators, have made a similar kind of comment that they aren't going to be comfortable until this is behind us. And I think that all, as you point out, sort of suggests, the one who can most honestly say, I've got a long record of independence may well be the one that comes across the finish line first through the whole process.
Very good, Roger. Next time I think I can do that. You won't even know I'm watching. If we can turn that camera on, we'll watch your reaction and see if I'm right about what you were doing. You're going
I'm central bank stoic at all points, even when the camera's.
All right.
Look out, you'd be surprised what we see from people.
Yeah, you would. You would. Digging for gold sometime.
I'm sure you're wearing pants.
Yeah.
Coming up, Democratic Senator Elizabeth Warren. She's going to join us next. She spoke to President Trump this week about potentially working together to cap credit card rates. Squawk Box returning with that after this.
Welcome back, everybody. President Trump reached out to Democratic Senator Elizabeth Warren for a conversation that the White House called productive. Joining us right now with the details of how that conversation came about and maybe some areas where they can work together is Senator Elizabeth Warren. She is the lead Democrat on the Banking Committee. And Senator, thank you for being with us. It almost sounds like a Saturday Night Live skit that the two of you actually spoke and had something that the White House called productive. First of all, how did this conversation come about? It was after a speech that you had given that was actually pretty fiery.
That's right. I had just given a to get interest rates down. And he said he wanted to work on that. And I said, great, let's get something done, because my point was, and I made this point in the speech, he had not lifted a finger to try to get something through on credit card interest rate caps. And then while I had him, I said, you know, there's something else you could do just right away. We need to bring down the cost of housing, and the way we do that is to increase housing supply all across this country. We're 3 million units of housing short, and we need urban housing, rural housing, housing for first-time home buyers, housing for renters, housing for seniors, housing for people with disabilities. So I had worked with Chairman Tim Scott, the Republican chair of the Banking Committee. We put together a bill that had 40 proposals in it, every one of them aimed toward increasing supply, making it easier to get approvals, more on manufactured housing. Passed the Senate unanimously, and yet goes over to the House, and the House Republicans won't move it at all. Gets tangled up over there. And I said, Mr. President, you want to help bring down the cost of housing? Light a fire under your House Republicans, get them to move this bill. Let's get it signed into law, and let's get started now on a first step on lowering housing costs. So we have a lot to talk about.
I want to go back to credit cards just
Sure.
for a moment, because there is a study by a professor at the University of Pennsylvania's Wharton School suggesting that a 10% cap could make up to 80% of customers of credit cards in America unprofitable at the current lending rates and credit limits, which suggests that there would be a meaningful reduction in the amount of credit potentially made available to customers if something like this were to go into effect. What do you make of that?
Well, first, obviously, I want to take a look at their data, but I also just want to start with the big picture here. Is there anybody defending 36% interest rate on credit cards or 28% interest on credit cards. Anybody out there who isn't paid by the industry that's putting out those credit cards? And do keep in mind right now, there are a lot of community banks, there are a lot of credit unions that are putting out credit cards at much, much lower interest rates. But what do the credit card company giants say? They say, oh no, you can't touch credit card interest rates. No matter what, it will be the end of the world. We will shut down credit cards. They go on and on and on. And basically, it's the same song they sang over what would happen if the CFPB put some caps on overdraft fees. What would happen if the CFPB put caps on fees on credit cards? The credit card companies literally make billions of dollars. Last year, they made $150 billion in profits off the credit cards that American families are holding. So we have some choices to make. Do the investors and the corporate executives keep that $150 billion, or does some chunk of that go back to hardworking families who are just trying to pay their mortgage, just trying to pay for groceries every month?
Senator, cumulatively, prices rose 22% in the Biden administration. So much, in fact, that real average wages were lower when Biden left the office than when he came in. Inflation was today 2.7%. It's still too high, obviously. But how are you blaming Trump's policies on the affordability crisis when you're talking about 2.7% versus 22%?
Well, let's talk about what's happened. And that is that Trump's tariffs have driven up prices. Trump's chaos from the tariffs and other changes have driven up prices. Trump's energy policies have driven up prices. Price of utilities, take a look around. And Trump's decisions, along with the Republican Party, to cut access to health care has driven up the cost of health care for some families double and even triple. So we're talking about Trump policies that have driven up costs for American families. You know, just pick one little piece out of that. Have you observed what's happening to home mortgage foreclosures? Do you know that since Donald Trump was sworn in, home mortgage foreclosures have gone up 21%? So yeah, there have been a lot of policies that Donald Trump and the Republicans have been following for a year now, and it is showing up in the cost that people pay.
I was trying to do the composite of putting everything together instead of picking individual things, and that's 2.7% versus a high of 9% during the Biden administration. Oil's down at least. Most prices don't drop, Senator. You know, the Fed looks for a 2% inflation rate. That's the target. So prices continue to rise every single year because we don't want deflation. So 2.7, while not great, is nothing close to what we had under the Democratic administration.
You know, Joe, what you should do? You should go lecture to every American family around the country who is saying they feel under enormous economic stress. 80% of Americans say, I'm worrying about whether or not I can make it to the end of the month on my paycheck. I'm worried about whether or not I can send my kids to school. I'm worried about whether or not I will ever have a chance to retire. American families are mashed to the wall on prices. They are not able to take their paychecks and stretch them far enough and build some real economic security. And part of that is because Donald Trump, in the 1 year that he has been in office, after promising how many times during the election? At least hundreds of times, promising to lower costs on day one, the costs that families have to deal with up close and personal every day, those costs, groceries, utilities, housing, healthcare, those costs are up, and it's putting a squeeze on American families. You can go tell them it's not, but I don't think they're going to believe you.
I'm trying to read the room here. Do you get the sense that you and President Trump will actually be working on things together, or do you think that this was just talk and that no action will come of it?
I don't know. You'd have to ask Donald Trump. I'm ready to go. I've got the legislation ready to go. We've got the housing bill that we've already gotten all the way through the Senate. I've worked with every Republican to get that done. My job is to do anything I can to lower costs for American families. And the Democratic Party is ready to go. We stand behind that. The question is, right now, all the Republicans have done is raise costs for American families. Donald Trump says, no, he wants to be in the business of lowering those costs. My answer is, talk is cheap. But if he's really ready to put up and get something done, then let's do it.
You said you didn't recognize the phone number when it came in. Did you save the number into your contacts?
You know, it really was one of those moments. I don't usually pick up the phone when I don't recognize the number. And I thought, I just come out of giving this speech. And I thought, 202.
You can
somewhere
put a
in
special.
Washington.
You can put a special ringtone on there, Senator. I've seen it on Landman. When his wife calls on Landman, it's just really scary. I think you can shout.
It's a great touch.
Yeah.
Senator Warren, thank you for joining us this morning.
Thank you for having me.
Okay, big banks on the move after two key reports and a big move from a tech powerhouse. Squawk on the Street is coming up after a quick break. Breaking on Squawk Box this morning, producer price index on a year-over-year basis went up 3% in November. That is higher than expected. Meantime, Bank of America and Citigroup both posted earnings that beat estimates. Citi shares up, Bank of America down. And Airbnb has a new technology chief, Ahmad Adal, and the travel tech company was able to hire him away from Meta, where he was head of generative AI there. Joe.
Final check now on the markets before we toss it over to Squawk on the Street. You can see down 160 points now on the Dow. We had a lot of bank earnings today, in addition to yesterday, and really nothing happened. We had a hot PPI, a number as Rick Santelli told us what to watch for. Said you want the year-over-year core number minus I guess minus food and energy and whatever that is. But he said that should be, hopefully that will be under 3%, which would be really good. And instead it was well above 3% in the hottest in a while. But that didn't really move things much either. So things are going to happen throughout the session. We've got some talk about Greenland. We've got a potential tariff decision. So I don't know if I base anything on where we are right now. So we're going to toss it over now to Squawk on the Street. It's their problem. Join us tomorrow.
Bye.
Bye.
Good Wednesday morning. Welcome to Squawk on the Street. I'm Carl Quintanilla with David Faber, Sarah Eisen here at Post 9 of the New York Stock Exchange. You'll see Kramer tonight on MAD. Stocks looking at another day of declines as bank earnings are mixed. A lot of attention on Iran, waiting on SCOTUS perhaps. Brent crude up more than 10% over 5 sessions. Retail sales do come in strong, but so does year-on-year producer prices up 3%. Bonds mostly taking that in stride. Our roadmap begins with this flood of bank earnings. Wells, B of A, and Citi beat estimates. Most of them anyway, what they're saying about their outlook and for the U.S. economy.
From Wall Street to Washington, a Supreme Court opinion on President Trump's tariffs could come today. We don't know, but we are expecting a decision, plus the latest back and forth on Powell and the Fed independence.
And I will have some new developments in that battle for Warner Brothers Discovery. Netflix likely to make its deal all cash. We will talk about why.
Let's begin with market reaction to some of the bank earnings today. B of A, as we said, Wells and Citi. The outlier is Wells today, Sarah, which is a miss on both the bottom and the top line.
I don't know. I think it says more a little bit about the expectations just missing, because overall it was a pretty healthy quarter for Wells. I did have a chance to talk to the CFO and the CEO today about the business, and it was exactly what they expected and exactly what they think that they've been telegraphing Wall Street in terms of growth. They've been unshackled from the Fed with this asset cap where they weren't allowed to grow, and now they are seeing really strong growth. Credit card, they say, continues to see strong increases in spend. New accounts grew over 20% from a year ago. Auto lending returned to growth, they said. Balance is up 19%. Net checking account growth was stronger. The Wells Fargo Premier, for instance, grew 14%. They did forecast net interest income for the year to about $50 billion in 2026. And just to show you what I mean when I say expectations, the expectations for the full year was $50.33 billion, according to the FactSet consensus. And same with the quarterly numbers as well. I think it was a slight miss on net interest income, but similar growth trends to what we're seeing from some of the others, the Bank of America's and the JP Morgan's on Wall Street as well. So this is a stock that had outperformed, and there are, higher expectations now, but credit quality looked good, the consumer looked good, and they're proving, I think, their growth story with continued momentum on the cost cutting. I mean, they have changed this bank, reduced the headcount from, I think, 275,000 people to 205,000 people.
Yeah,
and that shows up in some of the
Charlie Scharf has made no secret of it. In fact, I think speaking more to it than many CEOs would choose to in terms of the impact as well that AI could have, and they continue to seemingly focus on reducing cost overall. Would note, of course, the earnings today are against the backdrop, Carl, of that, as you take a look at some comments from Mr. Scharf in the press release in terms of their performance. Obviously, that asset cap was such a key moment for them when that was removed.
We're excited, he says.
Yeah, the old level playing field. But Carl, what I was going to mention, of course, was the performance of JP Morgan stock yesterday, which yet again fell as the day went along more significantly than it had earlier in the trading session after earnings that were generally seen as positive. Not a big surprise. JP Morgan stock seems to do that oftentimes after earnings, only to recover and then some during the remainder of the second quarter.
Yes, I think maybe expenses were part of this story there yesterday.
Yeah, maybe expenses, and just these lingering concerns, I think, Sarah, in terms of credit quality and things of that nature.
I was on the credit cards,
on the credit card side.
On the lingering concerns there on what President Trump might do when it comes to capping credit cards. I mean, the credit card companies, the Amex and MasterCard, sold off yesterday.
Yes,
as
they
well.
did. Yes,
So
they did.
that's something to watch. The other one I'm paying attention to is Citigroup, because that also continues to be an improvement story. Jane Fraser's been CEO now almost 5 years, and they've gone through this tremendous transformation here when it comes to, she's brought in a lot of talent from other big banks. She's also, slimmed down and focused some of the areas. They did show growth, revenue growth in all of the different divisions. And I got my hands on an internal memo that she sent the team where she actually says that they're about 80% through on the transformation. I think we do have that quote, if we can pull up from Jane Fraser. Continue to advance our transformation with more than 80% of our programs at or near city's target state. The OCC's removal of, this is another sort of regulatory hurdle they had to climb from the consent order in December, provided clear external validation of how far we've come, and will continue to drive innovation through a recently launched effort to use AI and automation to innovate, re-engineer, and simplify about 50 of the largest and most complex processes in the firm. So David, there's AI again. They're increasingly talking about it, these CEOs, and how, and she was pretty specific, 50 different places they're going to be using it.
Yeah, city shares were lower. Pre-market actually have reversed into the green. We'll get to B of A in a few minutes. Meantime, the president has sounded off yet again about the Fed chair, while global markets await a potential Supreme Court opinion today about tariffs. And for that, we'll get to Eamon Javers this morning in Washington. Went through this on Friday, Eamon. We'll see if today's the day.
We were all dressed up with no place to go on Friday, Carl. We'll see what happens today. Let me start with the president's comments last night. He gave this interview to CBS News, continued to pile on insults on Jay Powell and the Federal Reserve. He said that Powell is either corrupt or incompetent in that interview last night. And here's what else he had to say.
He's been a lousy Fed chairman. He was reappointed by Biden. I was a little surprised at that because I didn't think he really earned the stretch. He's been too high on interest rates.
So we'll continue to follow the bouncing ball on that relationship throughout the day and see if we get any more developments in terms of this Department of Justice investigation. Meantime, as you point out, 10 o'clock, we are expecting possible decisions from the Supreme Court just about an hour from now. Again, we don't know in advance what the Supreme Court is going to do, what decisions might actually come down. So we will be standing by for this tariff decision. Take a look at what's at stake here. We have a graphic prepared which shows you just how many billions of dollars are on the line here. Remember, what the Supreme Court is going to be deciding here, whenever they do issue that decision, is on the constitutionality of the IEEPA tariffs. Not all of the tariffs, but just the Liberation Day tariffs and the ones that he used this law for. So overall tariff revenue, $251 billion. The IEEPA piece, $133 billion in terms of what's at stake, what's been collected this year. An interesting comment from the president earlier this week that you might want to just kind of put a pin in, which was, he said that the stakes here are so high, the amount of money that the United States government would have to pay back in terms of refunds to companies who paid those tariffs during the course of 2025 is so high we might not be able to pay it, in effect, is what the president said. Other people in the administration have said if the Supreme Court decides against the United States, they will issue refunds to companies. But that comment from the president, guys, makes me wonder if there could be some sort of lag in payment or some delay or some fight over whether or not the U.S. government is actually going to pay those refunds. So we'll watch what the decision is, how that's structured, and then how the administration responds in the immediate aftermath if it goes against them, and do they commit to making those payments to those companies, because it could be material for some of these companies who paid a lot of money in tariffs last year.
Way, Eamon, of saying what the president said, and that is, we're screwed. Those were his words.
Yes, right. I mean, it's a huge problem for the administration. The president likes the flexibility of using IEEPA, which hasn't been used for tariffs in the past, but he likes it because it's nearly unilateral executive authority in his interpretation of the law. The other way you put tariffs in place requires you have to go through a lengthy and convoluted process of conducting a study and then having a time period. All of that, ties his hands a little bit more. The president says he's been able to bring foreign countries to the table in negotiations about all sorts of things using that unilateral tariff. And if he has to use this other method, then it could be much more cumbersome. Scott Bessent, the Treasury Secretary, has said, look, if it goes against us, we have other ways of enacting these tariffs, and we'll just simply change it to a fee or some other arrangement, and so we'll effectively be collecting the same amount of money. It'll just be a lot more convoluted, cumbersome, and time-consuming, and that means the president doesn't have the flexibility that he wants.
Yeah, I mean, that's why I don't think that most economists will tell you there's not a big macro impact of this decision, even if it doesn't go the president's way, because the White House has been quite clear that they'll just find other levers to pull when it comes to collecting these tariffs.
Yeah, it's interesting. The tone you get from Scott Bessent on this is, well, it would be bad if the Supreme Court ruled against us here, but we have other ways of dealing with this. If you listen to the president, you know, his hair's on fire on this. I mean, he's really appalled at the idea that the Supreme Court might rule against them and that they would have to reconstruct the entire tariff regimen that they put in place over the past nearly year now. But I think it's, you know, if you are an investor in one of these companies that paid all this money, you might want to sort of back out your calculations and figure out how much they could be getting in a check from the U.S. government and when that check might be coming in. Might be material for some of these companies, so a lot of CEOs are going to be watching this to see what happens, and of course a lot of foreign countries will be watching this to see what happens, because that impacts whether or not the president can really have his hand on that tariff tiller in a really direct, immediate way every single day of the week. You saw him just this week threaten to impose tariffs on any country that does business with Iran. That's the kind of flexibility he likes to have, and it's the kind of flexibility that might be sort of hands tied in the future if the Supreme Court goes against him in about an hour's time.
Kalshi's only given him, Carl, a 28.9% chance of the Supreme Court ruling in favor of Trump tariffs, so they're betting the other way.
That's about right.
Yeah, I guess, Eamon, so next week the Supreme Court is hearing oral arguments, I think the 20th and 21st, and the 21st is a key one for Wall Street as well, because that's when they're supposed to hear on Lisa Cook. And a lot of the research I've read actually suggests that the Lisa Cook case is even more important than they're watching this Powell investigation when it comes to implications for Fed independence.
Yeah, absolutely. I mean, the Lisa Cook case is all about, you know, this question of for cause. What does it mean that the president can fire somebody from the Fed for cause, quote unquote? Does that mean some malfeasance on the job? Does that mean some malfeasance that they committed before they took the job? Does that mean the president just doesn't like the cut of their jib and he can fire them basically because the cause is he feels like it? That is flexibility that the president obviously wants to have. And the question is whether he'll be able to have it or not, or whether he'll be constrained. The president has a maximalist view of presidential authority, and you know, we'll see the old checks and balances kick in here and restrain that in terms of the Supreme Court or not. And that applies to, you know, that position on the Supreme Court. And also, I think, you know, you back out of that into this Jay Powell fight and whether or not Powell will step down. How many seats on the Federal Reserve does the president get to fill this year is a very interesting question for Fed watchers.
Okay, thank you, Eamon. Eamon Javers.
Yeah.
We're glued to the Supreme Court. Here we go again. See
Yeah.
if we get that decision at 10 a.m. Eastern. Meanwhile, the president was asked last night, he did an interview with mainstream network, CBS, about the economy, and he was asked about the Fed chair, and he was asked about Jamie Dimon's comments on the earnings call yesterday, CEO of JP Morgan, saying threatening Fed independence is not a good idea. Listen to how the president responded.
Sir, Jamie Dimon said today that it's not a great idea to be chipping away at the Fed's independence. Do you think Jamie Dimon's wrong about that?
Yeah, I think it's fine what I'm doing. We have a bad Fed person. He was extended by Biden, and yeah, I think he's wrong. I think it's wrong. He's done a bad job. We should have lower rates. Jamie Dimon probably wants higher rates. Maybe he makes more money that way.
He actually does make more money that way, but I don't think that's what Dimon was getting at. That was just Trump taking questions from reporters there. But clearly he's not backing down necessarily on the vitriol and the criticism for Powell, certainly on rates, but didn't really go there when it came to any kind of criminal investigation by the Department of Justice. He hasn't really gone into that.
No, although the Times today talks about the blowback sort of impeding his efforts to assert dominance over economic decision making, and we'll get into some of the documentation the FT's uncovered about what Powell gave to Congress last summer about this renovation issue.
Pushing back on this idea from Judge Jeanine that they were not compliant with it. Now look, he's getting pushback, especially from Republicans. We're going to talk to Senator Kramer, who's on the Senate Banking Committee in Money Movers. He was one that said he didn't think Powell was criminal. So we'll talk to him later in a few hours.
Meantime, still to come this morning, some new developments on the battle for Warner Brothers. Take a look at the pre-market here. A lot of moving pieces today, whether that's macro, SCOTUS, or geopolitics. So don't go away.
Welcome back. Some new developments on the battle for Warner Brothers Discovery. Late yesterday, some reporting from competitors that Netflix considering replacing the stock portion of its deal, $3.75 a share of the $27.75, or the original consideration of $27.75, is made up of Netflix stock with all cash, so that shareholders would get $27.75 all in cash. And then remember as well, eventually you will also get the Global Networks stub, which is not part of the Netflix deal to acquire the studio and streaming business of Warner Brothers Discovery. It's not 100%. People familiar with the situation tell me, but it is likely that Netflix is going to move and move quickly. We should get an announcement fairly soon in terms of replacing that stock portion. Now, of course, people who've been following this closely know the stock had fallen below the bottom of the collar, and that had impacted the overall value of the deal to the tune of about 30 cents. So it was worth at the lows, and Netflix stock already moving up on this potential change. At the lows, the deal was reduced in price by, let's call it 30 cents a share or so to, let's, 27.45 or so. This clarifies that, this eliminates the stock portion, but that is not the reason. The main reason for doing this is because it will significantly accelerate the shareholder vote. Remember, we've been talking about a shareholder vote here, which is the key, of course. Paramount working strenuously to get shareholders to vote down the Netflix deal when Warner Brothers shareholders do vote, and is now suing in Delaware court, challenging really the business judgment rule, which is really hard, and any number of other things. But the vote is the key. It was not going to take place until the late spring or early summer. That will change should Netflix move forward with a change to all cash. Why? Well, when you issue stock, you've got to issue a lot more financials, a lot of accounting around it, and that just takes a lot of time, a lot of effort, work, not to mention expense even, for doing that. This makes it cleaner and quicker. And how much quicker? A lot. We're talking months. In fact, again, unclear, but you could see a shareholder vote as soon as late February, early March. If in fact Netflix does this, you will get the proxy and you will get the date. But perhaps the proxy will come very soon. Again, that's the point I'm making here. The proxy itself would not be filed for quite some time if you were continuing to include stock in the transaction. That will change with an all-cash offer, and that will bring the question as to whether Paramount is going to raise and do something beyond suing and claiming it's being treated unfairly in order to try to win the day. That remains unclear at this point, but Sarah, it will have the effect of consolidating that timeline significantly. I mean, let's call it, again, we don't have a date, but we were assuming perhaps as late as June, maybe early June, right? Sam DiPiazza, the company's chairman, has said late spring, early summer. I'm sorry, late spring, yeah, early summer. So this could move it up to, you know, let's call it early March, if not even sooner.
I mean, you know, I like the sort of drama behind all of this with all the parties. I am curious what it says, because wasn't the whole thing that Warner was saying is that Netflix is a better bid. It's, you know, go with the company that's worth $1 trillion. Go with the company that this is the money is guaranteed. Why would they then have to do this? In other words, does this prove Paramount's point?
I don't
maybe
believe
it wasn't a superior bid.
Well, no, I don't believe it does. In that sense, it clarifies the overall value. It is $27.75. Nobody knows exactly what would happen to Netflix stock. It brings that shareholder vote to bear much sooner, and so it does clarify the story to a certain extent. Netflix, it's been interesting, Carl, to watch that stock, which has traded down more or less ever since, frankly, since we first reported they were serious, and then, of course, when they actually got it. So, Sarah, I don't know that it specifically in any ways is an answer to that, saying, oh, yeah, we are inferior. That's not really what's going on here, as much as I think it is an attempt to have shareholders answer that question.
But it's an attempt to sweeten their view of their bid, of Netflix's bid, right? Shareholders' view of Netflix's bid.
Well, yes. I mean, again, it's not changing the overall value, except that because it was trading below the bottom of the collar, the value was impacted, as I said, by 30
Your
cents
point is
a share.
that the process is quicker now. Does it squeeze Paramount's ability to approach this through the board?
Well, Paramount has got to come up with what is likely to lead to a superior offer if it really wants to speak to the sport. Now, they're suing in Delaware court, but it's very much unclear where that will end up. And as I said, the business judgment rule allows for a lot of latitude amongst the board of directors in deciding what is a superior bid, Carl. So what this really does is says, okay, it's going to be sooner. And therefore, Paramount, if you are going to significantly improve your bid or meet some of the objections that the Warner Brothers board has, you're going to have to do it a lot sooner than we thought. Because we thought this thing could be playing out over the next 4 or 5 months. Now it will tighten that
So
time.
what are they going to do?
I don't know. I don't know, Sarah. To be
Find that out tomorrow.
To be continued.
Yes. Take another look here at the pre-market on this busy Wednesday morning. A programming note as well. Tonight on CNBC, an all-new episode of Leaders Playbook with our Julia Borston, featuring interviews tonight with Uber's Dara Khosrowshahi and mogul Barry Diller. That's tonight at 10 p.m. Eastern Time. Take a look at the 2-year today, moving past a lot of moving parts. PPI, 2/10 in line, core PPI unchanged, which was nice to hear. Also, retail sales strong, but maybe the bigger stories are things like silver, 91, oil near 62. We'll get to some of these commodities moving on headlines out of Greenland, Iran, and other things. Opening bell coming up in just a couple of minutes. Let's bring in our senior markets commentator, Mike Santoli, ahead of the opening bell here at Post 9. Curious to know where you think the lead is today.
Look, there's a lot for the market to chew on every day, it seems like. And I think that the basic broad observation is the market is attempting to sidestep some of these, policy grenades and everything else through rotation. So we came into the year, everybody is positioned for cyclicals to do well, for the economy to reaccelerate, for earnings to grow. Nothing has been refuted about that. The banks actually kind of confirmed that view, but we paid for it in advance. The banks are selling the news more than not, and I think that's the environment we're in. Also, we expected policy tailwinds. Now we have to deal with a little bit of policy challenges on many different fronts, and the reflation trade is also getting tricky with oil participating in that.
Mike's going to stick around. Let's get the opening bell here at the CNBC Daily Time Trade. At the big board, Block Spade Acquisition 3, a SPAC celebrating its IPO at the NASDAQ. It's MD Medical, focused on non-invasive therapeutic systems. As we're going to continue to chop around here in the low 6,900 range.
I would just say we did get some economic data today. Retail sales come in better. They were from November though, so a little bit old, but we're working through the shutdown impacts. But overall, good read on the consumer. Headline number up 0.6%. That was better than the 0.4% consensus. And then that important control group, which feeds directly into GDP, into growth, it was up 0.4%. That was largely in line with the street expectations. We got PPI as well. Maybe a little out on the overall number, but beneath the surface doesn't really show anything too worrisome on prices. I think the bottom line from the data, just like yesterday, is it doesn't do anything to change expectations around the Fed pausing in January, holding and seeing whether they're going to be cutting in March, which the market is pricing in.
Still pricing that in. I do think, again, we thought the economy was going to pick up. We'll see if that does come through. Also, we're expecting it to pick up, but nobody's expecting it necessarily to hit, jobs. So it's kind of this funny world where we're still fixated on CapEx, corporate confidence, the tax refunds coming through. And the other piece of it is, if you wanted a broader market, you've gotten it, even though the S&P 500 is opening today basically at the October highs. Okay, so almost no net progress from right before Halloween on the S&P 500, but the majority of stocks are up. The equal weight's doubling the S&P's return year to date. And I also think there's an interesting sub-element here, which is the AI excitement has migrated to Asia. So if you just look at the Korea market, China tech, relative to the NASDAQ 100, even on a one-year basis, you see that those two have lifted off and the NASDAQ remains kind of sideways here. It's almost, the AI trade here is more defensive. Alphabet being the beneficiary is kind of like the harbor from a lot of the disruption. And then, of course, the carnage in software yesterday, and it's ongoing.
I want to talk about that, Mike, with you as well. I mean, Adobe, Salesforce, Snowflake, Workday, add in other names. What it was yesterday, somewhat unclear. Claude introduced
I think that's what it was.
Product. That was Monday. Yesterday at the open, I didn't notice this because they weren't down that much. And as the day went along, the selling worsened, and you can see it right there. We've got any number of people opining this morning on trading desks and the like in terms of what it means and the fact that there's been no uptick. We've talked about the threat of AI agents, so to speak, for quite some time. ServiceNow is another name on many of these businesses. MongoDB, there you see any number of the names that were hit yesterday. The Claude product, Cowork, apparently, you set a task, the Claude makes a plan, and steadily completes it while looping in various things, and it doesn't require, I guess, much. But I don't know, do you understand the full reason why it would threaten?
Well, I don't understand the reason why it sort of gathered steam over the course of the day, except you see tons of things being shared socially, even by the people at Anthropic saying, like, by the way, Claude wrote the new Claude agent thing. In other words, there's kind of general sense out there. And I think the other piece of context is software stocks, enterprise software stocks, have had these massive premiums specifically because they're considered to be these very, very durable subscription-based businesses for many, many years to come. So if you have to add in actual business model risk because people are going to be able to do without that product increasing in the future, I think it has a disproportionate hit today in the present value of those stocks. Interestingly, a lot of these stocks that were chronically expensive no longer look that way if the earnings are going to come through. CRM, it's got a very prosaic multiple, cheaper than Microsoft. It was always much more expensive. So I think you're seeing the adjustment the market's trying to make. The other piece of it is this market loves to trade one thing against another. So if I have certainty about Broadcom, if I think the semis, there's not enough memory, whatever it is, I'm going to trade software against it on the downside because I'm going to stay kind of neutral within tech. So that's the other dynamic that's out there right now. But no, I don't really know if it's something where you should sort of take the signal of the market and saying, okay, this is the rule now, or if it's kind of an opportunity.
Right. The idea of software writing software in and of itself is significant development, so to speak. And what that will mean, of course, we talk about the impact of AI all the time. It's yet another thing to be thinking.
And arguably, it's where it's most manifest and can accelerate the fastest. In other words, it's going to be adopted quickly. You have people looking for solutions constantly, and maybe it's even the best application of it as opposed to, replacing web search or something like that.
It does get back, sorry, Carl, to Claude's ability to penetrate to the enterprise in a very significant way, and then you come back to, well, where's OpenAI and all of this? What have they been able to do in terms of the tools they're offering? Why don't they have an ad-supported service in a full way yet? And of course, the competition with, you mentioned Alphabet earlier, with Gemini has really stolen the mark, so to speak.
I have.
There's a lot of conversation
Gemini.
that I'm certainly a part of around OpenAI.
For I am
as we
Jim.
continue to try to understand.
And I am also I.
Has looked like Netflix is at the front of the pack, but it's the tug of war between Netflix and Paramount. The latest is, according to a Bloomberg report, Netflix is considering revising its offer for Warner Brothers Discovery, possibly shifting to an all-cash offer for its studios and streaming businesses. The move is essentially designed to speed up the deal, because this is a deal that many have said could take 12 months, 18 months, or possibly a little longer to actually go through a strong political scrutiny. There's some pushback with regard to the competitive landscape.
Oh, boy.
Remove the uncertainty around shares in the stock price. Keep in mind, Netflix has been
And the
rolling
monopoly.
out ever since the talks began about this deal back in October. So under the original terms, WBD shareholders received cash and stock, more cash than stock, but a new deal would be all cash. There are some, kind of caveats around that, protection if the shares drop below a certain level. But again, moving to cash could make this offer accelerate, cleaner. The big picture takeaway here is that Netflix is clearly willing to adjust to protect its bid and possibly neutralize rivals here, Nicole.
Yeah, I'm looking at these numbers. It said how Netflix and Paramount sparked this $108 billion media war for Warner Brothers Discovery. I mean, Netflix is not taking the whole thing, so their bid is around $82.7 billion, $108 billion from Paramount Sky, but they've been rejected. Paramount's been rejected over and over again. Okay, Diane King Hall, great to see you with that. And we'll continue to follow that breaking news, and we'll look at Bitcoin. Is this what you need to diversify your portfolio? Our last guest, Jim Thorne, was talking about a bit of an uptrend for Bitcoin. We'll be right back here on Opening Bell.
Bitcoin got good news? Right back, get my water going. Oh.
From what's moving markets to what's next, with sharp takes and market know-how. Follow me on all social media platforms at Diane King Hall and connect with me on LinkedIn for more.
Hey, Bob. Hey, Andrew. Last year, my dad had a stroke. Big shock to see this person that I've always seen as a force in our family be vulnerable. Wait, had a stroke? Yes. Now we're in the car together almost daily. I started to realize, what can I pick up from my dad? He's been with Schwab for a long time.
Jim, my financial consultant. I programmed that 20 years ago.
Jim's really been there to answer any questions I ever have. It makes a huge difference when you have someone that actually cares.
Live insights, actionable data, and market-moving analysis. Schwab Network connects the headlines to the why in real time. Watch free 24/7 at schwabnetwork.com.
All right, welcome back to Open and Go. So glad you're with us. And Stephen Wedding's with us, co-founder, CIO Group. Thank you so much for being with us. We want to talk about the earnings expectations. What we saw is now folks are looking at 15% as a possibility for 2026. 13% for 25, 12% for 24. Does that sound right to you?
Well, I think it's the upper end of what's actually likely. We've been projecting 10 to 15% EPS growth, record territory this year, with more industries contributing to the gain. Last year, we had a 25% EPS for the IT sector, 50% for semiconductors. That is probably going to slow. It certainly will in the out years. But a lot of industries were really constrained in 2025. You saw a K-shaped economy. I'm sure you heard. We think that we're going to be moving out of the K. Now, we also have to remember we're already at record high profit markets. We are deep into a bull market. So there are some risks. Plenty of them we can talk about. But we think that 15%, if you're just banking on it already, that's about as good as it gets.
So when we look at what's going on with Bitcoin, we can't help but notice the momentum recently. It's having a hard time even getting to or holding 90,000. It's below that range. But look at it today at 95,000. Is Bitcoin back? Is this something that everybody should have in their portfolio for 2026 and beyond?
Well, we tell you that if you care about your core portfolio performance, you're going to want to have a lot of assets that represent the capital of the economy, because money we can't depend on. So if you can't depend on money, you can look to an alternative monetary system. That's Bitcoin. And in this case, some small amount, just in the adoption phase of this alternative monetary system. I know I'm not talking about transaction, I'm talking about the stored savings, but along with gold, this is something you do when you care about the currency in the United States, which even after the lowest drop since 2017, if you take a look at it, it's still very close to its second highest level on record in inflation-adjusted terms. Then that gets into the issues of Fed independence and these concerns. And so, yes, you use this as some sort of volatile, diversifying element in the portfolios.
So you have to have Bitcoin and gold? Gold too? Because gold's at records too. Gold's at a record today.
We reduced the size of our overweight in gold already. And people can say, well, hey, you just missed that last $100 on that portion. We still have an over.
Okay, we're back at support here. Double bottom on the SPY at open. For I'm Washboardjim, the thinking strategist behind the sneaky snake trading strategy, where I talk about chart patterns, moving averages, and being in the now. Just created a new low. Got a new low. Not holding up. Watching it close. We got a new low. Let's see if it wants to. Looking for what candles here that are bullish. Right now we got an inverted. Starting to look a little bit bullish here. $692 strikes. For today, for scalp. Ah. Okay. Let's see if we get a double bottom. Or we break out with this here candle, or this flag. We just now had our first, maybe. Oh man, shoot. 90 cents. I could have got them at 90 cents. Now they're at 108. So that was a foul up. Now we're getting back down there, 95.
if we get some buyers to step in like we are right now, we're able to close this 15-minute candle in a hammer fashion. That could actually be bullish for us to try to recoup some of these losses for today. But obviously the market is also focusing
15-minute in a hammer fashion.
It has not been released yet. If it's going to be released today, to the upside 69.85.
Oh, he went to the 15-minute. Okay.
This morning, and we did have this actual head and shoulders pattern on the 15-minute chart, which we did break down that neckline here today. So when you're kind of looking at it, we're still in a consolidation range, at least for now. We are breaking the sequence of higher highs as well as higher lows if you're looking at the 15-minute chart, but we have not really fundamentally broken down yet. And if we get below 6,900, I get a little bit concerned that we go back and start testing.
Or tweezer bottom.
Like the 20-day moving average as well as the 50-day moving average.
Okay, and look, I mean, people are looking to other things too, right? Gold and silver are
That's
higher
interesting.
at records. We talked about some of the momentum that we've been seeing in Bitcoin. You are seeing a bit of rotation here. Very interesting. So,
See, I never thought about that. So I like listening to these guys. I mean, I don't know if you all picked that up or not, but he mentioned the 15-minute candle right at open, and that if it be like a hammer or even a doji, inverted hammer, insider, this is on a 15-minute, to try to determine what kind of day are we going to have from there. See, right now would be the time to buy it. Where are we here? SPY. These are at 85 cents. Right down here, why it's down here at the bottom of that 15-minute. Now, this is going to be risky. So let's note that. I'm going to try a new strategy. You all probably heard of it. I can't believe I never thought about that. Like I said, it's risky. Risky. I'm doing fine. Oh yeah. Risky. Now I jumped in it because of the tweezer bottom, but now we're below it. Still got a good price. Oh no. We're at 80 cents. So now it closed below that candle on the 15-minute. We got 7 more to go. I thought about adding 10 more right there, but we'll just leave it like it is. $0.80. You could have got 80. Jim, will you please take off your shoes and go in there? And is your coffee fermenting? No. Trying very hard here. Where's my shoes at? Okay. 87 cents. Crowd's going wild here at the sports arena. There's your 77. Okay. Now we need to bank up. We need to bank. So far, it's still bearish. That's kind of the way yesterday was. $0.80. It got down to 77. Still holding support. And we got 4 more minutes, we'll know when this candle switches. I want to see what this candle switches to. This next one. See if I was right. Because right now it's kind of bearish. Has to stay above that first 15-minute body. Has to stay above this resistance level when it closes. I'm going to say, so I'm going to, right there. Yeah. Then I will cut off the left extension. 689.56. You can do this, Joe. You can do this. Yeah, I don't think it's going to do it. Go get my coffee and my little cushion to put on my chair. I got it sitting on a wooden chair right now. Now I'd say that it's not very comfortable. 71 cents. I think the market's told me it's not bullish. Oh, that wasn't nice. Still, and we're at another support right here, so we'll see. We're at a 1, 2, 3. plus 3 black crows. $0.56. .56. Now let's go town. They're already even, just like that. 6, 6, 6, 6, 6, 6, 6. 30 contracts. It's funny. Depreciating. Got a little pullback on AMD, and Nvidia at 181. Meta 619. Just watch Meta. Put it on your watch list. So now we got 3 black crows for the first 3 15-minute candles. First 3. So it got an inverted hammer on that second one.
.35. million for the month. Street was looking for 4.21 million, and this is actually the fourth month that we have actually seen an increase when it comes to existing home sales. So these lower interest rates when it comes to mortgages is definitely causing a lot of individuals to kind of step into this market and start to purchase homes. Not only when you're looking at new home sales, which we already have that data set, but also existing home sales as well. So this is actually a really decent sign. You are potentially maybe seeing mortgage rates kind of stalling out at these levels after the announcement last week that Fannie Mae, Freddie Mac could potentially be buying up to $200 billion worth of mortgage-backed securities, which is really trying to move mortgage rates a little bit lower. But obviously we do have some uncertainty when it comes to the Fed, geopolitical risk, and things of that nature. So overall, the housing data that we have had today is actually really strong. Even refinancing activities, we saw a massive increase on a month-over-month basis, as well as on a year-over-year basis. So these lower interest rates are definitely causing the housing market to catch a little bit of a boom here. Let's see if it's going to translate into some of these equities that are related to housing, like a D.R. Horton or even Home Depot for that matter, if it's able to sustain and catch a bid here.
Okay, and just switching gears to some of the data around business inventories. What's the read on that this morning?
For business inventories, we actually did see a glut here. It's actually increased by 0.3%. Street was looking for inventory levels to stay flat on a month-over-month basis. Now, this is going to be a situation here where this is the October data set, so we're still a little bit behind here. But this actually could be good on the inflationary front. If we do see inventory levels kind of building up a bit, we could actually see a lot of companies lower their prices in order to move that inventory out. This also could be a sign that maybe we have some slowing when it comes to consumer purchases. That's really not being reflected, especially when you're looking at the retail sales data set that we actually had this morning, which was obviously a lot stronger than the Street's expectations, both on the headline as well as the core portion of that data set here. So inventory levels, not the direction you want to see if you are somebody that's trying to sell products, but it is probably the right direction you would like to see if you are a Fed member that would like to see inflation rates actually move a little bit lower here over the next couple of months.
Okay, talk us through some of the data we got this morning as well, KG. I mean, retail sales look pretty good on the headline, 0.6% month on month. We also got the PPI to producer prices up 3% year over year, 0.2% month over month. What does
enthusiasm's kind of going away.
Reaction?
Yeah, so if you're looking at headline retail sales here, once again, we did see an increase of 0.6% on a month-over-month basis. A lot of that
we're at 61
from the energy market.
I got 66.
General, as well as maybe some sporting goods, as well as furnishing
62
sales, if you will. The control group is actually the biggest factor that I'm focusing on here, Sam. That actually increased by 0.4%. That's in line with the Street's expectations, but that also then flows into GDP. So that actually should be a positive and should re-rate gross domestic product expectations or estimates a little bit higher here. We will get an update from the Atlanta Fed GDP now forecast to the upside here. When you're looking at producer price indexes, this is a very volatile print, so we have to be mindful of that. We did see final demand prices rise about 0.2% on a month-over-month basis. We are seeing some pressures when it comes to the goods side of the equation. Final demand goods actually increased by 0.9% on a month-over-month basis. Final demand for services was actually flat on a month-over-month basis. Now, a lot of that was, once again, gasoline prices moving to the upside aggressively, as well as utility prices. So what you do not want to see if you are a Fed member is good prices starting to re-accelerate, and that's actually the theme that we saw yesterday in the CPI print, especially when you're looking at food, because goods inflation usually leads to services inflation over time as individuals like employees and things of that nature demand for higher wages. So I would say overall the data has been, for the most part, actually relatively good. I think the hangover right now that we have right now is the SCOTUS decision, and I'm not seeing the tariff decision actually being released. We have one that was released at the top of the hour. I'm not seeing the tariff decision actually being released today. Maybe that takes a little bit of pressure off when it comes to volatility.
Yeah, still keeping an eye on that. The Supreme Court, no doubt, keeping us on the edge of our seats here this morning. Obviously,
that's today.
Market reaction to this.
That could be a big reason.
Particularly if it's not in favor of Trump. You've talked about the potential for the unwind in the metal space as well. Let's switch
or is it today?
As we await this decision.
The vote.
And this update here
the
now.
decision.
Obviously, we've talked about Tim. An interesting move there with respect to the
might be in winter trade here.
Thoughts on that, but also the oil market.
May just get a big old pop.
As we wait with respect to what is happening in Iran. Actually, I've just seen some breaking news within the last few minutes of the US pulling out some personnel from the airbase in Qatar as a precautionary measure. Now, I don't know if that's lining up for a potential move at all, but it's certainly something to look at. What do you make of the commodities patch this morning, KG?
Yeah, you know, when you're looking at 10, I read on the chart for this, but there's actually a squeeze that's happening in the China market. So a lot of those other metals, if you're looking at lithium or if you're looking at 10 or even steel for that matter, they are catching bids pretty much across the board in China, and that's really fueling the LME prices moving higher as well as the U.S. prices. So that's really what's happening with the metals. For crude oil, if you're actually looking at it from a technical standpoint on the weekly chart, we are starting to see some bullish indicators here with that MACD at the bottom with that 12 EMA crossing above that 26 EMA. That's a bull cross here. We actually are above the 20-week moving average. The 50-week moving average is going to be a very key area of resistance for crude oil. But as you talked about, the U.S. potentially moving some U.S. Personnel out of Qatar bases, if you will, could be in preparation for a potential strike, or it could be a defensive measure. We never know. At the end of the day, you usually do see some of these maneuvers when we start a particular military action, as well as trying to remove individuals from Iran. And there have been announcements from the State Department in order to get Americans out of Iran as soon as possible. So the market's pricing that in as of right now. We also had some updates when it comes to forecast moving forward for global demand for oil products in 2026 as well as from 2027. But this is really being traded off of geopolitical risk at the moment.
Okay, good stuff. Looking at the oil patch today, and we do have, of course, some of those oil companies up to date, tracking those prices higher as well. So it is a nice day for them in what is otherwise a down market today. Thanks so much for the insight, KG, and getting us across some of those data prints this morning. What's moving in the metal space as well. Coming up, we will examine the health of the current market and the most recent sector flow data with John.
Oh, there it goes.
From Asprey Research. Morning Trade Line. We'll be back after this.
Randy.
I'm Nicole Pedalides at the New York Stock Exchange. Live
we didn't move
interviews,
much.
market movers, and
Fuck.
real-time coverage right from the floor.
There we
Subscribe
go.
now at SchwabNetwork.com.
70. Oh, 76. Now, what's the deal?
What's up, Carl Nation? It's your
We're at the VWAP.
with the best full-service wealth.
Washboardjim just made one of his outstanding calls that he makes every day. Prime an AI robot programmed to receive. We're going to interview Washboardjim and ask him about this trade right here. Jim, may we bother you for a second? Yes, but you got to understand that I'm in the middle of a trade right here, and I'm getting ready to sell it. What is the reason? Because we're at the VWAPs, you idiot. We're at the VWAPs. Now this thing was at 76 cents. So I have 30 contracts, these suckers. Oh, get ready. Randy, 76 cents. Oh, 77. Can it hit the 200 SMA? That's the question. So as I was telling you, we're at 79 cents. So I would suggest anybody in their right mind to make a business decision. I don't know how he does it, but he about made a mistake. 73 cents. See, as you start to approach that 200, you gotta make a business decision. Now here's 77 cents. This thing could run up to $1 and break. here it is. Ladies and gentlemen, we're at 85 cents. We're at 81.2. I would make a business decision. We just hit the 200 SMA. Why does it? It's good. I've never seen anything like it. They never seen anything like it. Never say never. Thank you very much, Mark. For I am Washboardjim, the founder of the Sneaky Snake Trading Strategy, where I talk about chart patterns, moving averages, and cleavage.
One of the things you don't like. Obviously, we've seen this degree of rotation, though, out of some of the manufacturing and out of some of the sort of high-flying tech sectors into other parts of the market, sort of these so-called AI-adjacent type backdoor trades, you know, that it's going to benefit from a lot of the data
Well,
center
got that
build
good
out,
trade out of the
thinking
way.
Industrials, thinking materials, thinking utilities, the stuff that's actually going to power all of this stuff. I mean, what are you seeing as far as that is concerned from a sector rotation perspective?
Our sector rotation model, it's called our CEF model. We have a graphic of that. What we did was, years ago, we came up with an algorithm that measures the velocity of money. As
Rob's already at 100%. You son of a gun.
The S&P 500. We do it in 3 different time frames, as you can see: trading and tactical and strategic. We come up with a composite score. The lower score is the better score, like golf. Right now, we're looking at healthcare is number 1. Now, that jumped into a number 1 spot just last week. It's a big flush of money that went into healthcare. Whether it's defensive or some other catalyst, the data doesn't tell us why. It just shows us where the money's going. Now, the industrials, we've been overweight the industrials. That's been the sticky one. We've been overweight industrials since I think it's been December the 1st, and we've caught, I think, 9% outright and 7% of relative outperformance versus the S&P. So even though that's number 2 this week, that's been the sticky one where the money has gone into and has stayed there. Third is the financial sector, and the money has been kind of rocking in and out of there for maybe 6 or 8 weeks.
Shut up. Now, Washboardjim got in this snake, traded it, called it out, talked about the 3 black crows and the hammer, 15-minute time frame, and then we had a discussion of the 200 SMA on the 1 minute, and we had a discussion at the VWAP. So I'm going to ask you a question. Prepare ye. Are you ready? So to make this stock healthy, I have a frog in my throat. To make this stock healthy right now, what does it need to do? Consolidate and hold above the VWAP. Dip below the VWAP, or none of the above. There's Magnificent today. Nobody knows the answer? Come on. Come on. I've never seen anything like it in my life. And I was telling Julia the other day, I said, man, this room. Okay, we're at the VWAP. In the name of the Lord, amen. So we are now at the VWAP. So what do we got to do to stay bullish? A, hold the VWAP and consolidate. For you, James Howard, you got the winning answer. You'll get a $50 gift certificate to the local diner of your choice. I'll be right back.
I'm Diane King Hall on the floor of the New York
Blackout.
Stock Exchange. When markets react, we are live with analysis that matters. Watch now, only on SchwabNetwork.com.
So when I jump in it here, I'm not in nothing. So Jim, would you jump in the trade here? And I would say, well, I have two possibilities. I'd buy it for about 2 or 3 cents scalp, maybe 5 cents. And if it broke the 200, I'd be happy, knowing that it would break out and pull back and hit the 200. So they were at 55 cents, now they're at 58, 59. So 20 contracts for 1,000. Would give you $80. Does anybody see the pattern? Gee, I miss Grandma Savage. I'm Savage. I was listening to your YouTube channel, and you said that pattern showed up, and he's talking about that megaphone pattern. I know that's what he's talking about. Oh, there it is right there. If I was to take it, I'd take it here. Hope for a good scalp. If but I need to get I really would. 46. Now it's broke support. They got 689.56 coming off of the 15-minute. Crowd's going wild here at sports arena today. Oh, look at that. Oh, I didn't think about going to the 15-minute, looking at it. It hit the 9. So that was quite interesting. Tweezer bottom, and there's that hammer he was talking about. Tweezer bottom with that hammer. So if you get above that hammer, I'd buy it and run it up. Or if it come down to a triple bottom on the 15-minute. Ook. More drama. Okay, now I'm getting out of the spies, and I won't be trading them for the rest unless I go into tomorrow. I'm out of the spies, so the 15th. Okay, here comes the triple bottom on the 15 minute. So this is what we're going to see what happens here on this setup right here. So that's the 15 minute. And that price, I'm going to put that price line on here. Right there. 71. Now we got this got to hold right here. Prepare ye in the name of the Lord. And we're looking at the 692s for the 15th. At 94. Can't believe it's already the 15th. Now they're at 90. We don't want that. We're at double bottom. We're at 94. 692s for tomorrow. 94 cents, yay. Beneath Buffy Light. Auto. It's not an auto. How dare you? How dare you embarrass me like that, you sucker. Could buy 10 more at 90. But we'll wait. They're at 89 cents. Uh-oh.
Alternatives amid this rising trade and diplomatic tensions with the U.S. Now, some of the affected companies listed in the Reuters report include Broadcom's owned VMware. We are seeing Broadcom lower today. They're trading down almost 4% right now. Palo Alto Networks, they were lower when this report came out, have since moved slightly to the upside. And Fortinet also down about 3% too. As far as Israeli companies, Checkpoint Software is also on the list. Now, sources for Reuters is using say Chinese regulators are worried that the software could collect and transmit sensitive information abroad.
Breakout,
it remains unclear
pullback,
how
double
many
bottom.
Chinese companies got this notice, although it is noted it was received in recent days. There's been no commentary from Chinese officials, nor from any of the companies that are reportedly involved. But the move does come as Washington and Beijing are, in this uneasy trade truce and possibly preparing for a visit from President Trump to China later this year. Now, even before Trump's return to office, we did see the politics surrounding foreign cybersecurity vendors become increasingly sensitive. Chinese analysts warning that Western technology could make China vulnerable to foreign surveillance or hacking. Also, several of these companies that they're blocking have made allegations against China, saying that they have hacked them as well. Checkpoint put out a report saying that Chinese like hacking operations on an unidentified European government office. And in September, Palo Alto published a similar report alleging a Chinese hacking effort targeting diplomats worldwide. China denied both of those reports, but it has been a lot of back and forth here. But this is just the latest, and of course, no confirmation from the government or any of these companies, Sam.
Yeah, I mean, you've got to sort of read the tea leaves a bit with this story, haven't you? From my understanding, while Reuters has talked about how they've built a significant footprint in China over the years, my understanding is that the exposure is fairly small, and so maybe that speaks to some of the reaction we've seen, but no doubt it doesn't bode well, as you say, to some of the, two-way trade. diplomatic relations and meetings that are expected to come up, especially for technology as far as that relationship is concerned. Hey, thanks so much, Marley, for breaking down the details of this story and some of the reaction we're seeing. Let's trade it now with Scott Bauer, CEO of Prosper Trading Academy. We're focused on Palo Alto as one of those which has been targeted this morning. How are you approaching your example trade for this one this morning, Scott?
Sure, I actually love Palo Alto. I think it's best in class in this sector. But it is a bit stuck here, and besides the news coming out of China, there is a little bit of resistance right overhead. So that being said, I am longer term bullish though. So what I'm doing is what's called a poor man's covered call strategy. So I'm going to sell the February expiration.
PANW.
The 210 strike call up above, and I'm going to buy further out April expiration 190 strike call. I can do that for about $12 or about $1,200 per.
Still in the SPY.
The reason it's called a poor man's covered call is because usually in a covered call, you would own the stock and then sell upside calls against this. This is owning a further in the money or further lower strike call rather than owning the stock. So I think, the next week, several weeks, could be a little bit tenuous, but I do like Palo Alto moving forward.
Okay, looking at Palo Alto this morning, it's trading at 190 and change right now, only down fractionally, despite the China headline risk, as I mentioned. But I mean, we've been looking across the software space, and they've been really under pressure. I mean, we've continued to see this sell-off accelerating in that space as well. But, cybersecurity names have been the big favourites, obviously, given the environment we're in with all this AI demand. What are your thoughts on the overall market performance today? Obviously, a bit of a pullback on the headline. We've got some pockets of strength here. We continue to see sort of this some selective strength and this rotation playing out. What do you think of it?
I think it's a confusing market. The CPI numbers yesterday, coming in pretty good. PPI today much hotter than expected. So on the economic front, I think that's a difficult one for the market to understand. And then you look at the bank earnings here. Typically, we look at the bank earnings, which kick off earnings season, as kind of the precursor to what may happen. And kind of across the board here, we're seeing those lower. So I think there's definitely some concern. The fact that the Supreme Court came out and said, no, we're not going to get that decision today. We kind of saw a temporary kind of pop in the market off of that. Now we're back down pretty much to the day's lows. So I think there's just so much headline risk at this point coming from all angles that it pays to be cautious.
Where obviously we've seen this sort of vacillating in the stock market. I mean, in the bond market as well, we're just stuck in this range as we've been talking about too. But as you mentioned, I mean, look, Scott, if you're confused, I'm confused, because I think maybe what they're getting at with the PPI is that if we do see a hotter print there on the wholesale prices, whether we see that feeding into a CPI print, which actually looked okay yesterday. So we'll have to wait and see. It's about the trend, isn't it? But really appreciate your thoughts as always. We'll catch you next time. That's Scott Bauer, CEO of Prosper Trading Academy. Coming up, we'll take a closer look at what investors should be watching in overseas markets, including the impact of a potential snap election in Japan and what that could mean for the yen. Morning Trade Live, we'll be right back.
Morning movers, be the first to find out what's shaping early market action. Tech Check, Options Corner, Futures Focus, Technical Analysis. Morning Movers covers it all.
Grab your coffee and tune in every trading day at 8 a.m. Eastern, only on Schwab Network. Stay connected to what moves the markets. Download the Schwab Network app and stream anytime wherever you are. Live from Chicago, this is Trading 360. I'm Marley Caden. We track macro forces, market trends, and company news that shape investor decisions, all with expert analysis and actionable context. From inflation data to sector rotation.
Bouncing off the double bottom, yay!
It's a comprehensive view of the market every trading day.
Go!
Trading 360, in-depth market coverage straight from Chicago.
You know who I
Weekdays
am.
at 11 a.m. Eastern on Schwab Network.
I need a breakout.
Welcome back to Morning Trade Live. I'm Sam Barnes.
Not a fake out.
Joining us now, very pleased to
Let's
say,
go.
is AJ Kaling, Director of International Trading at Charles Schwab. But very good morning to you, AJ. So nice to see you. So it's all happening in international markets to kick off the year, particularly over in Japan. Talk to us about the Takaichi trade. I mean, obviously characterized by a weaker yen. That's good for equities, particularly in a sort of exporter-exposed type market. Just give us the details and what you're seeing as far as the performance is concerned over there.
Yeah, good morning, Sam. It's interesting, just a couple months ago, I feel like we were talking about the risk in Japan due to the strife between Japan and China. But as the saying goes, you can't keep a good market down, and you know, the Nikkei ended up about 25% last year. But the real story is 2026. It's up, including last night's performance, about 8% year to date. A lot of that is, like you said, on the back of this so-called Takaichi trade, where a lot of market participants are expecting her to dissolve Parliament and call snap elections within the matter of a couple of weeks now. The reason why this matters is that people are expecting that this will have a yen negative impact plus a equity positive impact. You got to keep in mind she's only been approved by Parliament to be the prime minister, but has never really faced voters yet. So she's looking to capitalize on some of the political strength that she has right now. And what that ultimately means is that that could pull forward some of that fiscal spending that was already planned for 2026. And you might see that, again, have impacts into the equity markets. When we talk about the yen trade, it's been trading in that range of the 140 to 160 level, getting down to about 159 overnight. This is the range that it has been trading in for a couple of years now. There's talk about some finance ministers, intervening to keep it from depreciating anymore. But I think what market participants are looking at is that weaker yen might been baked in to future earnings growth. So obviously, I don't think I have to explain to you or any of your viewers that a weaker yen is positive for exporters. And what is Japan? Is a net export country. So you look at industries like automotive, machinery, electronics, things like that, and you might expect to see when these companies bring over their revenue back, repatriate it to Japan, it just translates to more yen. So now, of course, an investment strategy shouldn't be based purely on currency. You should also look at market trends as well. But this should provide some tailwinds in Japan.
Yeah, obviously traders are on intervention watch, as you mentioned, checking out to see if there's going to be any sort of jawboning coming from the officials. But it begs the question what that means for the BOJ as well. I mean, obviously we saw that hike and we saw the yen heading in the opposite direction to what it should do. But that's been interesting. But I just want to sort of stick with the sort of Asia, the broad theme there. I mean, you mentioned it's a very heavy export market, but some of the bull case for technology has actually shifted to Asia. I mean, if you take a look at the Japanese markets, which obviously are in some of the chip business, I mean, the South Korean Kospi is on fire. We've also had these massive IPOs over in the Chinese market. I mean, rallying 400, 700%. We've had a nice start to the Hong Kong market IPO pipeline as well. All on this idea that obviously we're going to see, domestic alternatives and, Asia being part of the story. Have you got any thoughts on that?
Yeah, listen, I think this comes to a story about diversification, not just for the local industries within Asia, but you think about the U.S. investor. The U.S. market, you might say, is a bit frothy at this point, especially considering a lot of the AI boom that we've seen, the mega deals that have come down. And the U.S. investor is looking overseas to see what opportunity lies elsewhere. And with the the tariffs that have been in place, I know that's the big story right now about the NVIDIA chips. there is local talent and local companies that
Damn.
know what they're doing, of course, and can compete on that international scale here. So you're starting to see that play out, like you said, in the Kospi in South Korea, Hong Kong, and mainland China as well. So I think there's definitely investment opportunity if you dig deep enough and are
78.
willing to stomach some of that geopolitical, cross-border tariff risk.
Yeah, absolutely. And you mentioned trade. Obviously, we've got China running a $1.2 trillion trade surplus with the rest of the world. The export numbers looking very good overnight as well. Let's switch our attention to LATAM, Latin American equity markets. I mean, obviously, off the back of the developments we've seen out of Venezuela here, what are the opportunities? Because prior to that event and that development, everyone was very bullish on Latin America. Does this build the case for that?
Yeah, listen, you're right. There is some, when we talk about geopolitical strife, there's obviously, I know Iran's in the news today, but Venezuela is still, of course, top of mind. Still outside of that, on the whole, I think our investors are looking at Latin America for a strong investment, opportunity for a couple of reasons. We just talked about currency. The U.S. dollar is also
Apple new
quite
low.
weak, trading at very, very low levels historically right now. Of course, a weak U.S. dollar has traditionally been bullish for emerging market economies. Another reason is for commodity prices, high commodity prices, specifically industrials and precious metals. So you look at the region, Brazil, of course, being the biggest market there, had an outstanding 2025, I think up around 35%, putting it close to the Hang Seng in Hong Kong is one of the best performers of 2025. So I think the risk there is that did you miss the trade? So far, our investors are still focused on that, for a couple of reasons. We just talked about the commodities. China is still buying soybeans, and Brazil is selling them those soybeans. So there's that play there. In addition, there's been a lot of foreign direct investment that has started increasing due to a pro-business shift. One other country in the region, if I may, with potential investment opportunity could be Argentina, which enters 2026 after 2 years of economic contraction. So well within that recession area there. But there's a couple of things to point out with Argentina. Inflation has started to slow and consumption has begun to pick up. So our investors are trying to find those pockets of opportunity within Latin America. I think you still have to worry about sticky inflation, broadly speaking, within Latin space. Also, the tariff risk is also something that need to keep top of mind. But there's definitely those opportunities out there. So reasons to be cautiously optimistic.
Cautiously.
Okay, I'm looking at Argentina and looking for a rebound. Really appreciate the global lens as always, AJ. Appreciate your time. That is AJ Kaling, there, Director of International Trading at Charles Schwab. Coming up, it's time for Inside Out. We'll take a closer look at Amazon and bring you an example trade when Morning Trade Live returns.
Well, triple bottom didn't hold, nor did the double bottom. Triple bottom on these here three candles.
Investors, the market moves. And Schwab is here to help you move with it. So,
they got
whether
3
you're
more
buying,
crows.
selling, holding, or planning, whether you're ETFing or 401k'ing, saving, spending,
I might have to do the same thing I did that last one.
you can count on Schwab for market insights, live support, powerful trading platforms, and 400 branches. All at your service, all so you can invest your way. Sounds nice, right?
I'm Alex Coffey.
And I'm Jenny Horn. This is Next Gen Investing,
Jenny
where we
Horn.
track the trends shaping tomorrow's market.
From tech to energy, crypto to consumer, we focus on what's driving investor sentiment right now.
Clear analysis and forward-looking market coverage every trading day.
This is a make or break level for this stock.
That could certainly be a short to near-term catalyst.
Next Gen Investing, 1 p.m. Eastern.
Only on Schwab Network.
Let's go inside out on Amazon. Joining us now is Matthew Tuttle, CEO and CIO at Tuttle Capital Management. Thanks so much for joining us this morning, Matthew. So you write that Amazon isn't a retail stock, just like it wasn't a bookseller in the 90s. Talk us through that.
Yeah, I mean, the biggest investing mistake I ever made in my life was in the mid to late 90s. I looked at Amazon as a bookseller. And I think you've got some people making a similar mistake now. Yeah, I mean, it's a massive retailer. You can sit on your couch, order anything, have it here tomorrow. But what it really is it's a cloud and an advertising cash machine. And they have the world's largest logistical network. And we think this year you're going to see a shift in the AI trade, and cloud is going to be extremely important. So we're big believers in Amazon right here.
Okay, I mean, you don't have to look much further than my lobby at my condo to see, obviously people are still spending. The retail business is going strong. At your porch, very good. But as you say, look, AWS, people like that part of the business. With respect to the conversation about whether it's overvalued, I mean, you don't believe that. So talk us through why.
Yeah, so a lot of talk coming into this year about the entire Mag 7. People saying it's overvalued. They're looking at the other 493 stocks. We think overvalued is in the major themes that we're looking at
61.
this year, next year, the year after. The big winners are still the Mag 7. We just launched Mag 7 ETF, and we did that because we think, there's still real upside left in these names. And, and of them, Amazon is one of our favorites.
Okay. When we talk about Amazon, particularly ahead of earnings, everyone always says it's all going to be about AWS. So how do you view this part of the business right now? Particularly what's going on in this space. I mean, particularly when we talk about what is going on with software as a whole right now.
Well, yeah, and they're right from the standpoint it's all going to be about AWS. I mean, that's the most important thing. What makes us really bullish on the stock is the backlog. I mean, it's like $200 billion in backlog. People are worried about CapEx spending. Is it going to stop? These guys are sitting on a backlog. I think, an area that maybe investors aren't paying attention to is their ad revenue. I mean, it was like 17 billion last quarter. That obviously doesn't compare to AWS, but that's the icing on the cake. And again, we think you're going to see a shift where the AI trading is broadening out. People are looking towards monetization, and we think cloud is a big part of that. So yeah, we'll be focused on AWS, but I think those numbers are going to look real nice.
Yeah, I see that you've written also that that's a major media company hiding inside, so it's like it's in disguise somewhat. What about these partnerships? I mean, when you talk about things like OpenAI planning to spend $38 billion over the next 7 years, how confident are you around that? Do we need to see more partnerships? Do you anticipate we continue to do that throughout 2026, is to see, everyone sort of partnering up with each other?
I do. I think you're going to see more. I love the OpenAI partnership. Obviously people have brought up concerns about some of this circular dealing. We're not oblivious to that. But, until we see something that's concerning, we're still buyers. But yeah, we do think you're going to see more and more of this partnering up. This is such a big area. Everything around AI, and we're still in the early innings of what all of this can do.
I mean, that's been the narrative. You can't beat them, join them. We're seeing that across the tech landscape. But we are trading down along with the broader Mag 7 today, down around 2%. I really appreciate your insights, Matthew, as always. Matthew Tuttle there, CEO and CIO at Tuttle Capital Management. Let's trade this now with Tom White, host of Fast
What
Market.
supports do I have?
Tom. So Amazon, as we said,
Right now I'm trading trying to get out of this trade.
Market sort of sentiment here, but talk us through an example trade. What approach are you
We're at
taking here?
66.
Yeah, this is, had a pretty good start to 2026. It's up about 3% so far this year. It has pulled back a little bit here today and a little bit yesterday, but a lot of people think this is, just like your guest said, this is going to be a top pick going into next year. You look at what they do, 20% growth on the cloud side, that's reaccelerating. The over $50 billion in ad revenue they've got. So a bunch of different levers to pull here. So if you think it's going to, continue to move higher, this is a strategy to take advantage of that while offsetting some of the costs on a bullish trade here. So I went out to the March 20th monthly cycle. So just over 2 months until expiration, giving myself some duration for this trade to develop here. And implied volatility levels are still relatively low in this name as stocks are just off of their all-time highs. So March 20th monthly options, we're going to buy the 240 strike call just out of the money to the upside. And then against that, about what the option market's pricing in, about $30 into that expiry, sell the 270 strike call. So about a $30 wide bullish call vertical here. You're going to pay roughly, I've got a 1050 debit on it. That's where it was trading earlier. The stock has pulled back even more. Probably get it for $950 now. But the debit you pay is going to be your risk. So your risk can basically 1 to make an additional 2 if the stock gets to all-time highs above $270 over the next 65 days. The break even on it, if you pay $10.50 or just over $10 on this, it's going to be just over $250. It's about 5.5% above the current share price in Amazon. So you don't need a monster move. You've given yourself 2 months duration in this particular position. And I think one of the keys as far as trade management goes, you don't have to wait until March expiration to get out of this. If you get the move post earnings or something along those lines, you can start to parse down your position or maybe close it ahead of expiration. So buying a directional vertical like this gives you a little bit of flexibility as far as trade management goes. But this is setting up with what your guest commented on if you think the stock's going to rally over the next 2 months.
Okay, we'll be watching those earnings. We are slated in for a circle on the calendar, February 5th. Thanks so much for that, Tom White. As always, an example trade for us on Amazon today. Let's just quickly check in these markets because we are under pressure today. We've had no decision out from SCOTUS on tariffs. We've got a slightly hotter than expected PPI. Retail sales coming in pretty okay here, and this is the picture for you. Tech is under pressure this morning. Thanks for joining us here on Morning Trade Live. I'm Sam Vardas. Download the Schwab Network app, available in the Apple App Store. Tune in 24/7 on schwabnetwork.com. We've got Trading 360 with Marley Caden coming up next. I'll catch you later.
Schwab Bank Investor Checking, the checking account built for investors, named highest in client satisfaction by J.D. Power for 7 years in a row. With
Actually,
Investor
this is
Checking,
higher.
you get the award-winning features of our checking account, plus
I gotta move
cash
that.
management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money
Actually, it's
safe.
a little bit higher,
Also,
that first
because your
support.
investor checking account
We hit
is
it, I
linked to
think,
your
right
Schwab
on.
One brokerage account, you can manage your checking and investing in
Right
one
at-
convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in
Right
seconds.
there.
That means you can
6
stop
8
waiting and start
8 8
investing in
5
stocks,
7.
bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com.
Mom, when my grandparents moved here, did they know what our family would become?
I don't even know if they could envision it, to leave everything behind, literally come across the entire world. I think that we totally met what their wishes were. Schwab has been with us for almost 25 years through purchasing
25 years?
of our business, having children. They've always been.
You look so
I
young.
want to invest with a company that can help me give my family a happy financial future.
Fuck, you have a nice house.
Stay connected to what moves markets. Download the Schwab
Nvidia.
Network app and get live coverage wherever you are.
I want some advice. Marry a nurse. Marry a woman that will work. Uh-oh. The ladies just heard one of my life secrets. Yes, it's true. I've never dated a girl that never worked. I'm guilty. For I'm a chauvinist. And a misogynist. And first thing I ask you, we're on our first date, and we're sitting across there eating dinner, and I said, okay, it's going to come down to this. And she looks at me like, what? I said, you understand if we go out, whatever is yours is mine, and whatever is mine is mine. Do you understand?
Let's take a look at how the...
She sat there and shake her head. What'd you just say? I said, whatever is yours is mine, and whatever is mine is mine.
48. The Dow has given up 252 points this morning, 48,939, and the Russell 2000 just slightly down on the day at 2630. As for the 10-year, we're down to 415, but still trading in that same range we've been seeing. The dollar also slightly lower at 98.72. For gold, which we'll be talking about shortly, we are up to 46.2530 a troy ounce. That's more than 0.5% higher today. Crude oil also higher, close to 1%, 61.70 a barrel. And Bitcoin moving higher, getting closer to that $100,000 threshold. Can it do it today? Up 2.5% already.
Good job, Marley.
7,160. I do want to welcome in our first guest, though, joining us, Alex Coffey, co-host of Next Gen Investing, to talk about a stock we're seeing on the move today.
Alex Coffey.
After a downgrade, we are seeing Rivian move sharply to the downside.
Who else had a downgrade yesterday? AMD did.
Alex, you know, what's the latest on this note?
Yeah, as you mentioned, steep selling pressure today in Rivian shares on the heels of a downgrade from UBS. Joseph Spack over at UBS downgrading to sell from hold this morning, but boosting the price target to 15 from 13. So sort of a catch-up update from UBS. But some of the reasons cited are elevated expectations and less favorable risk reward. Well, if this sounds familiar, well, maybe it should, because just on Monday, Marley, we had a Wolf Research analyst by the name of Emmanuel Rosner do something similar, downgraded Rivian to underperform from peer perform back on Monday, and some of the reasons cited were challenging risk reward at current levels and potential downside risk to 2026 estimates. Speaking of those performance metrics,
Rivian downgraded.
Rivian recently recalled almost 20,000 vehicles last week over a faulty toe link bolt, and that, of course, increased potential crash risk. And then also in 2025, they did produce 42,280, but delivered just under 10,000 vehicles in Q4 of 2025, which was below estimates and marked a decline from the near 15,000 or just over 14,000 vehicles delivered in that same quarter a year ago, which does, I think, stress some of those demand concerns for EV makers like Rivian. Also, last thing, they recently appointed Greg.
Sorry about that. Alex had a little bit too much coffee this morning. So I'm in the spies right now. For my name is Washboardjim. We did break below the triple bottom here and have a what you call a J hook. It's reaching out its arm right now on the SPY. We're having tornado siren alert outside, please. Be patient. Can you hear him? Actually, I can hear the wind. Okay, well, that's that. We need some action. Things are kind of going slow right now, and I don't like it. It says it's finished. Oh, it does, don't it? The TTM. I just got a message on my telephone. I have to go check. So I'm a busy man. I'm going to ask anybody out there listening right now, if I raise 4 laying hens, would that be enough chickens to give me eggs for a single male? To have 2 eggs every morning? Or would I need more than 4 laying hens? Randy says buy eggs. Yesterday, trading stocks was like fishing. Today, trading stocks will be like raising chickens. So I'll give you the comparisons in raising chickens and trading stocks. So make sure you have your pencil and paper, and this will be broadcasted after lunch. Anybody interested in that seminar, please say yes. Jay. Well, let's say raising chickens and wanting to have chickens to lay eggs and trading stocks, you need to have the right criteria. You need to have the right tools. For example, you need a coop, something that will keep the varmints away from the eggs and from the chickens, where they can be comfortable and relax. Same thing as trading stocks. You need moving averages, chart patterns, and being a hypocrite. So you got to have your chart patterns. Raising chickens and trading stocks, you want to know what kind of your surroundings are, what kind of varmints, what kind of people are out there, or just talk smack, or same thing with the raising the chickens. You want to keep the coyotes and the possums and what you have, whatnots, out of your nest, because that creates stress. Okay. And number 3. Here comes the rooster. The rooster, the hens need the rooster, as the rooster will feed them properly and keep them in line, smack them around every once in a while. Same thing with stocks. You have the mentor, Washboardjim, with the sneaky snake trading strategy, where he talks about chart patterns, moving averages, and being in the now. That has to keep you in line every once in a while, you know, slap you around a little bit. Woo! A plus. You know, he does make a lot of sense. Dadgum wind out there. I wonder if we had a tornado. I can actually feel it coming in here. Draft. I don't know if that's necessary, please. Well, we're not going nowhere yet. We're still here. I'm at my position. I'm even Steven at 72 right now. And we have 30 contracts. I have 30. I would like to see this break out here. Let her sell at a break-even point. Big banks benefit from AI second act, jitters over Iran and Supreme Court, short squeeze in silver. Okay, well, I was just getting ready. We're lacking a little bit of cleavage here, but Marley pulls with another win. Okay, Marley, let's pump this market up. I need about 90 cents to $1, maybe $1.50. Today is the 14th July. Can you tell me the next government holiday? I bet you can. Please, give it a try. I'm talking about a government holiday. We need to break, baby. Can anybody tell me the next government holiday, please?
From the most iconic trading floor in the world, this is Opening Bell with Nicole Petalides, live on the floor of the New York Stock Exchange. The countdown, the setups, the stories that make markets move. Minute-by-minute breakdown of the biggest headlines, earnings, and global movers.
Class participation rate is at a very low rate here lately.
React in real time. Opening Bell, live at the NYSE, right when it counts.
Believe me, when it comes to investing, you'll love Carl's Way. Take a left here, please.
But there's a...
Carl's Way is the best way.
Is it?
Yes, it is.
Schwab, how I choose to invest is up to
Check.
Exactly. I can invest and trade on my own.
Yes, and I let them manage some investments for me too.
Let's move on, shall we?
No can do.
I'll get out here.
Okay.
Where are you going?
Schwab.
Let me see if anybody on YouTube could give me the answer.
Welcome back to Trading 360. I'm Marley Caden. It's time for the big three. We've got 3 stocks, 3
It's
charts,
wind.
and 3 trades. Kevin Green is joining us to take us through the charts and here to take us through the.
Today's trivia question is brought to you with Washboardjim and the thinking strategists behind the sneaky snake trade strategy. What? Question. What is the next government holiday? This is open for both YouTube and the room. But understand, the room has a very low IQ, so YouTube, you have a big chance of winning this.
VVIX, the VVIX, which is the volatility of the VIX, cracked all the way into the 110 region, indication that professional traders reaching for hedges left and right. So maybe a little duck and cover.
JYH wins.
All right, so then let's kick off the big three. You're starting with a name that's had a really standout start to this year. We're talking about
You're right.
Costco here. Is that part of the reason why it's in the big three today?
Absolutely, and I can't wait to short an underlying that has had a 10%. That's right, 10% move up on a year-to-date basis, predicated on what? Look, I saw same-store sales. I saw some of the holiday sales.
Martin Luther
This
King
to me
Day.
is nothing more than kind of a cyclical rotation. Right now, what are we not doing? Well, we're not really buying much of AI. Outside of Google, we're not really buying anything like AI related. All we're doing right now is just rotating. We're buying
We are
anything
not.
that hasn't been bought, last year, and
You
also
are,
happens
maybe.
to fall into that particular category. But again, a 10% rally. Of course, I'm calling it into question.
Oh God. Lord help me. For I might have to leave and go get lunch. And I do need to do something else. Probably need to do it right now and get it out of the way. And I need to do 2 things. Jeez. Let's see. Good. Oh. Huh. Oh, it might be right here. Yeah, there it is. Okay. Oh, I need to have this in my insurance. Auto insurance, I need to pay that. Today. Okay, we're back to even. We need a breakout.
970.
73.
And then beyond
We got
that,
an ascending triangle set up
1,000
out of the snake.
Here's another
Very
reason why
bullish.
I would be a little bit more bullish than bear.
Do you hear me? Randy, we have an ascending triangle breakout set up for the bottom of the snake. Are you serious? Serious. I've never been so more serious in my life than I am right now. Let's go ahead and keep the yellow. Yeah, let's make that, no, yeah, we'll make that yellow. Okay. So that's called an ascending triangle. And that's bullish. So we're at the 63, and that's your next, I mean, about $20 a contract. Not $20 a contract, but $4 a contract, $2 a contract. No, $6. So now we broke the 63. So that ascending triangle is very bullish. When you see something like that starting to set up, you have a lot more, it builds a lot of confidence. So this was a double bottom bounce, and it created a head and shoulders. There's your left shoulder, your head, and your right shoulder. And then it came down, broke out, created an ascending triangle, which is a reversal to the upside. So your pivot points, these two tops right here, this shoulder line, somewhere in this area right in here. Maybe even right before it. Oh, that megaphone. Yeah, it could be that first one. We already have that line at. Okay, right about now. See 83? There you go. What? How does he do it? How does he do it? How does he do it? You know what I just realized? I think I threw my dobro away. Not my dobro, but my, it's other thing I got that I played. Okay, we're at 93 cents. We're at the VWAP. Spy at the VWAP. What do? Spy at VWAP. What do? Oh, I'm getting ready to have a heart attack. You're ready to have a heart attack. What do you do when you're running? Unbelievable, Jim. So I'm going to ask the next question I'll be asking, and that goes for YouTube too. How many of you looked up the ascending triangle after Bobo showed the pattern? He already knew about it. Well, that don't matter. This is Mr. Rogers today. Spider up through the double bottom, rolled up into a snake, created an descending triangle for a trade that we all can take. Well, I called up the ascending triangle and I said we might go to the VWAP. VWAP. Well, we coiled out the snake, created an ascending triangle, broke the 63, and hit the VWAP. VWAP. Whoa! Another rock and roll #1 hit by Washboardjim. See this here line right here? That's called the VWAP. Sheba, did you like it? Yes, my girlfriend's starting to fall in love with you, Jim. I don't know what to do. It's either going to be you or her. Well, that's a tough choice to make. I'd hate to be in your shoes, young man. Take the woman, 'cause I ain't worth a damn. Okay. We got a triple top on AMD. Oh, Rob's up a... God, did he do that again? Not again. Not again. Nope. Not again. I won't tolerate it. Rob's the most improved trader that I've ever traded with. He just kept on ticking, never gave in. He trades stocks every day. It's easy to say, Rob, great job. Okay. Look at that. Right to the orb. So, room, are my songs touching or what? Magnificence here. You cried from the song? Yep. Very touching. Well, it's at $1.08. That sounds so great. From 72, it's at $1.08. Oh my gosh. I have nothing to eat in this house. What can I do with a can of frickin' green beans? I'm a bachelor. Let's make some Pokes, Indiana. little bit of white rye, and some grilled up green beans. I do have some rice. I got two things now. Okay, well, Rivian had a downgrade. Honeywell reversed there when I saw the low down there. Oh, look at IWM. Boom. Dadgum, boy. I can listen to the wind. I can listen to the wind. When the wind blows my mind, I can hear it. Oh, where we got the pullback? So how many people in the room has been in a tornado? That's a good question. Tornado. One year I sat here in the spring and called out 186 tornadoes in one spring. They missed us again. I'm still here. Last year we had what? That 90-mile-an-hour wind for all day long. I haven't seen that ball. Time to put this up. I got my winning trade. That was like $600. I'm done. I mean, I've got my limit. So if I was in my retirement mode now, I'd be packing up, get my laptop ready, and today we'll be going down to Chelsea's. Get me a margarita. This crazy guy, Washboardjim is. There it is. God. Look at that. Spy. Okay, we're back down to 63 now. We're retesting. Now, if we hold to 63, we stay bullish. But we could also come back and retest at 687.59. Previous resistance that broke out of that ascending triangle. So would I jump in the trade here? I've sold it. That's a 200. But I'm hungry. Should I go down to the store and buy me a Magoo? Mr. Magoo. mean, I really want to take this trade. Okay, prepare ye. It's 10:36. I don't know how he does it, but we're now under this 63, so we're bearish. Means we still could come down one more candle. So I'm not in no hurry at all. I'll wait until we hit this triangle here. Right in here. Somewhere in this box. If it'll let me. Oh, that ain't right. We have a misunderstanding here. Come on, give me one more red candle. I asked for it politely. As long as we're under the 63, we're bearish. And that's this red line. Which means we could come down with in time if it got real slow. It'll be right here. No! No, God, no. Don't break. How dare you? How dare you break to 63? How dare you break to 63? You piece of shit. Don't do it. It's kind of saying, I bet I can. Oh, now we're in between. Now we just got the sucker just squeezed right between the two. Everybody, please take your notebook and paper out. Write down your final farewells. Because if we break the 63 here and go past the 9, we're going to higher levels. Here we go again. Break it, Jim, a sneak and stay. We like it when called squeeze. Okay, it still might give me my chance. I'm still waiting for this. Bam, right there. And then I'm going to go to lunch. So the banks, I used as the excuse last year that we'd have a good run this year. I don't know what to say for this year. I'm good at forecasting, but I don't know. I don't know.
Check in with Nicole Petalides, host of Opening Bell and the Watch List. Good morning to you, Nicole. We're 2 hours into the trading day. We're just seeing the Russell turn into the green, which is a nice change. But I want to focus on Intuitive Surgical here. They announced some results for their fourth quarter, not their full earnings report, and seeing a pretty significant move to the downside.
Yeah, and it's really about the guidance.
These were next week, so
Anybody in
SPXs.
business news knows it's not only the quarter, but also really about what is this company saying about the
Really?
future. And the Da Vinci system, this is all about minimally invasive robotic surgery. That's what Intuitive Surgical is really known for.
There it is.
It has been a good performer
Okay, shut
over
up.
the years.
SPX. Well, I'm looking at the SPY, but I'm going to trade the SPX. Lotto. The 6920s. Or the 6925s. 69, get 3 of them. 6925s. We're at right where I said we need to hold. So at 255. He did it again. I have no clue how he does it. He sat here and he said, wait, be patient. We're not, it's not over yet, but. He did get you in that call. This is the SPX off the SPY chart. And I've got a telephone call. This is bullshit. Ugh. Always clean. Can't you see I'm in the middle of a trade? Whoa. Okay, uh-oh, I'm down $5. Kind of need to hold that. Uh-oh. Uh-oh. Oh. Uh-oh, your inputs. Well, it didn't hold my support, so I'm full for jumping in it. Ooh, that hurt. What? 1 to 80. They could drop more now. So this one I don't feel too good about. Well, it's a double bottom coming close in the right shoulder line. Right down there. George.
So I'm essentially going to buy the January weeklies, which expire in 16 days, the 95 call. I'm going to sell 2 of the $100 calls, and then I'm going to buy, to tap it off, the 105 calls. So altogether, this would cost you about
might add
$150
6
a share in debit, or $150 a contract. So in essence, it's a bullish trade. The sweet spot is effectively $100. That's the midpoint of the butterfly between now and expiration in 16 days. Your outlay is $1.50. Your potential profit, if it does at that level, is $3.50. And essentially, it has to hit $96.50 on the low side between now and expiration for break even. So it's a way to play a trend continuation, hitting a swing high level, which I suggest is $100. And it's a low-cost way of doing that. Again, so your outlay is your debit, which is $1.50 per share, to potentially make $3.50.
All right, so there's your trade. Right now, we're up 1.5% on the heels of this upgrade here at 95.46 for Okta. George, we appreciate you being here with us to break down the latest and also for that example trade. Coming up, we've got our 360 round. We'll highlight the bank earnings that we've already gotten after we had several major banks report earnings this week, several of them this morning. That's next.
You ain't been talking about them much.
Trading at Schwab is powered by Ameritrade, unlocking the power of think or swim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
I'm Alex Coffey.
And I'm Jenny Horn. This is Next Gen Investing, where we track the trends shaping tomorrow's market.
From tech to energy, crypto to consumer, we focus on what's driving investor sentiment right now.
Clear analysis and forward-looking market coverage every trading day.
This is a make or break level for this stock.
That could certainly be a short to near-term catalyst.
Next Gen Investing, 1 p.m. Eastern.
Only on Schwab Network.
Hey, Dad, I have a question for you.
Sure.
When did Granddad first start investing?
Granddad had an account with Schwab before there were branches in the area. He really started with nothing. He worked hard, and after he passed away, the torch has been passed to me, and my advisor, Jennifer, she was with me, with the journey, helping with the estate distribution. The 2 grandchildren planning for their college educations. Someday it'll be their turn.
This is Fast Market, built for traders who want more than just headlines.
We walk you through trade ideas with structure, risk management, and a focus on execution.
From options to earnings to volatility plays, we bring decades of trading experience to every segment.
With real-time insight across products and sectors, we deliver what active traders need to stay ahead. Fast Market weekdays at noon Eastern, live on Schwab Network at schwabnetwork.com.
Welcome back to Trading 360. I'm Marley Caden. It's time now for our 360 round. For that, let's bring in our panel to discuss bank earnings. Joining us, Eric Sterner, Chief Investment Officer at Avalon Wealth Management, and Pierre Boulay, the Managing Director at
Mr. Doing Good
SSA Company. Thank you both for being with us today. Eric, let's start with you. What are some of your takeaways from the bank earnings that we've gotten so far this week?
Yeah,
Good.
Thanks for having me. And I think overall we saw some mixed results among the.
You're low on SPY.
But the good news is that the consumer still, at an aggregate level, looks very healthy. We saw J.P. Morgan and Bank of America report less credit card delinquencies. We saw Citi write down on their loan loss provisions, and we saw Wells Fargo report that their written off bad loans was down 16% from a year earlier. So the consumer, yes, it's a very bifurcated story, as has been discussed much in the media, but overall remains healthy, and I think we're going to see a very strong year for M&A activity, which should serve these big banks very well.
And Pierre, as far as your observations from what we got, financials had a really standout year in 2025. Have the results that we've gotten shown that we can sustain this rally, or are valuations starting to limit upside here? What were some of your takeaways and some things that surprised you?
Yeah, hi Marley. I think I noticed that there is some slowdown compared to what I would expect. I would agree with Eric that overall consumer is doing very well. I have some worry definitely on the investment banking. I'm not as bullish as Eric on that. It depends a lot. And on top of that, there is a big issue which is dealing with the government. Depending on the policies come through, it could dramatically affect the performance of the bank in 2026.
And Eric, you were highlighting, that you think the consumer remains healthy on an aggregate level. What specific data points give you that confidence there?
Just the consumer spending. When we saw it with the retail sales report from just released this morning, where retail sales was up 0.6%. The last for GDP, I believe consumer spending was up about 3.5%. So overall, we see consumer spending, retail sales very healthy. We know that it's really driven by the higher end consumer and the wealth effect. Obviously, the higher end consumer has generated a lot of wealth with the stock market over the past year, as well as the home prices. But the lower end consumer is struggling, as the cost of living is up nearly 25% since COVID. And I think that's what we're starting to see with the White House trying to address these affordability concerns, especially in the midterm election year.
And Pierre, you note that credit quality bears watching here in the wake of some of these reports here. With what Eric just said about the health of the consumer here on the consumer side, what are some early warning signs that investors should be looking out for that we might start to see cracks?
So we are beginning to see, I think, overall the reserves are pretty much at the right level for the banks with regard to credit risk. And that is not even consumer, in fact, and corporate. However, there is a serious risk in my mind that depending how the economy plays or how, again, the federal government plays, that it would dramatically affect creditworthiness for the lower segment, and I would agree with Eric. By overstretching potentially the spending, use of credit card or whatever it is, depending which measures are taken.
And Eric, I want to talk about, when we're talking about credit, this proposed 10% credit card rate cap. You've called it more political than practical. If something like that were actually to be enacted, what would be the real impact, in your opinion, on consumers and also on the banks?
Yeah, well, it would certainly hurt the bank's revenues and profitability. But I think it would actually hurt more consumers than help them. Because, banks, credit cards are essentially unsecured loans, and banks need to properly price them based upon risk. And if they cap those rates at 10%, then many lower-end consumers are going to lose access to credit lines or even have their credit card accounts closed. There's been previous studies on similar past proposals where 80 to 90% of credit cards could be closed at a 10% cap. So at a time when the lower end consumer has issues with affordability and keeping up with the cost of living, losing those lines of credit,
Jimmy don't get it,
actually hurt the consumer as opposed to help them.
And Pierre, you've warned that government intervention here could create market imbalances similar to what we've seen over in Europe. In terms of the lessons that U.S. investors should be taking from those examples, what do you think the most important takeaway is?
I think the strength of our economy is based on free market economy. And as soon as you begin to play with free market economy, you will be affecting that in lots of ways. I agree with what Eric's analysis is. It will push the consumers to go to alternative potential means to get funding because they cannot live without it. As we say on the lower end of the segment, people are struggling to make ends meet, and that will get it way worse and pushing them into alternative ways that may not be very good for the economy as a whole.
I appreciate you both being with us to talk bank earnings and the broader implications of what we're seeing in the credit markets. Eric Sterner, the Chief Investment Officer at Apollon Wealth Management, and Pierre Boulet, the Managing Director at global consulting firm SSA & Company. Also want to thank all of you for joining us today on Trading 360. I'm Marley Caden. You can download the free Schwab Network app available in the Apple App Store, and you can tune in 24/7 on schwabnetwork.com. Fast Market with Diane King Hall is coming up next.
Schwab Bank Investor Checking, the checking account built for investors, named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Try and do something again.
Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists, streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com.
Hey, Bob.
Hey, Andrew.
Last year, my dad had a stroke. Big shock to see this person that I've always seen as a force in our family be vulnerable.
Wait, had a stroke?
Yes. Now we're in the car together almost daily. I started to realize, what can I pick up from my dad? He's been with Schwab for a long time.
Jim, my financial consultant. I probably met 20 years ago.
Jim's really been there to answer any questions I ever have. Makes a huge difference when you have someone that actually cares.
Stay connected to what moves markets. Download the Schwab Network app and stream live coverage wherever you are.
Welcome to Fast Market here on Schwab Network. I'm Diane King Hall. Noon Eastern here at the New York Stock Exchange, and Wall Street's under pressure today as investors dig through the latest batch of earnings. Let me give you a check of your scorecard as we hit the lunch hour on Wall Street. The S&P 500 down more than 1%. Dow lower by 0.6%. NASDAQ 100 feeling the most pain, off by 1.7%. Small caps trying to hold their head above water, not doing it right now. You're looking at the Russell 2000 off by 0.1%. In terms of the pressure within the S&P 500, circling back to the top of the leaderboard, consumer discretionary and information technology essentially neck and neck for the pressure there. Communication services, the other laggard. Here's the roadmap for today's show. We'll look at example option strategies for Taiwan Semi, plus The team from Likefolio will be along with new sentiment data on Shopify. And Goldman is also on our radar today ahead of its earnings due tomorrow. Big week for the financials. Now that we've got the roadmap for today's trading action, it is time to bring in my co-host. We got 2 for 1 in our Chicago studio with both Tom White and Alex Coffey there. And guys, we're watching stocks turn lower for the second day in a row. Pressure across the board, even in the face of better than expected economic data. Now, you got that retail sales data, the PPI. Alex, you made the point earlier that it's, basically it's catch-up data, so maybe that's why it's kind of just shrugged off, and that's not what matters right now. Tom, what's your take when you look broad strokes across markets?
I think it matters a little bit if you take a look at the PPI data that was, basically, above expectation, 3%, still, above those levels. Now, these are backward-looking numbers back from November, right? We don't know if these numbers are, fully, relatable to what's going on right now. So I think that's a concern. CPI data has been better than expected. But if you look at the PPI data, 3%, both on core and the headline, that's a concern. Now, the retail sales number is great, right? So what does this all mean? Up 0.6% on retail sales, up 3.3% year over year, above expectations, above CPI data, right? So, it kind of puts the Fed in this box where, hey, they don't need to do anything this year if we continue to see data like this where inflation's still above their 2% mandate, and then you've got good data on the other side, whether it's retail sales or some other figures that are doing well at this point. And if the jobs market stays relatively stable at these levels with the unemployment just below 4.5%. So I think this is one of those things where maybe the market's getting uncomfortable with the fact that, hey, maybe we're not going to get any rate cuts this year. And they're trying to price that in a little bit. You still have about 5 of the S&P 500 sectors out of the 11 that are still positive on the day, but they're not being led by the ones that you want. You don't want energy leading. You don't want consumer staples leading at this point, and those are the ones that are leading. We're seeing big weakness here in the NASDAQ.
Okay, great perspective there. Alex, what's your take now that you've had time to digest the data more?
Yeah, I think my take remains the same. I think it's largely clerical when you start thinking at where some of that data is, given that we've gotten the December CPI numbers already. I'm not in the inflation's a big concern camp, and if it becomes a concern, it largely means that in most of the times cases that growth outperformed, and ultimately if you're invested in market assets like equities, you want to see growth in the economy that you're invested in. So I think that's a good outcome. You look back in time, going back to 2022 when rates started going higher, inflation started being higher. Yeah, there was a scare, but you look at stock performance since that moment, they've done really, really well. And so it's this fear around what it means as consumers and what it means for the lower half of the K. But the reason it's so stressful in that lower half of the K is because they don't have risk-bearing assets largely, and they don't have investments in things like equities to the same extent of the top half of the K. The top half of the K has done phenomenally well over the last several years because they've had investments in things that typically act as a very good inflation hedge, like equities. Tom talked a little bit about the breakdown of the sector performance today. He's right. The 4 of the 5 most important sectors. So you look at financials, communication services, discretionary, and IT. They're the four worst performing sectors today. But I'm both nervous about today and encouraged by today at the same time. And the reason being is over 50% of names are higher in the S&P 500 today. And you look at this equity market represented by the S&P 500 in the U.S., and you see down about 1% or 70 points. Well, what if I told you 3/4 of that move could be attributed to the Magnificent Seven and Broadcom? So it both shows that there is demand for other names, there is, general strength in the market, but it also at the same time highlights that extreme concentration risk that's been prevalent in this market for the better part of the last 3 years.
That's a great point there, and I hear what you're saying about both nervous and encouraged. I share your sentiment on the long-term view on encouraged. Nervousness, I feel like there's also some nerves, and there were earlier, as it relates to the U.S. and Iran and what is happening there. So that adds to just some risk factor, but let's talk about the pressure on the banks. You've got Bank of America down, even though they were initially higher off the back of their results. Wells Fargo, they missed revenue expectation, that's down 5%. Citigroup also, the CFO saying on their earnings call that cap on credit card fees would cause some pain. Tom, what's your take when you look across the financial sector?
Yeah, maybe some profit taking. I think if you take a look at what's going on with some of the moves in here, we're down 4 to 5% on Bank of America, Citigroup, Wells Fargo. Bank of America looked like that was the outperformer as far as results goes. CEO Brian Moynihan basically stated that the economy is doing pretty well. The consumer is doing well at this point. Wells Fargo, you mentioned the miss on revenue, maybe a little bit of trouble there. Citigroup, it had been rallying to those 17-year highs going into this report. So I almost equate this to a little bit of exhaustion because it kind of follows that narrative that we saw with JP Morgan yesterday where the stock sold off over 4%. It's down another percent today on the weakness. But yeah, maybe just some profit taking on here because they were all pretty good reports. And if we continue to see data like retail sales that are coming out pretty good at this point, that stabilization in yields, the yield curve normalizing, that's going to help these banks. And if we do see this expected pickup in the economy as deregulation and consumer spending continues to be robust, you would expect that these banks would do pretty well. Now, valuation-wise, they're a little bit stretched compared to historicals, but maybe they're growing into those valuations. And I think that's one of the things you're going to have to watch for because they're at the front line of what's going on.
Doesn't matter how
in the
good they
economy,
do, they're
and
still going to pull back.
Continues to do well, and people have jobs, and people are out there spending. That's going to be a benefit for the banks moving forward. Maybe some volatility in the overall market might help those trading revenues also because that was a big boon for some of the banks last quarter.
That's a great point about the volatility, and that had done some of the lifting for the banks. And then to your point about the consumer, Tom, you know, there was another thing that I did hear, that the consumer is pretty resilient. Alex, what's your take?
Yeah, if you were to aggregate these four banks, you know, they're beating earnings by about 5% versus where the estimates were coming into this particular earnings season. All four of them have beaten on the bottom line. It's a little bit more mixed on the top line. If you were to aggregate the estimates, it's about 0.25% beat for the group, so a little more in line. And you've had two misses as well of the four. But to Tom's point about maybe the elevated, you know, high bar into these reports, it's represented by the one-day price change. It's over 4% to the downside on the aggregate when you factor it in as an average for these four names. So the numbers aren't really disappointing, but they're not good enough, and the market's not rewarding kind of okay numbers. It's looking for perfection in some of these sectors. I think that's an early tone being set for this earnings season that you're really going to have to, especially these sectors that have outperformed, deliver really, really home run-like results to continue the party to the upside.
Okay, let's talk about Netflix, guys. So the saga is not over yet as to who gets to own Warner Brothers Discovery. New chapter happening here. Cash is king. Bloomberg, I know you all saw this, that report that Netflix is weighing shifting to an all-cash offer. It looks like the idea is to accelerate this deal being done. Tom, what's your take?
Well, I think if you look at the reaction in the stock over the last 7 months or so, that's going to be the big concern for shareholders for Netflix because this asset they're going after, and you know, if you look at it just on paper, maybe their bid's not as good as Paramount Skydance's, but at the same time, it seems like Warner Brothers Discovery wants to pair with Netflix a little bit more. I think the shareholders are voting with their wallets at this point. You know, the asset that they're buying or the assets that they're buying from Warner Brothers Discovery potentially, are those going to be a drag moving forward? Are they paying too much? And you've seen that 34% pullback from those highs that we saw in the middle of the summer. And that's a concern, I think.
Got to break to 63.
In your head going, why are they going to do an all-cash bid? We're paying too much for this asset as it is, or the portion of the asset that they want to purchase. So that's a concern, and I think if you look at the stock performance in Netflix, it's kind of reflected that, hey, maybe the shareholders aren't keen on this deal getting done, but it's going to be a drawn-out process. We've already seen that. It's been months, right? We've got no resolution. I think that continues. Maybe the bid goes higher. Maybe that puts even more pressure on Netflix. Right now, you're concerned about Netflix shareholders at this point because they've lost a lot of value in that stock.
Okay, Alex, what's your take when you look across that sector?
Yeah, from what I've looked at, I mean, if they were to change their existing bid, so not adjust the price, but that, roughly $27.75 per share to an all-cash deal, it could mean around $12 billion in additional debt for Netflix. And I think that does pressure the stock, right? It changes the balance sheet dynamics quite a bit. And so I do think in many ways Paramount Skydance sees this as almost existential. And they're worried that if this set of IP and assets goes to Netflix, that it's going to really solidify Netflix's position. So I see their defensive, offensive, approach to it, trying to come up above, trying to continue to put pressure on this deal and to try to get the WBD shareholders to switch. But if you're Netflix, I think you liked the idea of the sort of split, partially equity-driven deal, partially cash deal, just because it allowed for a little bit less pressure on the balance sheet. But if you want to really try to just ram this deal through, pull the timeline up because of that pressure for Paramount, I can understand why they're mulling this decision.
Okay, and shares of Netflix down 2% today. Tom, great points that you made about how much the shares have been under pressure as tied to this deal. Well, let's talk about some more pressure. It's on Fortinet and Palo Alto networks, though not as much as one maybe expect. You've got renewed tensions between the U.S. and China. This time, China is calling for essentially what looks like a ban on cybersecurity software
what?
from the West. They mentioned
New
U.S.
tension?
and Israel. Tom, what's your thought?
What the fuck?
The technology battle continues here, Diane, and you're seeing that from the tit for tat that's gone back and forth between China and the U.S., maybe restrictions on some of the products that are being able to sold. China coming out and saying, hey, we don't want our companies, our domestically based companies, to use these products. Well, there was a note that came out immediately after, and probably why you're not seeing that big of a reaction in Palo Alto, in Fortinet, and Checkpoint, CHKP. That's actually positive right now because TD Cowen analyst came out and said minimal exposure to China. Only about 1 to 2% of those companies' sales are going to be negatively impacted if these restrictions go through. So that's not maybe as worrisome. You look at AVGO, though, with their VMware that they purchased a few years ago, that might have the most exposure here moving forward. But this is just a continuation, Diane, I think, of these restrictions that we're going to continue to put on each other as this AI race and this technology race continues at this point. So geopolitical and headline risks are going to be a topic for a lot of these companies moving forward. You've seen Broadcom pull back nearly 19% from those recent all-time highs, so maybe struggling a little bit. You've seen NVIDIA. That's going to be a case-by-case basis from the U.S. side, while the Chinese side maybe are going to continue to restrict the GPU sales from AMD and NVIDIA moving forward. So yeah, I think this is just going to be one of those headline risk type of stories, even though you might get blowout earnings from a lot of these chip makers moving into earnings season in a couple weeks.
Yeah, it does feel like it's that, continuation of that theme of tit for tat. Alex, what's your take when you look across this space?
Yeah, I think the headline, at least for some of these more pure play cybersecurity names, is maybe scarier than the actual financial impact. But to Tom's point, especially the analyst point around the percentage of the revenue for each of these companies derived from China and really just the Asia Pacific region in general. That said, I don't know that it's overly surprising. Maybe timing, specific companies that are called out, for example, could be. But if you look at the world through a realpolitik lens, like this is kind of where things are shifting. There's a general trend towards deglobalization. There's a general trend towards onshoring and developing things that are seen as geopolitically relevant domestically. That's, of course, a trend that we're seeing in the U.S., but you're going to see equal and opposite reactions from places like China that are going to be impacted as well. So I think it's, again, surprising maybe specific companies that are called out or mentioned or targeted and maybe the timing, but this is the general direction the geopolitical landscape is shifting towards. And until there's a meaningful update that suggests otherwise, this is kind of the baseline for the direction in my mind.
Okay, all right, great stuff, guys. We have got bull versus bear coming up. The guys get their example trades put together for Taiwan Semi ahead of its earnings, which are on tap tomorrow. We'll have more Fast Market after this break.
Okay. I gotta pay city. So what's today? Today's Wednesday. I'm gonna do this tomorrow. City license are due. No, I should have Social Security.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. They're designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Sometimes, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
Welcome back to Fast Market here on Schwab Network. Taiwan Semi is set to release its quarterly report card this Thursday, and analysts are expecting strong numbers thanks to rising chip demand from its partners like NVIDIA and AMD. Converted to dollars, consensus expectations are the company will report earnings of $282 per share on revenue of more than $33.2 billion. Now, the stock had a strong year last year. Most industry watchers are expecting that pattern to continue this year. Time now for the tug of war on Taiwan Semi. For that, let's welcome back in our co-hosts Tom White and Alex Coffey. It is bull versus bear time. Before we get to your example trades, we got to talk about your views on Taiwan Semi. Alex, we'll start with you. What's your thoughts?
Yeah, I mean, my general thoughts are that this is probably one of the most important companies when you think about the role it plays in this AI infrastructure build-out. And as that web of names that it becomes larger in terms of names that are significant to the build-out, as it's branched out from NVIDIA to AMD to Broadcom, etc., including the memory names, largely TSMC's role benefits regardless, and I think that's probably slated to continue. There's a reason when you look at analysts, 93.5% of them say to buy this stock, and only 6.5% of them, or the balance of them, say to hold it. Now, one of the recent analysts is one of the holds, and they have a price target around $325, which is pretty close to where the stock is trading right now. But if that's one of your more downbeat views, is that the stock will be kind of where it is versus, for a comparison, some of the other analysts that cover this, from Susquehanna to HSBC, that see this stock potentially trading at $415 a share or over $437 a share in the next 12 months. If you were to take that for what it is, it seems to be a favorable risk reward. all that to be said, this is all in spite of the geopolitical overhang that we were just talking about. Where this company's located does present risks, but besides that, there's still a lot of optimism and bullishness surrounding this name, and it's a company that's going to still be really important even as semiconductor manufacturing is more onshore here in the U.S., assuming it continues down that path.
That's true. That's a great point there, Alex, in terms of its positioning and how it's honestly leaning into its relationship with the U.S. Tom, there's some great perspective that Alex gave there, including what the analyst views are. What's your take?
Yeah, I think if you take a look at what they do, remember they report
what they
revenue
do
numbers and sales numbers on a monthly basis. So you've got some clarity in what's going on. They just reported sales at the beginning of this month. And that revenue was up 20% year over year, so that's a positive. There was an article that came out from the Information this morning that said TSM is hard-pressed to meet surging AI chip demand that NVIDIA on their GPUs went to TSM and said, hey, we need more production from you. AVGO, they're making some of the TPUs for Google Alphabet. They've asked for TSM to increase production, and they can't do it. They don't have the capacity at this point. So that's a good problem to have, probably. And
probably
the fact that they're trying to build out more infrastructure in chip plants here in the U.S.
SPX is at the 200 EMA on
expects them to actually
the 1 hour.
Increase that, but those aren't going to be online for at least a year and a half to 2 years. So it's a good problem to have, but margin expansion, do they get up to that 60% gross margin level that a lot of investors are expecting them to get to? And what kind of pricing are we going to see from TSM when they report their numbers? Because with all this demand, do they get to increase prices from some of those companies that are trying to get them to ramp up production at this point? So a lot to work through, but we do get some clarity on a monthly basis just due to those sales numbers.
Okay, all right, this is true. We get that monthly cadence, so that helps give some understanding of where things stand. Now, this makes me feel like the setup is bull versus bull, but let's get into it. Example trades. Alex, you take it away.
Yeah, I mean, you look at this stock's performance so far year to date, trading around 325. It hasn't meaningfully closed below the 5-day exponential moving average so far this year. I use that as like a shorter term trend indicator, and it really would have to go back to the middle parts of December to see a meaningful close below that mark on December 18th being the last time. When you look at it though, all things considered, for this, the 1 week moving average continues to trade well above the 1 month moving average. That 1 month moving average on an exponential basis around 312. Market maker moves around $12. If you think that that 1 month moving average coinciding with that one standard deviation range could act as a level of support, even in disappointing numbers, a short put vertical below that mark could make sense from a risk-defined example trade strategy perspective. Not that we've looked at here. It's a 310, 307 and a half put vertical. It's a credit spread looking to collect 50 cents. Now, risk reward is 4-1, so it's definitely leaning more into the high probability of success than it is risk reward. And you can see that basically reflected by the fact that you're risking 4 times more than you can make per spread. But the break even would be 309.5, so you have a cushion below not only that one standard deviation range, but also that potential support level, guys, that's around, I think, around 312 right now for that 21-day EMA.
Yep, Alex, you look at what the option market is pricing in on a 1 day move on this one. It's plus or minus $12.30. The IV percentile rank below the 30 level at this point. So not really elevated volatility, but that's probably due to the fact that it hit all-time highs just yesterday. And the fact that, you get those monthly numbers from TSM. But let's break down Alex's trade. This is out in the January 23rd weekly cycle, so not a pure earnings play. You got 9 days in this position, so even if maybe you're wrong, the stock goes lower, you still have some time in this position. Selling the 310 put, buying the 307.5 strike put, just a short $2.50 wide put vertical, collecting roughly about a 50-cent credit. You might even be able to collect a little bit more than that. But if you collect that 50-cent credit, that's what you can make. $200 in risk on this one, but that's all the way below the 307.5 strike. It's kind of setting up about that one standard deviation, a little bit more, but you're giving yourself an extra week in this position. The option market pricing in about a plus or minus $19 move either way into that expiry. But this is neutral to bullish, and it's risk defined, as Alex mentioned. I think that's a key in here. And he did mention the break even on this one, 309.50 to the downside. So you've got a pretty good cushion to the downside before you start getting hurt, where you can still take a directional bias on something, but give yourself a better probability of success. That short 310 strike, about a 75% probability of finishing out of the money. That's why you're only collecting 50 cents on a short $2.50 wide put vertical. Now let's flip it here, Alex. I'm going to go walk through my bearish example trade. If you think maybe this thing's topped out, because the stock did top out yesterday at 336 was the all-time high intraday in yesterday's session, pulling back about 1.5%. But I looked at a strategy that gives me an ability to take a downward bias, but then maybe lessen my risk on this position as opposed to just buying a straight put or buying a put vertical. I looked at an unbalanced put butterfly to the downside, buying the 330 put one time in January 16th, weekly or monthly cycle that expires in just 3 days. Buy one of the 330 puts, sell two of the 315 puts. That's where you want the stock to go. And then buy one of the 310 strike puts. So in essence, you're buying a bearish $15 wide put vertical, offsetting some of the cost by selling a $5 wide put vertical. You're going to pay roughly about a $5 debit. That's where it was trading earlier. It's probably trading closer to $5.30 right now. Might have to pay a little bit more, but the debit you pay is going to be your risk on this position. So if you pay $5, it's going to be $500 in risk with the potential to make $1,000 if it settles at or near that 315 strike where you're short two puts on this one. Break even on this one, 325. I think that's really key. On a percentage basis, Alex, you don't need a big, massive move to the downside to get below that break even on this unbalanced put butterfly.
Yeah, the interesting thing, guys, is that there's actually a $15 wide window. Not that these two trades synergize well together, but where both trades can work. And so 315 would be a perfect level for both these examples. And it shows that you can have a neutral to bullish strategy and still have the stock go down if it's structured in a way like I did, a little bit more leaning into high probability of success. The way that Tom structured this, it's more about picking a direction, setting up a set of risk and reward parameters, but needing something to happen in order to make that money. So it's just shifting where you begin on that risk profile. Now, the shape of the risk profile, of course, is a little bit more complex and different as well. But for the most part, a lot of the same principles apply. You're just starting closer to the break even as opposed to in the max profitability zone. One of the things that I really appreciate about unbalanced or skewed butterflies is that oftentimes in the traditional butterfly, you have an area you want the stock to go, and that area is either going to be higher or lower than where the stock is, and sometimes it goes that direction, but it overshoots your target one way or the other, and so you can have a bullish or a bearish strategy and the stock moves too far. By skewing it the way that Tom has for this example, it's a bearish strategy and it does not take downside risk. And so in a situation, especially around earnings, where some sort of unforeseen surprise could send the stock into a bit of a tailspin, there's no exposure that you pick direction right and it goes too far. So I think that's quite notable. And then, of course, longer term over the last year, as Tom mentioned, that IV percentile rank is sub 20, but more on the 1 month range. So relative to recent trading action, it started to creep up. It would be about a 66 if it was a 1 month. So implied volatility across the board is very low, but it is starting to creep higher in some of these names just because we're going into earnings.
Yeah, and you made a good point here. Even if you get the stock to fall out of bed on the unbalanced put butterfly, it's still a double in profitability on that below that 310 strike because you made it a broken wing or a skewed put butterfly on that one. But as Alex mentioned on his Diane, he can be wrong but still be right. He just needs the stock to stay above that 309.50 level on the short put vertical.
All right, good stuff, guys. Thank you, Alex, as well for joining us today. Alex has got Next Gen coming up in about 30 minutes' time. Stay with us. We've got Cash Jacks coming up. The team from Lightfolio will be along with new sentiment data on Shopify. Keep it right here on Schwab Network. Fast Market will be back after this break.
Time is money.
Sometimes, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
I'm Sam Vardas, live from the New York Stock Exchange. When the market moves, we're on it. Getting the reaction, the strategy, and sentiment in real time. Stream Schwab Network at schwabnetwork.com.
Trading at Schwab is powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and in-platform chat. Trade brilliantly with Schwab.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you an active trader? Our active trading webcasts are designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
I've got
No politics,
688857.
from open to close and beyond. Streaming 24/7, any screen.
We're at a major support right now on SPX. Triple bottom, and we did have a little bit higher low there. And I think that just ruined that. Which was kind of good for it to go ahead and move up. It also has kind of like an ascending triangle up here. But right now it's kind of just going sideways. So it really needs to move back up. It's the third dip. It's more or less a symmetrical flag coming out of the snake. Definitely cheap. The only thing I don't like about them is a little bit too far out of the money now. It's kind of got a bullish bottom here. A little bit like what you see right here. Almost the exact same thing. Look at that. Look at that. It's almost the exact same thing. And the breakout right here. And then the big candle pull back right here. Yet another one right there. And then a breakout. And then another breakout. And then a pullback, and then another breakout to a double top. I mean, it's almost identical. Well, they're not being very nice. I'm trying a new indicator that predicts movement. The Washboardjim indicator. Okay, come on. I gotta get something to eat.
Arena, and Shopify is really helping unlock that for a lot of these smaller businesses that may not be the Walmarts of the world. You know, Shopify, if you look at the last quarter where they really scaled, were these small to medium-sized businesses with under 25 million gross merchandise volume. And so you're kind of helping these smaller players gain access to a consumer. So that obviously, if you're Shopify, this is
that's
what you're
a
really
straight
good at,
across
what you love to
almost.
do. And
Count
we're
that whip.
seeing signs, at least in our data, you know, when we track this digital traffic, this is a sign to us that more and more merchants are increasingly turning to a company like Shopify to help power their platform and thus integrate within these systems. So I think that on our end, you can see this chart here, that's that digital traffic I was talking about. And you can see that even though, you know, the stock has had a great run over the last year, the stock has really rebounded from lows in 2022, if we were to expand that even further. But that blue line, that traffic line, is continuing to jump ahead of it. And we're seeing a bit of an acceleration around the holiday season. So, you know, even considering we're still at the very beginning of truly agentic shopping, you know, inside of these AI platforms, overall, companies or merchants that are utilizing Shopify seem to be getting more traffic. They seem to be outperforming. And so I think that this is good for Shopify, you know, capping off this holiday season shopping quarter. The company doesn't report until February, I think, but that early data that we've seen come in looks very promising.
Megan, let me ask you this. I know on the chart of visits that you all have that Amazon is lower on the list by quite some distance compared to Shopify. But I wonder how much of a threat is Amazon to Shopify, especially when you have this conversation about the AI component and Amazon's leading into that and people are using that. Some say it's still, you know, kind of finicky. So yes, we're Tom, like you, I'm not an early adopter yet at all on that. I don't know if I will be, but there are people who are using Rufus, for instance, on Amazon. How much is Amazon?
The SPX, I mean, I like where it's sitting here at the 200 on the 1 hour time frame. We've had inverted hammers. We got long leg dojis, so they've all thinned out. But it's right, I mean, it bounced off that 200 EMA. The SPX. 1 hour time frame. I'm still safe. So easy to make a a 9 out of a 4.
Growth runway ahead of it, and certainly whenever we see pullbacks like this, we'd like to take advantage.
Okay, we'll leave it there. That's Megan Brantley, Vice President of Research at Likefolio. Tom, I noticed the same thing with the stock. I was trying to figure out what the trigger was. I mean, it's down, as you mentioned, about 8% right now. I can't see what's going on here, especially to your point with the broader market. Yes, it's under pressure, but not to this degree. You know, and it seems like, I mean, maybe there's some profit taking here. What's your final thought before you get into your example trade?
Yeah, it might have something to do with the fact that consumer discretionary is down pretty significantly today. You know, Shopify stock has a 2.8 beta on this, so it moves nearly 3 times as much as the S&P 500 on a percentage basis. So it's got that higher beta. Maybe that's why. Maybe a little bit of profit taking, but the stock has pulled back pretty significantly from those all-time highs by about 15% just about 2 months ago. So got to take that into consideration. But that's how I set up my example trade here in Shopify after seeing some of their data and then seeing the pullback here. So I created a strategy. If you want to take advantage of this pullback, maybe give yourself a little bit of a cushion. I looked at a cash secured put here in Shopify that, hey, if the stock kind of consolidates here or goes higher, I just get to keep a credit that I collect. If not, if it continues to fall, hey, you get to buy the shares potentially at a cheaper price than where it's currently trading, which is about $155 per share. So I looked at the January 30th weekly cycle. So you've got a couple weeks till expiration on this one, 16 days. You're going to avoid that earnings event, which is on February 11th. I think that's really key here. But we're going to sell the out-of-the-money 150 strike put. You're going to collect a credit of roughly about $3.50. That's what you can profit on this trade, $350 per put that you sell. Now, you do have quite a bit of risk on this one. Remember that, because if the stock were to somehow go to zero, you've got about $14,650 in risk all the way down to zero. Now, the break even on this, if you collect a $350 credit, that's what you can make. The break even goes down to $146.50 to the downside. That's about $9 below the current share price. So you've got that cushion. So you can be wrong on this trade and potentially still be profitable. Now, if the stock does fall below 150 into expiration, you're still short those puts. You may get assigned on those, and that would allow you to have to purchase those shares at that break even of $146.50. So you'd be buying them at a discount. So this is a little bit more aggressive, a little bit more capital intensive, but it sets up Diane well with Likefolio's data. If you think we're going to see a rebound, maybe some consolidation, it gives you that exposure to the upside, to a neutral type of stance, or even a little bit of downside before you start getting to that break even. That's about $9 below the current share price.
All right, good stuff, Tom. We've got the breakdown coming. We are taking a look at Goldman ahead of its earnings due tomorrow. It's under some pressure today, along with the pressure that we're seeing across the banks and financials. We'll be right back.
Here we are, resistance, blanket. 1, 2, 3. Blanket. Sure.
To the markets with
Schwab Network. Tune in 24 hours a day, 7 days a week on SchwabNetwork.com and on all your favorite streaming services. Schwab Network. Available anytime, anywhere, on any device for free.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. The Platforms and Tools webcasts are designed to help you broaden your knowledge of platform features and resources available from Schwab. You'll learn tips and tricks to help navigate Schwab.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Welcome back to Fast Market here on Schwab Network. I'm Diane King Hall here on the floor of the big board. Before we get to the breakdown, let's take a look at where markets stand as we get closer to the bottom of the hour. We're still looking at pressure. The S&P 500 lower by just shy of 1%, so not as much as the top of the hour. Dow
God, look at that.
0.5%.
406
NASDAQ 100 is off by more than 1.5%.
Woo!
Has flipped direction from the top of the show. It is higher, but by less than 0.1%. Again, the reversal of what we saw earlier. Shares in Goldman Sachs are lower once again today, extending the pressure on GS after that stock sold off yesterday. You got disappointment over some results across the banks, like investment banking fees at JP Morgan Chase. Those have been casting a shadow across financial stocks, and then there's some other worries across the sector. As for Goldman, analysts are expecting the powerhouse bank to report earnings of $11.77 per share. That would be down from the prior quarter. Time now for the breakdown. For that, let's welcome in George Silla, senior markets correspondent, for the fundamental look at Goldman ahead of its results tomorrow. So the banks have been under pressure. Financial powerhouse is under pressure today. What's the thought or the views going into its results?
Well, I'll tell you what I think. I think if you look at the composition of the banks right now.
As of right now, this setup's kind of bullish looking because you're above all the resistance levels. As long as you respect that old resistance of 68, 95, 63, 63, 63, 63, 63, 63, 63, 63, 63, 63. Oh, left one out. Or you just get out of the trade because you feel good about it. Yeah. I'm gonna walk into the kitchen. I have no food in this house. It's killing me. I don't have a chip. Okay, fast. What do I do with my city license? I know I didn't throw that fucking away. Oh, I think I put it in here. Yeah, there it is. Finance Department. License Division. Oh, look at that knife. Oh, God. That hurt. Well, makes me want to buy some here. But not there, not that one. Well, I just got up, come back and saw that. I said, jeez. It's not looking too good.
But like I said, if you just look at the margin profile and you didn't look at what company you were
It's number
evaluating,
4.
I think it's a technology company. It's pretty remarkable. So
We're
with
in
that
sweet
said,
spot.
I can see why the stock has done extremely well in the last 52 weeks. But again, you have to consider some of the risks out there, which include investment banking, potential slowdown, technology slowdown, because we know that mega caps really haven't done anything for the most part. Many of them are down. Look at Meta Platforms, Broadcom. So that might impact Goldman Sachs in terms of investment banking and underwriting fees going forward. But nonetheless, I mean, interest rates are still high, and that really suggests that investment demand is still high. I know everyone looks at interest rates as a consumer-oriented price of capital, but it really signifies investment demand is still high. And that comes back to improving prospects for companies like Goldman Sachs. It may not necessarily be as good for the loan-centric based banks that have a lot of loans as a part of their assets and liabilities as deposits. Again, deposits are a cheap form of capital, but it seems like irrespective of the deposit base that Goldman Sachs doesn't have compared to a JP Morgan, they're just executing very well from a margin standpoint and growth standpoint.
Okay, great breakdown there. That is George Solis, our senior markets correspondent. Let's get Tom back in here for example trade purposes. So Tom, George gave the views going into this one, and I know you've been paying very much close attention to the bar. You made this point that the bar has been higher going into these bank results. Goldman's up next in terms of the playbook. I know there's also
God. Well, that's number 4. I don't like candles like that. When they just drop the floor on you. You can't do nothing about it.
getting hurt on a trade like this. But this might be the way to look at it. If you think it's going to react maybe the way that some of the other stocks have reacted post-earnings in the financial sector.
I'm glad you gave the caveat at the top of this, so that 928, 929, whatever, around that level, it ain't cheap. Yeah. All right, good stuff there, Tom. That's going to do it for us today on Fast Market. I'm Diane King-Hall alongside Tom Whiter. Thanks again to Alex Coffey for stepping in today. Download the Schwab Network app. It's available in the App Store and tune in 24/7 on schwabnetwork.com. Stick around. You've got Next Gen Investing coming up.
Schwab Bank Investor Checking, the checking account built for investors, named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited
I'm gonna pay that off. What's this? Whoa, what is this?
Welcome to Next Gen Investing. I'm Jenny Horn alongside Alex Coffey. And as we check out on markets here, we are seeing some pressure that has held pretty much throughout the session so far. We are seeing the steepest declines today, led by the NASDAQ, which is down now about 1 3/4%. So that is a substantial repricing to the downside. Also,
that's crazy.
Russell pretty much
NASDAQ
the Dow down about 0.5%. So now we are looking at about a percent loss on a week-to-date basis in the S&Ps. NASDAQ's down 1.8%. So again, I know that we've chopped around, especially when like we look at the S&P and the Dow. I mean, these names are seeing nothing but new highs after new highs. The Russell as well, but
a pullback today. I know that we're so quick to say that this earnings season will be negative, but so far the bank earnings have not provided any sort of upside catalyst to these markets, as we've seen another day of some pressure from these financial results.
Yeah, the four big banks on aggregate have beaten earnings by about 5%, but their average one-day price reaction is down over 4%. So it goes to show that beating expectations, at least on the bottom line, is not enough for the market right now. But I'm not going to blame today on the banks, and we can talk those stories, and they have an impact. But today's a Magnificent Seven Broadcom story. The Magnificent Seven plus Broadcom is contributing about 50 plus points of the S&P's down move today. That's basically 3/4 of it. So when you start looking at the performance of the marketplace today, there are encouraging signs. Over half the S&P 500 stocks are higher. Many points throughout the day, the Russell 2000 has been higher. You look at the sector performance, you have 5 sectors that are in green territory, but when concentration starts going the other direction, it can be painful. And we've talked about this being a risk for 2 years, so we shouldn't be surprised when it happens. Now, the risk is that this isn't just today, that this is some sort of prolonged trend. And every time this has happened in the last 2 years, that hasn't been the case. But hey, one day doesn't make a trend, but it can start one.
Yeah, and to speak to your point, you can see exactly from that heat map a great visualization of why we are so substantially lower today. I mean, Amazon, Alphabet even, which has not participated in some of the weakness we've seen as of late. Meta, Nvidia also down now about just over 2%. And the one outsized pocket of strength is actually, as you can see there, the energy names, or anything with energy exposure, actually a nice green spot across the board.
Yeah, where Nvidia is twice the size of the entire energy sector in terms of weighting. But if we can pull that heat map up once again, I think it's important to clarify what I say when I say, hey, over 50% of the S&P is higher. Well, that doesn't look like 50%, right? That looks like, hey, at least 75% of the S&P 500 is red. I'm not talking about the market cap of the S&Ps. That's actually the point I'm making. I'm talking about each individual square. And so that's why you see, hey, the equal weight S&P 500 is basically unchanged. SPX EW, if you were to look at the performance today of the SPX EW, it's basically unchanged. But the SPX itself, which allows for a name like Nvidia to have that very outsized impact, is down over 1%.
It is, and I mean, some of these losses we're seeing today, I mean, like substantial days of weakness. And actually, I was just curious because I totally understand the point of it's the weighting, it's how big these companies are. 245 of the S&P 500 names right now are lower, which actually you would think, again, you would think it'd be actually more than
50-50.
that. Yeah, and so the markets, I think this is a great read on right now what has propped up our market for the last several years, but also then what can lead to the real, I'd say, downside pressure.
Well said, and at the same time, we can be encouraged by the weakness. If you're gonna have a down day, % or more, wouldn't you rather it looks like this than 95% of the market lower? And there's no optimism? At least you can point to some areas and say, hey, there are parts of this market that are doing okay, whether it's energy stocks, whether it's consumer staple stocks, utilities, real estate, healthcare, all those sectors are higher on today's session. So this is that argument to be made for it can be a stock picker's market, there can be rotation, but that rotation doesn't necessarily come without some pain if it's at the effect of the performance of Broadcom, Nvidia, Microsoft, we know the names.
Yeah, and that I think right now is where people are so quick to say that some of this pressure then is going to be the downside catalyst for the overall market for the whole year. I think we're far too soon to be saying that, but it does seem like some news at least driving some of the weakness today. So we'll dive into that throughout the next hour as we'll kick things off here with some of these earnings movers to keep on your radar, as we did, of course, hear from some of the largest banks this morning as well as yesterday morning. We'll also then be discussing some of the recent technical levels that we are seeing in Netflix as well as Paramount Skydance, as the continual drama is continuing to just really run its course, but we'll be looking at some of the underperformance we've seen in these names versus one another, although I will say actually they've all been pretty solid if you look at the last several years of price performance. But we'll also then discuss the, of course, real catalyst to the downside today in the tech space, and that is focused on all things
back to resistance,
security, as well as Broadcom's VMware, Palo Alto Networks, and some of the pressure we're seeing specifically in those names, as well as Fortinet. Then we'll discuss the
Now we created right shoulder.
We have a broad crypto theme for the back half of our show. CleanSpark also announcing an agreement now to continue to expand its transmission facilities. We'll also discuss really what the outlook is for crypto into 2026. And we'll close things out here with under 30, which we're seeing Rivian today, a substantial day to the downside after some varying analyst feedback. So all that to be said, we'll start things off here with Bank of America, which initially reading these numbers, I mean, I have to say, just from doing this for quite some time, I was looking at this report thinking this was very similar to what we heard from JP Morgan. I mean, I think that there was still definitely some highlights of this report, some definite weakness, but they did still see, as you mentioned off the top of the show, Alex, an earnings beat. They also did say their client base is growing faster than the industry average, and that they're right now continuing to see overall stability actually in this economy, and that right now, based on overall expectations for the Fed and just overall rates this year, they continue to see a strong consumer health that's boding pretty well for continual improvement into 2026. So, I mean, right now, near-term stability we've seen in their total net charge-offs, and they did say that the right now key driver of expenses, which has been echoed across the board, and you've heard it from Delta as well as JP Morgan and now B of A today, headcount and labor continues to be a massive expense to these companies. But all that to be said, I mean, resilient despite some of these economic pressures. And I think if you just took Brian Moynihan's commentary, you'd say this was a pretty optimistic take. But unfortunately, what you do see is some more signs of seeing people, or they're not really seeing people that are borrowing significantly more, saving less. It's just right now is a lot of disparity across income brackets as well as these varying credit card delinquencies. And so that, I think, is unfortunately also driving some of the pressure today. Another day where it's the unknown credit situation continuing to evolve that is really weighing on sentiment today.
Yeah, and I think we should also, level set. I mean, in many cases, these stocks are like not that far off of all-time highs. Like,
right.
Yeah, it's a little bit of a down move, but within the last week and a half, they were trading at the highest prices that they've ever traded. So at least in some of their cases, double beat, best fourth quarter ever for equity trading at Bank of America. There were certainly things to like. I thought it was interesting. CEO Brian Moynihan did say that AI is going to cut Bank of America's headcount. I mean, that's about as forthright that we've seen a CEO kind of say the quiet part out loud, which is the only way, logically, that all of these investments can ultimately be accretive is that they can save you money somewhere. And where are they likely
Well, it's at resistant levels.
To do some of these tasks. And that's the cool reality of it. And they essentially said that. All that to be said, still a down move in the stock. And this isn't to be dismissive, because I do think the financial sector is one of the most important, especially as a group. But these three names, Bank of America, Citigroup, Wells Fargo, you take all their down moves today, add them up, it would be about 5 points in the S&P 500. Well, there are, several names. There's actually 5 names that on their own are contributing more. Amazon, Apple, Microsoft, Broadcom, NVIDIA, all on their own. In the case of NVIDIA, twice that much pressure just on their own than all three of those banks combined.
That's also a very good point. I think also why we don't tend to see, so much volatility around these names. Although, to speak to that, we are still seeing a pretty substantial day of now weakness here in Citigroup, which actually was initially a bit higher. And so now we've given back all of that strength and some as investors do parse through these results. We're down about 4.5%, so more modest than what we are seeing currently in Bank of America. Again, by a narrow margin, but stock is dropping, as they did say. Their message to employees is that, again, automation, AI may be cutting some roles. And so I do think that this is a continual narrative that we're going to hear this earnings season more and more so. But they did say that there's right now, bar has been raised, signaling again more job cuts ahead, following, of course, the 1,000 layoffs they already had made this week per Bloomberg reports. But they did say they are not so much, right now, they're basically navigating this environment for the first time, as we all are. But as far as this overall picture was concerned, it was mixed. I will say that their executives did say they continue to expand momentum into investment revenues. They also did say that from right now, the quarterly earnings, was a pretty solid picture of just the overall landscape for their top and bottom line. Provision for credit losses, though, are steepening of $2.2 billion. And we do continue to see, again, a very similar tone that from all of these banks where they do mention these AI jitters, but also just jitters over the future outlook of the credit environment that we're operating in.
Yeah, there's not a ton to add to Citigroup in particular that you haven't already said, but if I look at their plan for job elimination, to say it what it is, 1,000 this week, but up to 20,000, actually not even up to 20,000 jobs by the end of this year. That's about 10% of their workforce. If you look at kind of the workforce as of September of last year, it was 227,000. So a little bit less than 10%, but pretty close to 10% of the jobs. Well, we've talked about from a macro stance how fragile the job market is right now. Yeah, you haven't seen layoffs pick up significantly, but you also haven't seen job openings and hiring pick up either. So if we're in this no hire, no fire, the risk is it becomes no hire, fire. And it sounds like we might be walking across that bridge here in real time.
Yeah, and that's exactly, I think, what the concern is with a softening labor force. And there's a reason, I mean, it's softening for a good reason. It's not just like people, at least as far as some of the data you see, it's not like people aren't searching. It's just that there aren't the same scope of jobs available, which is not
Let's just be frank about it. It is not like AI is there yet.
Right.
This is like AI wave 1.0. Like, if we're looking at potentially almost 10% of one of the biggest financial institutions on the planet in this first wave, like, I've yet to hear the plan for when this is 10 years down the road or whatever time it takes, and AI is capable. Let's just use that word, capable.
It is, and I think that, well, that's hugely what props up. It's a difficult narrative because it's like that's also what then props up the growth of the tech heavyweights.
Well, then, and this is where it becomes like this debate, but it's like, who buys the product if no one's working?
Yeah.
It's very, very interesting, and I'd love to have someone who has that kind of forward thinking, mind, kind of give us that playbook. And at this point, we're all guessing anyways. They said a lot of the same things around the internet. I'm sure they said a lot of the same things.
Dial Washboardjim.
Revolutions at different points throughout history, and for the most part, it's only just spurred growth and created more opportunity. But we haven't really tried to replace ourselves yet, and so that's the interesting thing.
And I hope that we're not fully replaced, because I do still definitely hold on to the human element of all business. I think is still so important. But now to shift gears away from some of these earnings movers into what we're seeing from Intuit Surgical, which is the name we used to discuss all of the time because it was really one of the leaders of all things innovative medical care, and I do think that makes them kind of a unique company in that sense. But we are seeing a pretty substantial day of weakness, but about 3.7% here after
Go SPX break
guidance miss. So preliminary fourth quarter revenue, that actually did beat. That
6,900 now.
But right now, as far as their
new resistance.
Procedural growth guidance, that came in as
SPX. Oh, I know what I need to do. I'm gonna have a little choice now. Yeah, I got a choice.
that everything tied to the DaVinci product line was really what drove also that huge upside performance after its last earnings. So
it was looking good in 2025.
It was, and not to completely go back on everything we just discussed with AI, because I know there's also the real
It's kind of consolidate, wants to break, but
the DaVinci robotic system, I like tend to geek out about, because it does have such cool capabilities where it can, eventually it's not there fully yet, but it can basically make like zero fail types of surgical procedures, which is just, from a computer, it's amazing.
You think about the scalability, you think about the precision that robotics and artificial intelligence can provide to fields like surgeries, for example, medical fields that have really high stakes. It's really exciting, but there are fallouts, and so that doesn't mean that all of these things can't have really positive impact, but it's really hard to compare to other eras because of how quickly things are changing.
Yeah, that is very true, and that is, I would say, especially for some of these more minimally invasive
pull back
procedures,
again.
Is, to me, I
think
that is a fascinating aspect of AI that no one can argue is necessarily a bad thing if you're able to just make less, frankly, mistakes, as there's a human
and
element.
Potentially cheaper if it's more scalable, and
right.
Once you have that machine, if it doesn't need a ton of maintenance, that it can do things quicker, higher success rates, scalable, potentially, you can see the positive impact. So it doesn't need, somebody who's got a medical degree to make the argument.
Yeah, no, I completely agree there. Now, our last name today is Okta, which is seeing actually some analyst favorability. Steven's upgrading shares to overweight from equal weight. Price target raised to 120 from 97. As this analyst did cite the increasing probability of growth acceleration materializing now over the course of 2026, and what they view as an attractive risk and reward setup. So in 2026, they do expect cybersecurity to remain a durable growth area, supported by stable and resilient demand, this overall demand environment. And so, pretty optimistic note. This name was actually initially slightly higher on the session, at least this morning, but now with the overall market has pulled back, and I was actually shocked to see it hanging on by a thread, because cybersecurity is the area getting hit hardest today. But and the note was ill-timed. I think that it would have probably been read more significantly if it wasn't a day where we saw such news in cybersecurity. But I do think that this is still a pretty optimistic take for the remainder of 2026 on a lot of these cybersecurity names.
Yeah, an important part of cybersecurity too, right? The identification and authentication, space that is going to be so critical when it comes to all the things that are moving through computers, and AI is only accelerating that. So, yeah, you can understand the bullish case for some of these names. They announced a $1 billion stock buyback program on the 5th as well. And to your point, it's going to be hard to outperform as a tech stock today when you have as much pressure as you do in some of those big time names.
Yeah, and so unfortunately today has succumbed to the overall market, but at least a more modest decline than what we're seeing in a lot of these tech and cybersecurity names. So we'll leave it there for the top of our show today. Now, coming up next, it's time to discuss the ongoing drama and the saga between Netflix as well as Warner Brothers and Paramount Skydance, as Netflix is working on some of these revised terms for its Warner Brothers bid. And so we'll dive into that as well as some key technicals to watch coming up next. I swear I didn't see it.
Stay connected to what moves markets. Download the Schwab Network app and stream live coverage wherever you are.
What's up, Carl Nation? It's your #1 broker with the best full-service wealth management skills in the biz.
Actually, I'm seeing something from Schwab.
Uh-oh.
Yeah, Schwab lets you invest and trade on your own.
And if you want, they can even manage it for you.
Not to mention, Schwab has a team of specialists for taxes, insurance, and estate planning, all with low fees.
We're experiencing technical difficulties.
Carl.
Schwab, a modern approach to wealth management.
Whether you're a bull or a bear, you'll want to catch the latest market action on Morning Movers with me, Diane King Hall, live from the floor of the New York Stock Exchange, only on Schwab Network.
Welcome back to Next Gen Investing. It's now time to look at the technicals and some example trades in two of our biggest names in the media landscape, Netflix and Paramount Skydance, which are going a bit head-to-head at the moment. But joining us now for some more insight into the technicals we're seeing in both
They
of
are,
these
you
names
say.
is Ben Watson, our chart master for us. And so we'll start things off here, Ben, with Netflix, which is right now working in these revised terms for its Warner Brothers bid. We will not get into all of that, though, because this saga, I'm sure, we'll continue to discuss as we have been throughout the network. But walk us through what you're watching here from a chart and technical perspective.
Yeah, you know, Jenny, I was listening to your conversation with Alex and thinking, well, if AI takes all of our jobs, maybe we'll have more time to sit around and watch Netflix. But maybe that becomes a self-defeating prophecy as well. But looking at the price of this stock in the last couple of weeks, and you're absolutely right, the conversation and the narrative are ever changing here in this dance that they're doing with Skydance Paramount. But seeing this today, this big bearish engulfing candle, that's the first thing that stuck out to me, was the fact that today's candle opened quite a bit higher and is now open, or is now
Talking
moving
candlesticks.
significantly lower than the range of yesterday's candle and the day before, and really, in fact, the size of the previous 4 or 5 candles. So starting to see a little bit more volatility playing out here. I think from a trend direction standpoint, it's clear to see that overall intermediate to long-term trend has been down, and in the last week it's broken below that support level at around the 93 mark. But it's kind of falling now right in the middle of this range between previous support. So if you look left to confirm what's going on right, you see that there's that support level sitting right about the 85.5, 86 level. And you also see the RSI down in that lower portion of the panel continuing to move to the downside. So I think there's definitely some bearish elements, but there is, looking on that bearish perspective, some potential support sitting there right at 86. Okay?
So to be a fair assessment to say then, I mean, you know, we've obviously seen a pullback. We're down about now 34% from the recent highs. I mean,
Right.
that despite that this name, I still do tend to see Netflix on days when, I mean, the overall market is lower, that Netflix is somehow fairly resilient. I know that this whole saga with Warner Brothers has put a dampening on that, but when you look at the broad trends, I mean, like, there's still some optimism as far as even the recent weakness we've seen.
Yeah, I think there is still a little bit of optimism, right? You look at the course of the time frame that the stock kind of went sideways along that 93 level as a support level before it broke down through. And there were some kind of bounces and some momentum shifts. There was, in fact, a little bit of a bullish divergence on the RSI as it was bouncing along that 93. And then as these deals started to kind of play themselves out, changed once again, as the ground shifted underneath them, it kind of fell out from below them at that support level. Now, does that make it strongly bearish? I don't know. I mean, I think you've got an area that's been double, triple tested in that 86 that could potentially be a backstop. But that's, of course, never a guarantee when we're talking about technicals.
No, absolutely. And today, another day of weakness, down about 2.3%. So appreciate that, Ben Watson. And now as we do think through trading Netflix here, Alex, and of course for example purposes only, but say leaning into the fact that, I mean, Ben did highlight the recent bearish activity, again, a pullback from highs, and the fact that, I mean, like $86 level, he mentioned it looks somewhat compelling, obviously would imply some further downside from here.
Yeah, earnings next week as well, and so say you look at sort of what options are pricing in for a potential move, it's somewhere around $8 at the moment, and so if you take that for what it is, bearish target would be $80. Well, at late 2024, early 2025, kind of spring 2025, those low 80s, 81-ish, acted as a level of support. And so combining those two, I looked at an 80 put calendar, selling the January 23rd expiration, buying the January 30th expiration, looking to spend 25 cents for a debit. So the relatively smaller trade and one that looks for precision to move into that low 80 range, with the best case scenario being a move towards 80 by the end of next week, perhaps post earnings. But all in all, Max lost $25 per spread here, Jenny. Very customizable, but looking for the trend, unfortunately, for Netflix bulls to continue with this example.
Yeah, and so now to shift gears into, of course, its rival for the overall takeover of Warner Brothers, that being Paramount Skydance, which has actually still held on to a 13% climb over the last 52 weeks or so, but we pulled back also 42% from highs seen in this name earlier this year. So, Ben, as far as this technical picture, walk us through your thoughts.
You know, there are a lot of similarities here, Jenny, between Paramount Skydance and Netflix. And I think, you know, you look at not just content creation, but at least the trajectory of the stock. And it seems that Paramount Skydance, you know, late to the game. I mean, this is a relatively new company coming together in the combination of those two, but you see them kind of falling off here just about the same time, perhaps, that Netflix really started to make the move. The purple line that I've got on there, that's a comparison line with Netflix. So you can see the relationship in terms of that trend trajectory from really the September timeframe on. These two have been very, very closely aligned. And as one moves down, so does the other. Maybe that's just the nature of the streaming space, but you see other names in that space that aren't doing the same thing. These are closely tied together. But Paramount Skydance kind of sitting right at that support level around the $12 mark here. It's got some resistance overhead, kind of in a similar place to what we saw on Netflix. In this case, proportionally, this is about the $13.25 range. This is obviously a smaller price stock. It doesn't move as significantly in terms of its incremental movement, but the RSI also sitting kind of down in that lower portion of its range, that potential reversal zone. The one difference that I note here is that this is already sitting on a support level. Netflix has some room to continue to move to the downside to get to a significant support level here.
Okay, and so when, of course, we assess both of these names, I mean, does one downtrend give you more concern than the other? Because both of these names, with, of course, their news in the last several months, both, I could say, is the safe contributor to some of the weakness.
Well, I think it's a point that needs to be made here is that Netflix is significantly, even though that longer-term downtrend exists, Netflix is significantly less volatile, both historically and also looking forward in terms of implied volatility, than Paramount Skydance has been. You look in the August timeframe and the September timeframe, and you see some big upward movement. You also see some big downward movement. So the fact that this is sitting on a level of support, if this deal changes, that could break this below or above that level very, very quickly. And the other thing to keep in mind here is that these two moving averages, the 50 and the 200, have not yet crossed. On Netflix, we saw that death cross that happened a few weeks ago. That has not yet happened, but it is certainly approaching. I know it sounds ominous, but it's usually late to the game, and after it happens, it's oftentimes a harbinger of a bounce, Jenny.
Yeah, and seeing actually a move to the downside that's somewhat outperforming the overall market just based on the broad weakness across media and tech. So at least today it's not taking it on the chin, but 42% contraction from its highs is a pretty substantial repricing. So we appreciate that, Ben Watson, our chart master today. And now, last but not least, Alex, as we look at Paramount Skydance for example purposes, again, a pretty downbeat trend we've seen as of late.
Yeah, a strategy that many traders look to, but we don't often talk about, is just buying a call, and that's what we looked at here. So it's very counter.
I do it.
But it is risky.
I talk about it every day, man. What are you talking about?
Some sort of news or optimism or change.
We're waiting for the breakout.
Pop. This is a trade that could potentially pay off dramatically. It has uncapped upside potential. Max gain is unlimited. Its max loss is going to be the debit spent. In this case, I looked at the $12 strike March 20th expiration.
69.02's next. 9.03 or 02. Yes.
To break even, simply add that debit to the strike, you get 13. So you need some help from the market. But Jenny, the idea being this is 65 calendar days away. a little bit further away so that time won't be working against this position as dramatically as a shorter term option, but for that you pay a little bit more for the at the money call, looking for a rally over the next 2 months.
Yeah, and looking for hopefully some conclusion or at least some developments as far as the latest, as the bidding war does seem to not be halting anytime soon. But we will leave it there for Chartmaster today. Coming up next is time to dive into the cybersecurity stocks that are seeing some shakeup as a result of the policies implemented or expected to be implemented by the Chinese government. So substantial weakness today. We're seeing Palo Alto, Fortinet, as well as Broadcom's VMware.
For instant reactions, earnings breakdowns, and hot takes that teach you about stocks and markets, follow me on X at @NPetalides and connect with me, Nicole Petalides, on LinkedIn, Facebook, and Instagram.
Trading at Schwab is powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim Desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
Live from Chicago, this is Trading 360. I'm Marley Caden. We track macro forces, market trends, and company news that shape investor decisions, all with expert analysis and actionable context. From inflation data to sector rotations, earnings to policy, it's a comprehensive view of the market every trading day. Trading 360, in-depth market coverage straight from Chicago. Weekdays at 11 a.m. Eastern on Schwab Network.
Stay connected to what moves markets. Download the Schwab Network app and get live coverage wherever you are.
Hey, Dad. I have a question for you.
Sure.
When did Granddad first start investing?
Granddad had an account with Schwab before there were branches in the area. He really started with nothing. He worked hard, and after he passed away, the torch has been passed to me, and my advisor, Jennifer, she was with me with the journey, helping with the estate distribution. The 2 grandchildren planning for their college educations. Someday it'll be their turn.
Welcome back to Next Gen Investing. It's now time for FOMO. Today, unfortunately, the FOMO feeling a bit to the downside, and that is actually putting it lightly, as we're seeing some substantial weakness today in cybersecurity stocks dropping on news of this reported crackdown by Beijing. So joining us now is Marley Caden, host for the Schwab Network, for some insights here. And so Marley, particularly these names, Broadcom, Palo Alto Networks, and Fortinet are the ones seeing the most substantial hit, and obviously the ones that were named, of course, in this report today.
Yeah, we're seeing Broadcom down about 5.75%. Palo Alto is down about 1%. And Fortinet down about 2.3%, after Chinese authorities have reportedly told domestic companies that they have to stop using cybersecurity software from about a dozen U.S. and Israeli firms, citing national security concerns there. Broadcom-owned VMware, Palo Alto Networks, and Fortinet are among those U.S. firms, like you mentioned, Jenny, that have been banned, while Checkpoint Software Technologies is among the Israeli companies. That's according to Reuters sources. These sources say that Chinese regulators are worried about the software, that it could collect and transmit sensitive information abroad, though it remains unclear how many companies actually got this notice, which they say was issued sometime in recent days. We did see shares slip pretty broadly for cybersecurity on this note, but there's been no comment from Chinese regulators or any of the companies named in this report. Beijing has been sort of widely accelerating its efforts to replace Western technology with domestic alternatives, while boosting domestic cybersecurity firms like 360 Security Tech and Newsoft amid rising trade and diplomatic tensions with the US. We also, of course, this week got the chip restrictions note on NVIDIA that it's also reportedly limiting imports of NVIDIA's high-end chips, the H200, to special circumstances, citing similar national security concerns there. Many viewing that as a potential leverage point in trade talks. But the politics surrounding foreign cybersecurity vendors has been increasingly sensitive. Chinese analysts warning that Western tech could be vulnerable to foreign surveillance or hacking. And to prove that point, Check Point, one of the company's name, published a report on an allegedly Chinese-linked hacking operation against an unidentified European government office last month. And in September, Palo Alto published its own report alleging a Chinese hacking effort targeting diplomats worldwide. So some greater implications here, but we are seeing, a move to the downside as this could affect an industry more broadly, particularly for these U.S.-based companies and the Israeli companies.
Yeah, and I do think it's interesting, especially because of the reports that we got out of yesterday, really, that the regulators had been meeting with these Chinese tech companies and trying to basically navigate the whole NVIDIA H200 situation, which has also been an ongoing headache, I think, for NVIDIA. But it seems like the demand is definitely there. It's just, unfortunately, the pawn that is being played right now back and forth between the U.S. and China. And so, I mean, as you think about trading these days, Alex, I do always tend to see these days of substantial pressure as perhaps opportunity. That's not always the way of thinking. Obviously, you could always see another session tomorrow, weakness, but I do think of these names as real leaders in the cybersecurity world, as well as then the charge for AI, because you have to have cybersecurity if you're going to have increased AI presence, across the board.
Yeah, and TD Cowen noted that for several of these companies, of which Fortinet was included, only about 1 to 2% of the company's sales are actually taken from China. So the actual impact may not be as scary if you buy into some of that thinking than the headline suggests. And so, for an example trade in Fortinet, I looked at a neutral to bullish strategy, selling a put vertical below the market. It's the 70.65 put vertical in the February 20th expiration, looking to collect $1. Max loss is 400, max gain is 100, break even $69 per share. So 4-to-1 risk reward definitely leans more into the higher probability of success. But with that, a risk-defined strategy that looks to take advantage of the dip in the shares today, perhaps because, as TD Cowen notes, this may not be as big of a deal as it reads on paper.
Yeah, and I will say that this is one story we'll continue to watch, because I do think it, again, could have broader implications than just these names that were specifically called out. It is definitely wide-reaching across the tech, but these are still very important names in the cybersecurity world. So we'll leave it there, of course, for FOMO today. Now coming up next, we will discuss some of the moves that we're seeing today across everything with Bitcoin exposure, as we're seeing CleanSpark, as well as Bitcoin continuing to really drive at least some outperformance today. Bitcoin futures now about 2%.
Believe me, when it comes to investing, you'll love Carl's Way. Take a left here, please.
But there's a...
Carl's Way is the best way.
Is it? At Schwab, how I choose to invest is up to me.
Exactly. I can invest and trade on my own.
Yes, and I let them manage some investments for me too.
Let's move on, shall we?
No can do.
I'll get out here.
Where are you going?
Schwab.
Schwab, a modern approach to wealth management.
Stay connected to what moves markets. Download the Schwab Network app and stream live coverage wherever you are.
Morning Movers brings traders the biggest headlines to start the day, from volatile overnight swings to the earliest analyst calls. Get your watch list ready. 8 a.m. Eastern, Morning Movers, only on Schwab Network.
Hey, Dad. I have a question for you.
Sure.
When did Granddad first start investing?
Granddad had an account with Schwab before there were branches in the area. He really started with nothing. He worked hard, and after he passed away, the torch has been passed to me, and my advisor, Jennifer, she was with me with the journey, helping with the estate distribution. The 2 grandchildren, planning for their college educations. Someday it'll be their turn.
Welcome back to Next Gen Investing. It's now time to discuss the move we're seeing today in CleanSpark, announcing earlier today that it has entered into this agreement to continue to acquire some substantial amount of land to really expand its transmission facilities. So joining us now is Diane King Hall, the host of Morning Movers, for some more insight on this story. And one pocket of strength that we are seeing today has been everything tied to broader crypto. So Diane, walk us through the latest here from CleanSpark.
And this is actually going beyond crypto. So you're seeing a spark for CleanSpark today. Those shares rallying, as you mentioned, more than 5% right now. So it's buying a massive amount of land in Texas, 447 acres of land. That's a lot of land. The goal here is to build out AI and high performance computing data center for this. So this is about their expansion beyond Bitcoin mining. CleanSpark, as we know, that has been the space that they've been in. They're best known for that. But this is essentially showing that there's a strategic pivot that is happening with regard to CleanSpark. They're moving toward this energy-backed digital infrastructure play, and that's what this is here, targeting AI and the growth that's expected to come here. So with regard to Texas, this is the second major Texas project after its Austin project. So combined, the 2 sites could support nearly 900 megawatts of power capacity. So the idea here with Texas is that there's a lot of energy there, so they have the access there. There's faster timeline to permitting. That's how it's seen, relatively speaking. And then, of course, we know that there is strong demand from AI and power players in this space, so they're leaning into that. The deal is expected to close in the first quarter of this year, so soon. And the CleanSpark says they're talking with potential AI and compute partners to co-locate on the sites. Jenny and Alex?
Yeah, and I mean, the same now rallying over 30% so far this month, up another 6% today. So definitely seeing, again, a story that's even just outside of Bitcoin, but continuing to develop in a high growth space. And so it's nice to talk some names moving to the upside today, and we needed that. So appreciate it. Of course, host for the Schwab Network. But now to continue our broader crypto conversation here, we are joined by a special guest in studio today, Brandon Corpelis, CEO of Sovereign. And so, Brandon, I think there's something metaphorical about the fact that we are seeing such weakness in the traditional banking stocks today, and then you, of course, made a transition to leave banking after 20 years to then go all in on Bitcoin. And so what really made you make that decision? And, of course, thank you so much for joining us today in the studio.
Yeah, well, thank you guys so much for having me, first of all. And yes, today is a microcosm of what's going on in the broader world. I try to avoid the day-to-day chart watching and that kind of stuff because really Bitcoin is a long-term proposition, a long-term saving proposition, a transition from an old monetary standard, the fiat monetary standard, which was embarked upon in 1971 when we ripped ourselves off the gold standard that was in place, then less in place, and then completely not in place as of 1971. And once you realize this trend, once you understand what's going on, once you understand Bitcoin as a hard money, as something with a finite cap that can't be debased, and then you look around the world at all the fiat currencies of the world and what the central banks are doing to those currencies and debasing them, you realize that you've stumbled upon something that only a small group of people in the world have yet to understand. And I kind of felt a calling to leave what I was doing in the traditional banking space, go into the Bitcoin space, and really begin to educate business owners about what's actually happening to their money. Why are they unable to save? Why can you not put cash on your balance sheet? Why are you constantly chasing the next capital project, the next hire, the next T-bill to put your money in, just to try to preserve your purchasing power into the future? And I really felt a calling to try to help business owners understand that.
Yeah, well, one thing's for sure, Brandon, I always salute those who take risk, especially in the world of finance and in the transitionary period that we find ourselves in, whether it's AI, whether it's digital assets. But I do got to ask, and how one balances this particular dynamic where Bitcoin, if we use that as sort of a microcosm of digital assets as a whole, the volatility and the returns over time seem to be more of the feature than a bug, and how that ties in to the greater, I guess, discussion about how it can serve as a payments infrastructure. Said another way, if I want to own Bitcoin because it's appreciating so much over time, or it has, why would I want to spend it?
So Bitcoin is, as you mentioned, it's both a medium of exchange and a store of value. And the reality of the situation is, if you're spending dollars, that just means you're short Bitcoin. I don't have any dollars. I spend on credit and I pay my monthly bills by selling a little Bitcoin. And so I don't actually hold any dollars, because if I'm deciding to pay for something in dollars, that means I need dollars. And I don't want dollars. I don't want a depreciating currency. I don't want to be subject to the whims of debasement. I want to have
SPX is depreciating.
my wealth. And I would prefer to spend a better money if available, but hold my savings in a better money. And so as Bitcoin is volatile and it does fluctuate over time, the longer you hold Bitcoin, the less subject you are to that volatility. So I always tell everyone, this is a 5 to 10 year plan, not a 5 to 10 month plan. And as you start to accumulate savings in Bitcoin and make that your store of value, then it can become your medium of exchange. And you're really not worried about the volatility, because you acquired it at a point earlier before where it was so much lower, it's completely irrelevant to you today as you're spending the better form of money. And another thing too is merchants that accept Bitcoin, I want to reward them. I want to reward someone that is willing to see the future of money, that is willing to accept a better money. And also it saves the merchant money as well. And every time you swipe your credit card, it's a 3% fee. I can send money to a merchant over the Lightning Network for a 0.03% fee. And so that adds value to the business owner as well. And I like to have personal communal relationships with the business owner I'm transacting with.
So right now, I do think that a hurdle from just maybe like a personal standpoint is, again, navigating that volatility depending on, of course, the price you buy into. But as looking at small to mid-sized businesses, what are typically the biggest hurdles you see that they face when trying to add and, of course, just adopt and really just continue to utilize Bitcoin?
Yeah, the volatility certainly is an issue, but that can be managed by position size. So if you're a business that has some seasonality, or you're not completely convicted about Bitcoin, just start with a small amount. Put 5% on your balance sheet, put 10% on your balance sheet. I usually like to say, whatever we're going to put in Bitcoin, I don't want to talk about it for another 5 years, unless it's about utilizing it or putting it to work. But if it's just about what's happening to its price or what's going on in the market, that you need to ignore all of that. And let's talk again in 5 years. And so you take the volatility, and Bitcoin itself is not volatile. Bitcoin is incredibly stable. Every 10 minutes, we know exactly how much Bitcoin is going to be issued. The monetary protocol of Bitcoin is one of the most stable things out there. It's guaranteed. It's open source software. It's being enforced by tens of thousands of people running the software across the globe. And there is nothing less volatile than the Bitcoin monetary protocol. However, when priced in fiat currency, the current monetary system, it has some volatility as its unit of account that it's being denominated in fluctuates significantly. But again, that can be mitigated by position size, understanding, conviction, and then financial planning around that. Let's talk about, what are your plans in 5 years? What are your plans in 5 months? And how do we get your position size and set your company up to be in line with that?
Yeah, no, this all makes a ton of sense. It's just hard, right? It's hard to get from where we are to this vision that you're describing, especially because of some of the things that we talked about from hurdles. But it's an industry that's right for disruption.
25s don't look too good.
You can definitely make the case that this is going to be maybe a thing that reaches a tipping point quicker overseas, and the concepts prove there first. Is that fair to say?
It's possible. We also are building the best infrastructure here in the United States. I had a conversation with someone in the space this morning, and he was doing some work down in Brazil, and he says, they're 3 to 4 years behind the United States. So for all the problems we have going on in this country, we still are the tech leader in the world. We are the most innovative country, and we're bridging gaps. Square just rolled out their terminal a couple months ago, and immediately 4 million merchants can start accepting Bitcoin with the switch of a button. They don't have to understand the network. They can even have it converted to dollars if they so desire, but at least the option's there for them. And we truly are innovating at an incredible pace that I could see the acceleration in the United States happen first, just because we're innovating the most here in terms of the UX and the UI that's available. However, I could see the other argument where you look at Iran, where their currency basically went to zero overnight. And if they had some Bitcoin, or people in that country had Bitcoin, obviously the use case is self-evident. They don't need to read the Bitcoin standard or the price of tomorrow or the bullish case for Bitcoin. They just know that one currency went to zero, the other didn't, and the one that didn't go to zero they can spend on their phone. So I can see both scenarios playing out. How it actually does play out, I don't know, but it will.
We're at another resistance
over time.
Yeah, and I do think
if we break this could be big news here.
Contrast with what we're seeing right now with an unknown credit.
But right now you're at the 200 EMA. So if you break it, you break it, we got 69.20 area, 69.17 to be safe. Let me see a little bit of resistance right here, where we are right now. If we break that, I think we can go a lot higher. Okay.
Some mixed analyst feedback here, as Rivian typically does have more polarized opinions, but we pulled back now about 24% from these recent highs. What's driving today's pressure?
Yeah, and I think we talked about this when the stock was making its most recent run to the upside, and it happened based on some very positive news associated with a few factors. Every time we talk about Rivian, the challenge really is production volume. They seem to be really stuck beneath the, between 50 and 60,000 unit volume production. They are scaling up their production accordingly in the next 5 years to over 200,000 vehicles eventually. But that has really been the problem for Rivian because prices have to remain very high to offset low production volume. And we know prices right now in terms of affordability have been challenging. So nonetheless, that's creating a problem for Rivian's profitability as well as their cash burn problem, which is still a problem. If you look at, top line sales last year to 5.8 billion, they lost about $3.5 billion, and so essentially the cash burn is essentially putting pressure on the shares. Now, going back to we saw a run up in late 2025. Coming into this year, there was some positive elements to Rivian's technology. Essentially, they launched a new AI chip, more in line with their own software, kind of competing with Tesla's robotaxi. They said it was either a $2,500 upfront charge or a $49 a month charge for that service. Now, you have to consider what's happening here in terms of scale compared to Tesla. This is important because I suggest this is the reason why we're seeing some downgrades today from UBS, which is now rating the stock as sell, but they did increase their price target to 15 from 13. Tesla has a production volume of over close to 2 million units. They have been down over the last couple of years, and they've talked about this. They have millions and millions of miles driven in data collection to essentially have the robotaxi or full self-driving software. The challenge for Rivian is that they can launch a software, but it may not necessarily be as scalable or as good as Tesla's full self-driving software because they don't have a history. And Tesla has that history. They have a long-standing history of data collection and, of course, adapting their technology for full self-driving faster. It looks like Tesla, again, this is why the Tesla bulls are still intact with the name, will eventually be licensing that technology to other companies. Maybe in the future they'll license it to manufacturers like Toyota, but maybe even to Rivian. So for what it's worth, Rivian did make some progress in terms of launching their own full self-driving software. But one would say that it's not necessarily close to where Tesla is just because they don't have longevity. The units that are driving out there, the number of vehicles out there, plus the data collection progress that Tesla has made over the past decade.
Yeah, and I will say that I know they're oftentimes compared, obviously, in different points of their overall profitability journey, but today, a pretty substantial downbeat session, and it's been chopping around, but actually, towards the back half of 25, Rivian looked pretty solid, so we'll see if we can recover some of today's losses in the coming days, but appreciate it. George Tillis, Senior Markets Correspondent for the network, and that will also do it for Alex and myself for Next Gen Investing for, of course, this Wednesday. We're actually seeing the Russell slightly higher now to close things out. Appreciate you for tuning in. The watch list is coming up next.
I'll be
Schwab
right
Bank
back. Oh,
Investor
we
Checking,
broke.
The checking account built for investors, named highest in client satisfaction by J.D. Power
We're
for
not
7 years in a row.
$1.10.
With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and
Here we go,
start
120.
investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
Bingo.
Get inside
150.
the minds of pro traders.
My point is
Give it
that
to
they're
me.
getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news,
Closing in on the VWAP on /ES.
With shows built for action, we break it all down in real time.
Marley.
Accuracy.
We're getting rich.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists. Streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com.
Mom, when my grandparents moved here, did they know what our family would become?
I don't even know if they could envision it, to leave everything behind, literally come across the entire world. I think that we totally met what their wishes were. Schwab has been with us for almost 25 years through purchasing our houses, opening up our business, having children. They've always been there for us.
I want to invest with a company that can help me give my family a happy financial future.
Oh, he's a smart guy.
Stay connected to what moves markets. Download the Schwab Network app and stream live coverage wherever you are.
Okay, we'll give it another shot. Go higher and higher.
Good afternoon. Welcome to the Watch List. I'm Nicole Petalides. So glad you're with us. It's 2 p.m. Eastern Time. We're live at the New York Stock Exchange right here on the floor on the corner of Wall and Broad. And we have a big show for you today. We are seeing selling across the board for the major averages. So we're down 2 of 3 trading weeks, but did hit some records recently. Unusual options activity for Taiwan Semi, Intel, Macy's. We'll show you some real trades. Ken Polcari joining me right here at the desk. Kenny always has a lot of energy. I'll talk about the markets, the state of the economy, give us some of his picks. And our panel will dive into the retail sales data that we got, showing what the consumer will and will not be spending on, it seems. In the meantime, we have 2 hours left in the trading day. We do have some down arrows. The S&P is at 6904. Whatever to 7,000, we were so close, but nope. Down 60 points here. The NASDAQ 100 down 1.5%. Tech is getting hit hard here. The worst of the bunch. The Dow is down 1/3 of 1%. The small caps are actually squeezing out a gain right there, gaining 0.2% of 1% overall. Oil and gold, well, those are both higher. Gold is up $48 an ounce, and oil's at the highest in a few months, 3 months. It's at 61.87 the barrel. The VIX at 1733. The 10-year bond yield continues to come down. It's moving. I mean, it was just right around 420 yesterday and 419 this morning, and now it's at 414. So keep an eye on that. Bitcoin 97,000. That has been moving higher. It's very significant to note the recent momentum we've seen in Bitcoin. All right, let's break it all down. Senior markets correspondent Kevin Green joins me now, and we are seeing the biggest laggard easily now in the major averages, and that is all about tech and China.
Yeah, we are getting some news around China here, Nicole. And one of the big headlines this morning actually was the fact that China has now encouraged its own companies in-house to stop purchasing and stop utilizing U.S. as well as Israeli-made cybersecurity platforms, if you will. So this is actually having an impact when it comes to Palo Alto Networks, Fortinet, as well as other companies here. Now, this is due to national security concerns, which is what they are citing, and we are seeing the software names as well as the cybersecurity names move to the downside here. Now, we haven't had a true confirmation as of yet, but it seems like the market is trying to get ahead of this story just a tad bit, and this is just another item that's just on the radar when it comes to China and U.S. trade relations. Is this going to be a barrier for us to try to renew some of the hopes of reducing these barriers into 2026? It seems like it's escalating rather than de-escalating. So you are seeing a lot of these shares moving to the downside. It will have somewhat of a meaningful impact if this is going to be the case moving forward for a lot of these companies when it comes to earnings power and their financials just in general. But a big headline mover here today, which is another reason why, once again, technology just in general has been the key laggard for the S&P 500 as well as the NASDAQ 100.
I saw Palo Alto down 1%, Fortinet down 2.5%. I'll also note that NVIDIA is down today about 2%. Also, the concerns about whether or not China would accept the H200 chips, too. I think that's been under some scrutiny. Let's talk about some of the financials. Bank of America, Citi, Wells Fargo, all reported numbers today. Not all bad, but the lower stocks right now.
Yeah, we are seeing the buy the rumor, sell the news event when it comes to these financial stocks, especially when we had JP Morgan provide pretty decent earnings yesterday, and that was followed up today with Bank of America, which for the most part actually had a pretty decent earnings announcement. Both top and bottom line did beat, and their guidance moving forward for the most part was actually in line with the street's expectations. But once again, you are seeing maybe some headwinds, maybe some concerns when it comes to new credit card policies that could actually impact the industry as a whole. If you are looking at maybe some of the weaker names that we're reporting today, you could make the case that it was actually Wells Fargo. Wells Fargo did miss on the top line when you're looking at revenue. That was reported at $21.29 billion. She was looking for $21.6 billion. Now, they did exceed on the adjusted earnings per share, having that come in at $1.76. She was looking for $1.67, but net interest income was actually a big headwind for them. Now, that might improve if we continue to see the short duration as well as long duration treasury bonds, that spread continuing to widen out. That should actually be a benefit for Wells Fargo here, but you are just seeing this selling event when it comes to the financial. This is kind of par for the course. I mean, the last couple of quarters, we actually did see financials holding up after earnings, but usually we do see a lot of these stocks actually selling off, and a lot of them are actually trading at pretty extreme multiples or premiums compared to their 5-year average.
All right, and you know, as I think about what's going on here, I said we were down 2 of the last 3 trading weeks. We just hit some records on Monday for 3 of the 4 averages. We have 2 hours left in the trading day. I do see up volume actually exceeding down volume, which I can't believe my eyes when I look up there, because it doesn't feel that way necessarily when you look at the major averages. I mean, I just put in the NASDAQ 100 to take a look, because really we're seeing tech getting hit so hard. Pretty much every single name is down between 1% and 4% in some of the big names that we follow. What are you looking here this last 2 hours of trading?
Yeah, I mean, you mentioned, we have over 50% of the stocks in the S&P 500 in the green so far. We are seeing a pullback to a key level here. The 6,900 level is going to be key for the S&P 500. We're basically coming back and retesting the 20-day moving average. Now, if we're kind of looking at it over the last month and a half or so, when we do test it, usually we do get some buyers to try to step in here. But some of the technicals are starting to maybe turn here a tad bit, especially if you're looking at that MACD. It is hinging to the downside, but we are still keeping the overall structure of higher highs as well as higher lows. And Nicole, just keep your eye out on the Mag 7 names. A lot of those stocks are now in close to or are in correction territory. So the 493 is actually holding this market up and keeping us near all-time highs, as the Mag 7 is kind of pulling back fairly aggressively here. And I would not be surprised that we do see some erratic behavior for the last hour of today's trading session, maybe some short covering events taking place. And if not, and we have a breakdown, you could make the case that the next key area of support for us is 68.50, and we are actually seeing those puts gaining a little bit of traction when you're looking at the buying volume.
All right, well, good to know. Thank you so much, Kevin Green. Great to see you this afternoon. Appreciate it. Let's take a look at the bigger picture. Andrew Graham's with us, managing partner, Jackson Square Capital. Thank you for being with us. We were just noting that even though up volume is surpassing down volume, you are feeling like it's super negative today because you're seeing all these tech names down. For example, I was just looking even at Intuit, which is down, almost 7%. So all the Mag 7 names are under pressure, but, is this a buying opportunity type of day? What do you think about this first quarter of trading?
What we've seen so far is a continuation of the December trend, which was towards cyclical value and small cap stocks. This has been the strongest opening for any year of the Russell 2000 versus the NASDAQ 100. So that is going on right now as we speak, and I think that the Mag 7, the tech names are sort of under pressure from sentiment. But as we get into earnings season, as we have to sort of justify the consensus earnings growth on the Russell 2000, which is currently 60% for 2026, that's, I think, when it's possible that those names will kind of consolidate, they'll hang back, and people will start to reward the real earnings growth, which we feel is within tech and specifically networking equipment.
So, I mean, I had a guest on today who liked the small cap value, looking at IWN. But what's interesting here is we've had 3 years of double-digit gains. There's still a lot of big bets on the AI revolution and AI spend. You know, are you sticking with tech and other sectors? I mean, what does your portfolio look like?
What we have added some maybe cyclical aspects of tech. So you think of analog semis. So microchip and analog devices are names that we've added recently to the mix, right? They have a cyclical exposure, of course, within tech. But in terms of like digging deeper into the cyclical exposure, like commodity chemicals and things like that, we haven't seen any evidence that that's the case. You've got a little geopolitical risk premium right now that's building in oil prices, and that clearly helps companies like Dow and Lyondell, which have like bumped up here a little bit. They have like huge dividend yields, and if you get a real cyclical acceleration, those stocks will double in 9 months. So it's something to pay attention to, but I don't think it's happening yet. And when you look at the U.S. Economic Surprise Index, which is running at like +4 or +7, I mean, just a month ago it was at 22, +22. So we're going to need to see some more economic surprise in order to justify the rally that we've seen in cyclical stocks. And yeah, it's our preference to get the upside from earnings growth, and that earnings growth, in our opinion, comes from the networking equipment names.
Let's talk about a name like Amazon, which is down 2% today. It's off the $258 high. It's at $237, right? So, you know, $20 off the high. Opportunity here? Why?
Yeah. So Amazon, I think, was up 5% in 2024 and 5% in 2025. It's really been the Mag 7 laggard that really stands out. December is usually a terrible month for Amazon for whatever reason, and January is a really good month for Amazon. You also see a lot of strong consumer trends right now. There's tax cuts, of course, that are going through. You've got other reasons to be bullish about the consumer, the middle income consumer, and maybe lower income consumers. And you know, you've seen it in Wayfair, you've seen it in Etsy and all these other maybe online names, and you haven't quite yet seen it in Amazon. But Amazon has 2 feet, right? We've got one that's in the consumer group, and we've got the other one that's over here in tech. And when they report earnings in February, on February 2nd, I believe, it's going to be about AWS growth, and I think the buy side bar is 21.5% year-over-year growth in AWS, and I suspect they'll get that and a little bit more. Plus, you get the consumer going here. I just think this is the time to own Amazon. I think it's going to be the Mag 7 outperformer, at least for H1 26 for the first half.
And then you looked at a name like Cisco Systems, which people loved for a while. I mean, it was just so great. But lately, it's been in a sell-off. For example, on the 10th or 9th or 10th of January, we were saying how it was down 9 consecutive days. It felt pretty sort of, you know, a moment. You hadn't seen 9 consecutive selling days since 2015. So what happened to Cisco Systems, and why is it now buying opportunity?
I think the reason to buy Cisco has been coming from the people who are actually installing the equipment, right? Cisco's changed. It's not your mother's Cisco anymore. The company under new leadership has got the right go-to-market strategy. So not only do you have networking equipment for the data center, for the hyperscalers and so forth, and there is a lot of growth there for Cisco, I think the opportunity is in the tech debt that's been amassed within the branch and campus enterprise market. So all these big enterprise companies have all these branches and so on, and all that has been a huge amount of tech debt that needs to be replaced. And there's probably 3 or 4 years beyond when it should be replaced. And when these companies are looking to replace equipment inside the branch networks and campus networks, they're looking to also sort of future-proof, right, the systems. And so the smart switches that Cisco makes have a distributed firewall embedded within them. And I just don't think you can make firewall a single choke point anymore. And there's just been a big, or I guess a good amount of interest from enterprise customers in adopting Cisco's Smart Switch architecture when they're upgrading their branch and campus networks.
Yeah, and quickly on Arista Networks.
Arista, I mean, big beneficiary of scale up in our opinion. So the scale out, we're building more data centers, we're adding more racks and so forth. But in every one of those server racks now we're connecting them all, we're adding more compute, and that just drives higher connection rates for all the networking equipment names. If you're a switch company, an Ethernet switch company like Ethernet, like Arista, that's enjoyed just big market share gains in hyperscalers and data centers. I think the opportunity here is in scale up is adding more and more. The company has $2.5 billion in deferred revenue that's going to be coming off of the next 18 months. That's a freebie as well. So for us, it's an easy name to own. When we're talking about Cisco, we're talking about Arista, we're trying to talk, stocks that really haven't just taken off in the recent days or in the last, 4 months. And there's an opportunity, I think, for greater upside because of that. So we look for earnings growth from Arista to really kick in Q1 of 26, and we expect that to be probably our number one pick, our number one name for this year.
All right, so Arista, a top pick there, Cisco and Amazon, and more discussion there about the big picture. Andrew Graham, managing partner, Jackson Square Capital. Thank you, Andrew. Good to see you. Appreciate it. Coming up next, Options Corner. So we're taking a look at real options trades, options activity on news, Taiwan Semi, Intel, Macy's. We'll be right back.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Real-time access, data-driven analysis, from U.S. equities to global macro matters. Schwab Network connects the dots. Watch live, subscribe free at schwabnetwork.com.
All right, welcome back to the watch list. Time for Options Corner. We welcome in Tom White, host of Fast Market here on Schwab Network, taking a look at a market now that's digesting some of the Fed comments in the book, the beige book, also everything that is volatility and a gyrating market here, Tom White. And we're waiting too on earnings from Taiwan Semi. In fact, this week, tell me, you found a trade on Taiwan Semi that you're going to share with us here.
Yeah, pulling back just a little bit here, but just over 3% below those all-time highs that we hit just in the last week. So expectations are pretty high. Remember, Taiwan Semi reports monthly sales, so you got a little bit of clarity on what they've already done for the quarter going into this report tomorrow morning. The stock's up about 62% from year-ago levels, up about 7% so far this month. So the expectations are high. There was an article that came out earlier today out of the information that basically stated that, hey, NVIDIA went to Taiwan Semiconductor, AVGO, some other chip makers went to Taiwan Semi and said, hey, we need to ramp up production. Can you take on more capacity? And they basically said no, according to this report. So that basically tells you that they're maxing out at full capacity here. Now they're trying to build out some infrastructure here in the U.S. Over 165 billion invested already into a couple of their chip plants, but those aren't going to be online for a year and a half, 2 years. So take that into consideration. The option market pricing in going into this report, pretty muted, plus or minus 4% move either way, just under $13 in either direction going into this report. But the bar's high, right? Maybe it should be because there's a lot of demand for their production capabilities as far as the advanced AI chips, CPUs, and smartphone market that's been doing really well. But I did see some bearish, unusual option activity in here today, and this was all the way out in the February monthly option. So not a pure earnings play by this trader. They've got 37 days to expiration. Trader bought over 20,000 of the 330 strike puts in Taiwan Semi. They paid a pretty hefty option premium, $16.55 per put that they bought. So what does that mean? Well, the trader needs the stock to go below 313.45 over the next basically 5 or 6 weeks. And that's about 4% below the current share price. So about that one standard deviation that the option market's pricing in on just a one-day move. So it could be a trader that's speculating to the downside that maybe, hey, this run is over. Maybe it's going to pull back post-earnings. Or it could be somebody that's hedging their long stock position that they might have in here. They're paying a pretty hefty option debit, so I would probably allay that it's probably more in the speculative nature where this trader's giving themselves over a month for this trade to work out. But taking a downward stance here in Taiwan ahead of that earnings report tomorrow morning.
Yeah, I can't wait to get that. I mean, there's been so many different stories about chips when we talk about, there was one about chip shortages. Obviously, you have the president working with Intel. There's an NVIDIA story every single day. So waiting to hear what Taiwan Semi has to say tomorrow with the numbers. So thank you for that trade. Now, what about Intel? I just mentioned the president and Intel, which gave it a boost. What do you think about the trade that you found for Intel?
Yeah, it's pushing it back against losses, especially in the tech sector today, up another 2.5, 2.8% today. And that was after 7-8% gains yesterday. I mean, this stock so far this month, Nicole, is up over 30% in the month of January, up over 150% from year-ago levels. I mentioned this one yesterday. We saw unusual option activity in here, call buyers out in the March cycle. And this trade kind of sets up that they're getting out of some of those already and rolling it into the March 60 strike calls. But yeah, a lot of positive commentary on this company over the last several months. The U.S. government taking nearly a 10% stake, NVIDIA investing $5 billion. They got a pretty good price on that one. You know, those commentary from President Trump that, hey, all these other companies came in after the government said, hey, we're going to take a stake. Intel came to them. He had a good conversation with the CEO of the Bhutan recently. So everything seems to be going right for this company, but they need to get their foundry business in order. CPU sales, almost after that upgrade yesterday, almost sold out of CPUs for 2026. So that's a positive for this company also. But I did mention, in the March monthly cycle, a trader came in today and bought 34,000 of the 60 strike calls, paid an average debit of about $2.26. So that break even where this trader starts to profit is above 62.26 over the next 65 days. So you've got some room, about 28% above the current share price, to get above that break even. Now, I mentioned this yesterday. I brought unusual option activity where they were buying the March 55 strike calls. Well, they sold out of a bunch of those. There was a big open interest position of over 50,000 contracts. They sold 34,000 of those and then bought these March 60 calls. So somebody taking some profits probably and then reallocating some of those funds to a higher strike with the expectations over the next couple of months the stock's going to continue to rocket to the upside.
Yeah, and the shareholders would like to see that because they've certainly had their share of disappointments and seen some volatility, so they would love to see it rocket to the upside. How about we talk about what's going on with Macy's? I know that Bloomingdale's was a bright spot for Macy's. We got in the retail sales numbers today. Bank of America CEO talked about the resiliency of the consumer spending. What did you find in the trading environment pertaining to Macy's?
Well, yeah, just when I saw the unusual option activity, kind of peak up, I was like, what's going on with Macy's? Why is this stock up about 55% over the last 12 months? Is everybody going back to Macy's? Well, maybe it's reflective of them getting rid of some inventory issues that they had, paying down some of their debt, maybe some of the competitive nature within the space has gone away, right? They maybe righted the ship. Maybe it's execution at this point. We've seen analysts come out raising price targets recently. Jefferies put a buy rating, $27 price target, while assuming coverage on this one. But it was kind of a head scratcher because if you look back at 2022, 2023, and into 2024, the stock was under some serious pressure due to those headwinds that I mentioned before. But we did see maybe a trader taking a position where maybe this rally that we've seen over the last 12 months is going to get extinguished here, because we did see some put buy in here. And this was out in the February monthly cycle. So you're going to capture that earnings event that comes in February. Trader bought 20,000 of the February 20 strike puts, paid an average debit of only 50 cents. These are cheap options. So the break even where this trader starts to profit is below 1950 over the next 37 days. That's about 10% below the current share price in there. Put volume today, Nicole, about 5 times normal daily average volume that we've seen over the last 5 trading sessions. So yeah, this was a head scratcher to me, but maybe the execution's been pretty good. Consumer, you mentioned retail sales came in a little bit above expectations. Atlanta Fed GDP now tracking at 5.3%. So maybe the economy and the consumer is still robust at this point, but this trader betting against any further gains here over the next month or so in Macy's.
I mean, it's been an incredible move for Macy's. It was sort of like if you weren't watching and you rubbed your eyes and you looked and said, what? You know, Macy's is up 50%. But the Bloomingdale spot of it was always a bright spot. The real estate that they had was always a bright spot. But there were plenty of headwinds for a name like Macy's, too. All these department stores, look what's going on with Saks. For example, right? And I mean, Barney's out of business here in New York City. You know, the department store business is not necessarily an easy one. Yeah. Tom White, thank you so much for being with us, especially with all the smaller, fast fashion type of things that compete with them. All right, coming up, we'll discuss alternatives to your portfolio, different things that you can think about putting in your portfolio other than the plain old stuff that you're used to. The watch list will be right back. And Kenny Polcari is standing by.
Kick off the morning with the data and the decisions moving markets. Morning Trade Live breaks down the macro moves driving the price action, from Fed policy to global growth to inflation prints and geopolitical risk. Smart, fast, and always live from Wall Street to your screen. Morning Trade Live, where the markets meet the macro, weekdays at 10 a.m. Eastern on Schwab Network.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Do you like using charts when analyzing your stocks? Our technical analysis webcast series breaks down different charting techniques like trend analysis, price patterns, moving averages, oscillators, and much more. Best of all, you can ask questions directly to an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
I'm Kevin Green, and I track options flow daily, identifying who's buying, who's selling, and how it's going to impact the markets. Watch live on Schwab Network at schwabnetwork.com.
Trading at Schwab is powered by Ameritrade, giving traders even more ways to sharpen their skills with tailored education. Get an expanding library filled with new online videos, webcasts, articles, courses, and more. All crafted just for traders. And with guided learning paths, stacked with content curated to fit your unique goals, you can spend less time searching and more time learning. Trade brilliantly with Schwab.
Welcome back to the Watch List. I'm Nicole Petalides. We're live on the floor of the New York Stock Exchange, checking out every single mover here on Wall Street. Let's talk about Rivian, which is down nearly 9%. UBS downgrading Rivian to sell. The analyst cited elevated expectations for the new R2 launch, for the downgrade. Not great news for Rivian. It's down 8%. Now, Netflix is down more than 2% after the reports have come in that the company is preparing an all-cash bid for Warner Brothers, revising that terms of the $82 billion deal to buy the studio and streaming business. Paramount Skydance has offered $30 a share for Warner Brothers Discovery, but WBD has been rejecting Paramount Sky. We'll continue to follow the breaking news on that. And we're focusing also on alternatives for your portfolio. And that's why we bring in Kyle Bergacker, Portfolio Manager at Gradient Investments. Thank you so much for being with us. So we shouldn't have the plain old stuff our parents had in our portfolio. All right, Kyle, why not? And what should we have?
Well, thanks for having me back, Nicole. Yeah, I mean, that is the question, right? It really comes down to access to private markets. Providing alternatives is really different than it's ever been, right? You've got a couple legs of the stool now that are very much different than public markets. You think about investing in stocks in the stock market. The private markets have really changed a lot over the last 20 years or so, and very rapidly in the last 2 or 3. It's kind of 3 items. The first is really access, followed by convenience and understanding. So in terms of access, private equity, hedge funds, private credit, infrastructure, real estate, they were really only available to institutions or very wealthy investors, and most.
Well, we just had a new one there.
Participate. Convenience. You know, the old structures were pretty cumbersome. Investors committed capital, $7 to $10 million over years. And then the funds would draw them down in stages. There weren't really any tickerized options for access or perpetual evergreen funds. And once you're invested, the money was locked up. You didn't really have a lot of visibility. And now it's kind of a whole new world. New structures exist, better transparency, and digital platforms are changing the game. So investors can now access private assets with those blue chip kind of household names, Apollo, Carlyle, Ares, JP Morgan, Goldman Sachs, names like that, among others, through evergreen and perpetual vehicles, and that just didn't exist before.
Right, understood. I mean, you're talking about access, convenience, and also understanding the getting the access to having private equity investments or real estate investments. How do you go about doing that? I mean, do you call your broker and say, I want to look at some alts in this way? What do you say to him?
Yeah, I mean, that was the traditional way that people used to do it. And now here at Gradient Investments, we're one of the first to the market in providing that turnkey, easy access for the everyday American. You've got an SMA platform, and we partner with Case and Schwab to be able to provide a seamless turnkey access for kind of a fund of funds approach. So if you're looking for growth, we've got access to private equity, to venture capital hedge funds, private credit, and infrastructure, basically the entire alts platform that is now open and accessible to people that it wasn't just a year ago.
Understood. I mean, when you're thinking about people who are younger versus those who are looking at their retirement, the risks and rewards, I mean, how do you do this based on your age?
Oh,
yeah, I mean, private assets do.
Good question.
Just like public markets, so irrespective of if you're young or old, on the pro side, it really is providing access to strategies most investors couldn't reach historically. You touched on that at the outset, and with private markets, you earn an illiquidity premium. Essentially, you're being rewarded for being patient. You're paid to wait. And in conjunction with the pro side, which is different really now than ever, is reporting is a lot simpler with new tools, new managers, where you have 1099 streamlined tax reporting that arrives in time for tax season versus those clunky K1, K3s that are confusing to everybody. So whether you're young or old, those are really positive benefits. On the downside, investments aren't for money you need in the short term. So if you're young and life is happening rapidly, it's coming at you, even with those perpetual or tickerized, those new structures that provide easier access, you typically will face a soft 1-year lockup, meaning kind of a small penalty to unwind that private investment. But after 1 year, quarterly redemption opportunities do exist, and they're available. They're not guaranteed, but they're very, very common. And so usually access to alternatives are best for investors with mid to long-term horizon who are looking for portfolio diversification versus public markets alone.
And so last but not least, as I'm looking at, obviously you were talking about KKR, Apollo, Carlyle, Hamilton Lane, Blackstone, just to name a few. What about just things like the crypto world or commodities? Do you look at that closely?
Yeah, I mean, those are definitely.
And do you like that? Do you recommend that?
Yeah, so I mean, those are part and parcel of a diversified portfolio. It's kind of like cayenne pepper on your meal. You want some, but not the whole thing. So I think we can take a page from large endowments that have been around for hundreds of years. You look at Yale or Harvard, which allocate 20% or more of their portfolios to alternatives, which some of it is the crypto world, but some are private real assets. You think about FedEx, warehouses, privately owned Amazon, data warehouses, OpenAI, Anduril. Think about private companies that get access through these vehicles. So really it comes down to adding diversification, boosting returns through illiquidity premiums, and reducing overall portfolio volatility. I mean, if you compare public versus private markets, over the last 30 years, the S&P has annualized 10% returns with about 17% volatility per year. A buyout private equity fund over that same period, on average, is about 15% annualized returns and about a third less volatility. So that patient capital, that diversification, non-correlated assets to public markets does pay dividends over the long term.
Understood.
Understood.
Great to speak with you about this type of investing because people like to see some alternatives and diversification in their portfolios, particularly when you have a lot of global events and different things happening. Portfolio manager at Gradient Investments. Thank you so much. Coming up next, Kenny Bulgari's at the desk, and he's got a lot of ideas for you in your portfolio. Of course, we're going to talk inflation and earnings, but the stocks he's watching, we'll hear all about it, and we'll be right back.
Hmm? Oh. We're back at the 63 here. She's gonna cut her bangs. Oh! She did it.
You could have done better. Same goes for where you invest.
That's tough.
Level up and invest smarter with Schwab.
Real-time market moves, earnings breakdowns, and trade-ready insights. Follow me on X @sam_Vardas and connect with me on LinkedIn or Instagram for more.
Trading at Schwab is powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
Welcome back to the Watch List. I'm Nicole Petalides. Kevin Mulcahy is with me, partner and chief market strategist at Slate Stone. Well, so glad he's here to give us your thoughts on the market action we're seeing right now.
So look, I'm not necessarily surprised. This churning, this backing and filling, we're not seeing the market collapse, but we are seeing it kind of backing and filling, right? Some of it is just the fact that we've kissed new highs again this week. The S&P made another new high this week. And then we started in earnings season. And earnings season so far has started off great. But there is, I think, some caution ahead. And I think part of that is overall caution in the market, kind of anxiety over midterms, especially in the first half of the year. What happens? Typically, historically, if you look back at the midterm election year, the S&P gives back between 15 and 19% at some point during the year. So investors need to understand that and know that going in, and which is why they should be prepared for that, make sure they get a portfolio that kind of reflects that action. So I think that's what's going to happen. Look, the banks have started out well, but there's some cautious there. You saw what J.P. Morgan did yesterday, and I think this is a key.
always sort of cautious,
Yeah,
though,
but
right?
but what J.P. Morgan did, and I always find this very interesting, is they upped their allocation to their loan loss reserve account, which only tells you it's not about losses, current losses, it's about potential losses. And so the fact that they upped it fairly substantially. And so all that says to me is that while he says to you on the one hand the economy is fine, the consumer is great, the fact that they upped the ante in their loan loss reserve account just suggests to me that they're trying to be a little bit cautious. Now, if nothing ever happens and the defaults don't happen, they can take that money and add it back in. But at the moment, I think that's a clear sign. And so it's going to be interesting to see I didn't see what Bank of America did today. They upped their loan loss reserve.
What they did is they beat up on the top and bottom line.
I saw
and
that.
Brian Moynihan actually was very bullish on the 2026 economy. Right. He said U.S. consumers will keep spending. The loan, I wrote plus 8%, 1.2 trillion. Those are the loans that were given out.
Yeah.
That was not the reserves.
That was not loan loss reserve.
That's not the reserves.
Yeah.
Deposits were higher. So, I mean, net interest income was on the rise. I mean, it was generally a pretty good report. And also gave it a good outlook, too. I mean, basically saying good economy.
Right.
So the rest of the bank earnings, we're going to get it Goldman Sachs and Morgan Stanley and more. Do you think the rest of the banks will continue to be good news?
I think. I saw that Citibank disappointed a little bit. I didn't read the whole story yet. But I think overall the banks are expected to be strong. And so, yes, I think we're going to get positive news out of the banks. Jamie Dimon said the same thing. He actually, what was interesting, too, out of J.P. Morgan, was that they see no rate cut this year, and they see a rate hike in 2027. All that suggests is that they're expecting the economy to continue to perform well and then start to overheat, which I think is very interesting, because I'm in the camp that, that rates are fine right where they are. That will stimulate this economy.
No.
So you have a few names, and I think one of this is about the theme of small and mid caps.
Right.
I was saying that folks who invested in small and mid caps have been so frustrated over the last decade when they're seeing 20% returns. And what happened to my mid cap, for a decade, right?
Get him off the air, please.
Now's the time.
Yeah, well, listen.
We're having technical difficulties.
We have seen they're lifting their head. And so they're starting to perform well. And so we've got a name we just added to our portfolio is Neurocrine Bioscience, NBIX. It's off about 5% so far year to date. It is it's a little bit of a volatile name because it is a SMID, right? But
wrong.
All kinds of great work in the neurosciences, so psychological things, anxiety, depression, even brain tumors, and they're making some great progress. So it's a name that we're excited about. It's a name that we just added to our portfolio.
All right, so NBIX, and look, it's run up from $84 up to $160. Does it go back to 160?
Yeah, I think it goes. Where's it? It's right now about
Right now, 134.
Yeah, so I think 160 is probably, you can look for that right on the chart. I'd have to look at the chart, but yes, it has backed off. It's down about 13% off that high. So,
Yeah.
1
month down 12%.
Yeah.
Let's talk about Verizon. I saw 180,000 customers facing some outage today.
Yes.
In the meantime, you do have Verizon as your pick.
Yes.
And Verizon
But it's up
actually
today.
was one of the names that was in the green. I saw Telecom. I saw AT&T and Verizon
Mm-hmm.
had green arrows when there was a sea of red, I should say.
Right.
But this chart, though, is as flat as flat could be.
Well, but if you look at the chart, how far does this chart go?
This is a 1 year.
It's a 1 year chart. Well, Verizon trades in a very narrow range, like 36, 46. That's where it trades. And where's it trading right now? 38?
Right now, 39.70.
Yeah, so it traded down to 36, it kind of bounced off there, and it's trading back up. But look, the story about Verizon, it's a 7% divvy payer, right? It's consistent.
That's why our dads picked it.
That's exactly right. And so if you are worried about some chaos in the markets, and you want exposure, and you want a place that's you want a stock that's going to pay you, Verizon is always my go-to pick. I own it. The firm owns it. I'd buy more on this pullback. We bought more of it, and so that's just a safe thing. There's nothing sexy about it. It's just a safe play in kind of an uncertain world.
And then we talk about aerospace and defense.
Right.
The president's administration wants to add another, 500. We're going to get up to 1.5 trillion
dollars.
So tell me about L3 Harris.
So L3 Harris again is smack in the middle of that. Now there's just new news that came out yesterday, I believe it was. NVIDIA made. The country made the Department of Defense made a $1 billion investment in their missile. It's going to be a new company that they're going to spin off. I forget what it's called, missile something. It's going to spin off sometime later this year. But the Department of Defense just made $1 billion investment into this part of L3 Harris. You can see the stock reacting very nicely. It's actually trading, in a straight line up over the last couple of days ever since that news came out. But look, if you're worried about geopolitical issues, which clearly everywhere you look, there's a geopolitical issue around the globe, right? Whether it's Iran, it's Venezuela, it's Cuba, it's Russia, it's Ukraine. Aerospace and defense is going to be another sector that that I would overweight. And L3 Harris is the name one of the names I picked.
What are your favorites in the Mag 7?
My favorites in the Mag 7 are going to be Amazon, because that underperformed last year. Amazon, NVIDIA still. Google is going to be, I don't know Google. It's funny, I missed that boat in Google from the very beginning. But Google now is suddenly piquing my interest a little bit.
Having regrets?
Yeah, but I think, listen, it's not about getting out of the Mag 7 at all and getting out of tech. You have to have tech in your portfolio because that story is not going away. The AI story is not going away. So it's just about when do you get into it? When do you add to it? If you already own it, you're going to participate. If you don't own it, you got to get in. Then you got to get in slowly. You got to get in just kind of dollar cost average for a little bit until you get a sense of where this market's going and where they're going. Because look, if the market pulls back, tech will be the first one to get hit because it is so outperformed. So you just have to go in kind of with your eyes open.
All right, Kenny Polcari, Slate Stonewell, thank you so much for being here.
Well, thank you for having me. It's always a pleasure.
A nice variety there. Welcome back to New York for a brief moment. Thank you, Kenny. Coming up, our panel ready to talk all about the retail sales data and the state of the consumer. Are you spending or are
Come on, break out. We're getting a little bit higher highs. Seems like. We had one little bitty one, but it still had a higher wick. So I count it. Here we go. Come on.
The final 90 days of the trading day, that's when markets make headlines and traders make decisions.
From earnings shocks to sector rotations, we're tracking the catalysts that move markets right into the close.
Here on the floor, I
We
bring
got
you
12 more
real-time
minutes to
sentiment
power
from
hour.
traders driving the action.
And in Chicago, we break down the data, technicals, and trades you need to see before the bell rings.
Live coverage of the close every single day.
This is
Market on Close, live weekdays 3 p.m. Eastern, only on Schwab Network.
Okie dokie.
Opportunities don't stop when the market day ends. So neither do we. Schwab gives you round-the-clock access to over 1,100 of the most popular stocks and ETFs, plus a wide variety of futures markets. All with 24-hour support from trading specialists who understand the ins and outs of 24-hour trading. No matter the hour. you can trade brilliantly with Schwab.
Hey, investors, you know the market moves, and Schwab is here to help you move with it. So, whether you're buying, selling, holding, or planning, whether you're ETFing or 401k'ing, saving, spending, or even retiring, you can count on Schwab for market insights, live support, powerful trading platforms, and 400 branches. All at your service, all so you can invest your way. Sounds nice, right?
I'm Sam Vardis, live from the New York Stock Exchange. When the market moves, we're on it. Getting the reaction, the strategy, and sentiment in real time. Stream Schwab Network at schwabnetwork.com.
Let's dive into those retail sales numbers that we got in today. A little better than expected. You also heard Brian Moynihan from Bank of America really counting on the consumer to spend in 2026. And we have right now with me Anthony Ferry, CEO of Wavia, and Brian Jacobson, Chief Economist, Annex Wealth Management. Anthony, Brian, I'm so glad you're both here. Anthony, your thoughts on retail sales and where do you think the consumer will spend or won't spend in this first quarter or this year?
The results of the report weren't too surprising for us. I think continued spending and cautionary spending from consumers is going to continue. We do see a lot of uncertainty in the market and trading down continues, at least with our data. And the consumers looking for those bargains and being responsible with their spending. I think that the holiday season was strong. We see even up to the current data for ours is that spending continued and all the uncertainty in the market. They're overcoming it, and the traditional sales trends with car purchasing towards the end of the year. We saw strong consumer electronic spending leading up to Super Bowl, which we always see. The Black Friday sales is a big spike for television sales. So I think that we're going to need the same trends, but continued trade down and those necessity products, those need to haves more so than the want to haves, continuing into the concerns in the start of the year with all the other uncertainty around the market that's influencing consumers.
Talk about the holidays, and there's always this worry that we're not going to see the growth, and they're all different sort of estimates, but then it always comes in at 3, 4, 5% year-over-year growth, and people are shopping online. You mentioned televisions and things like that, maybe other big ticket items. Brian, were you watching tariffs and how people were spending?
Yeah, I think that it did really show up in those numbers, how we saw over the last 12 months that there was a decline in some of those big ticket items as far as with autos, furniture, things like that, that you had an increase in price with the tariffs, but you also see some of that demand destruction because there was a decline in those purchases and those big ticket items. And while the month of November, keep in mind this retail sales report was from way back in November, it was slightly better than expected on the month, but that longer arc is still showing that the consumer, maybe what they did was spend a little bit less going into the holidays so they could look for the bargains and buy some of those essentials during the holiday shopping season. In fact, the Beige Book came out just about an hour ago to give some clarity as to maybe what happened and how to interpret it. High-income individuals were really driving a lot of the spending, especially travel, tourism, things like that, whereas low to moderate income households, they're still feeling the pinch. They are price sensitive and really focusing more on essentials and looking for bargains.
Brian, you mentioned tax refunds in your notes. Tell me more about that.
That is one of the things that I think maybe can help bridge the gap between a delay between when we see the GDP growth increasing and the labor market beginning to recuperate here is tax refund season. We know that because of the One Big Beautiful Bill Act, that this tax refund season, which is basically January through April, a lot of it is going to happen in February, it's going to be a record, probably about $200 billion. And a lot of that will go towards lower and moderate income households. As a result, maybe that can bridge that gap between some of the sluggishness that we see now in the labor market and then a re-acceleration as we get into spring and through summer.
Yeah, and Anthony, in your notes, you were talking about some of the hot-selling items. You mentioned televisions, right? Smart TVs, gaming consoles, also according to Wavia's data that you brought to us. I appreciate that. And how are people using Buy Now, Pay Later?
Yeah, we're seeing an all-time high in Buy Now, Pay Later. So again, goes to an indication of consumer sentiment that they're being cautious. That they don't want to be out that cash all at once, and so opportunities that they have to be a little bit more conservative and stretch the spending dollar, they're taking advantage of. So again, Buy Now, Pay Later is at an all-time high that we've ever seen. The console spike sort of goes hand in hand with the TV purchasing being driven a lot again, I think, by Black Friday and leading up to everybody wanting to purchase for the Super Bowl is always a big one. Console, Nintendo released the new Switch console that drives quite a spike too. In our data, we're pretty heavy in the consumer electronics space, so we have pretty good data in that as well. So yeah, those are typically strong spaces, but we did have a release in that in the console market that drove that a little bit. Without that, who knows where that would have fallen. But again, same consumer concerns with spending, looking for those bargains and taking advantage when they're there.
We think about, are people looking for bargains or how they'll be spending? Are they worried about their jobs or their credit card interest rate levels? A final thought here, Brian.
Yeah, it's really timely that we got that announcement from President Trump that he wanted to cap interest rates on credit cards at 10%. I mean, if Buy Now, Pay Later is at record highs, that's just going to keep climbing as people lose access to credit or those credit lines get cut if we do see that type of interest rate cap put into place. And so, in terms of the access, the ability to spend, to bridge that gap from paycheck to paycheck could be severely crimped if we do see some of these policies.
Yeah, it's interesting how Brian Moynihan said that people are spending, but also that small businesses are feeling optimistic because consumers are spending. I guess they feel confident enough to do these Buy Now, Pay Laters, like you said at Wavia. They're really using that. Anthony Ferry, Brian Jacobson, great to see you both. Really appreciate it. I'm Nicole Petalides. Thanks for being with me every single day here on Schwab Network at 9 a.m. and also at 2 p.m. every day. Thanks for being with me. I'm Nicole Petalides, and coming up next is Market on Close. We'll be right back.
Schwab Bank Investor Checking, the checking account built for investors, named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, features of our checking account, plus cash management solutions, all designed for investors like you. With unlimited
we have 3 minutes to power hour.
Cash withdrawals worldwide, no overdraft fees.
I ain't done much trading today. I've did my limit.
Keep your money safe.
I don't want to ruin it.
Because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting. And
this market ain't the way that I usually like to trade it.
Money market funds and more. Get more with Schwab Bank.
I'll tell you that right now.
The checking account built for investors.
What'd you just say, Jim? I said this market's not usually the kind of market I like to trade, so I got to figure out how to trade it. I know how to do the power hour, but it seems like just nothing holds very well. And today we have, same issue. George. Another commercial. Damn it. George.
Accuracy and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists. Streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com.
Mom, when my grandparents moved here, did they know what our family would become?
I don't even know if they could envision it to leave everything behind, literally come across the entire world. I think that we totally met what their wishes were. Schwab has been with us for almost 25 years through purchasing of houses, opening up our business, having children. They've always been there for us.
I want to invest with a company that can help me give my family a happy financial future.
Stay connected to what moves the markets. Download the Schwab Network app and stream anytime wherever you are.
Comes back to sport again.
Good afternoon. Happy Wednesday to you. It's 3 p.m. on Wall Street, and this is Market on Close. I'm Marley Caden, coming to you live from our Chicago headquarters.
And I'm Sam Bartis, coming to you live from the floor of the New York Stock Exchange. Let's take a look at what is coming up on today's show. We'll discuss how volatility has returned in 2026 and talk about ways to diversify your portfolio to help protect you from that. Later, we'll look at Nvidia and Google and break down their place in the AI race. And we'll dive into the world of alcohol and talk about how dry January impacts beverage stocks and
January.
But for now, Molly, take us through what you're watching
Here's
today.
the pullback I've been
Shares
looking
of
for.
Wells Fargo, Sam, fell by the most in 6 months today after missing analyst profit
January.
estimates as severance costs drove up expenses. Net interest income and net income both came in slightly below expectations as well, sending the stock down more than 5%. Bank of America also moving lower after earnings, despite a fourth quarter beat on both profit and revenue, driven by stronger net interest income and equities trading. Investors appear to be focusing on softer fixed income trading results and have questions about how much momentum can carry into 2026, even as the bank guided for 5 to 7% net interest income growth next year. And Rivian under pressure as well today
We're
after
at
getting
200.
a second downgrade this week. UBS downgraded the electric car maker to sell from neutral, saying the stock has gone too far too fast. The firm is also concerned that expectations for R2 SUV sales might be too high. We'll dive into these stories shortly, but first let's take a look at where the markets stand as we head into the end of our
Boom, just
day.
like that.
We are a mixed picture here. The S&P trading down 9% at 69.01. The Nasdaq down more
This
than
is
1%
interesting.
at 25,315. On the Dow, we're down.
Ladies and gentlemen, Washboardjim sitting here calling out this trade. It's the SPX, and this is what I said. This is what I said. Quote, this is what I've been waiting for. We pulled back and hit the 200 with a, looked to me like some kind of hammer. And look at that. That candle just shot up just like that. Boom. From 25 to 75 in a split second. So this is when you're supposed to say, unbelievable, that's what you are. There's 95 cents. Did you see that? The 200 SMA. Jimmy said Yahoo. Boom. To a double top. Is Nvidia on your list?
Coming in at 0.6% month over month, which was more than the market expected and was broad-based across various categories like cars, gas stations and sporting goods. Now the control group, which strips out the volatile
That's crazy.
components, rose 0.4%. That was in line with expectations, and that's important because this flows into how GDP is calculated. And so, as KG pointed out this morning, this could be a positive and should re-rate GDP estimates a bit higher. Now, this data, remembering, is for November, as the BLS is still playing catch-up after the government shutdown, so the numbers are still lagging, which may be why we haven't seen a huge movement as far as the market reaction is concerned. If you take a look at the Treasury market, for instance, we've seen the 10-year yield really staying range-bound. So for now, the next Fed meeting
Can't
is
beat
likely
that.
to be another wait and see. Marley, I'll send things back over to you with Jenny in Chicago with some of today's top movers.
Thanks so much, Sam. Like you said, Jenny Horn, co-host of Next Gen Investing, joining
Jenny
us
Horn.
in our Chicago headquarters to talk about some of the big moves we've seen today. Of course, we have to talk about bank stocks to start. We got earnings this morning. Let's kick things off with Bank of America. You know, they had a good quarter, but we are seeing a move to the downside of almost about 4%.
Yeah, and I think right now the looming concerns over the credit environment in the United States is really just dominating these post-earnings moves. I mean, we've seen now consistently pretty substantial earnings beats, and Bank of America, no exception, beat on earnings and revenue, powered by what they highlighted was strong net interest income and record trading performance. But, however, now seeing a theme, weak investment banking and this looming regulatory and rate risk dragging on shares today, even as management remained fairly upbeat about the 2026 economic outlook. So we did see that earnings per share, again, topped estimates. Net interest income rose 12% year over year, or excuse me, that was 9.7% year over year.
Oh
Net
my.
income was up 12% year over year. But management now forecasting another 5 to 7% growth in net interest income growth in 2026, continuing again some overall strength. Equity trading revenues was up 23% year over year, hitting an all-time high in their fourth quarter. And overall sales and trading revenues were still up about 10% year over year. That was the 15th straight quarter of growth. Now investment banking lagged, and so we saw investment banking fees flat. Equity underwriting was down 20%. And this is right now perhaps being read as a broader scope on deal making that could spill into this new year. But regulatory risks definitely still remain, I think, the most central concern, at least for the near term. Of course, the proposed 10% credit card cap rate could significantly cut Bank of America as well as the broader financial system's profits if implemented. And so we know CEO Brian Moynihan said consumer and business trends actually frankly remains very strong. They're bullish on the U.S. economy in 2026, but that was not enough to ignite any upside here. We're down 4% today, which these are pretty substantial moves. If you look at the chart, I mean, it's a pretty big red candle for a name that doesn't typically trade at this much volatility.
And yeah, and interesting, you know, a lot of the question was around the impressive year that bank stocks financials had in 25, and could they sustain that? These numbers indicate they are sustaining it. They just seemingly weren't good enough is sort of the message that I've been hearing in conversations today. And again, that's why we're down now about 3.75% for Bank of America. Even bigger dip off for Wells Fargo, though. They had some pretty significant severance costs that drove up their expenses for the quarter.
Yes, and so that's also, I think, interesting, as well as the fact that Wells Fargo, I mean, still, again, seeing their overall income missing some of their forecasts, but net income at the bank was around $5.4 billion in the fourth quarter. That amounted to roughly $1.62 a share. That came in below expectations. Revenue 4% higher, but higher loan balances did help lift their net interest income. But they expect net interest income to now rise in this new year, boosted in part by a growing balance sheet and assuming that the Fed does cut interest rates at least 2 to 3 times. But this was the second quarter that they were free from the asset cap that the Federal Reserve did put into place back in 2018 as a punishment for, of course, that fake account scandal. But the bank did take roughly $612 million in severance charges, and also mentioned that AI, I mean, explicitly stating this, that AI is going to change right now their headcount. And you haven't seen it called out as specifically as you have from actually both Bank of America and Wells Fargo. But I do think that you look at right now the rising expenses for the banks, and frankly, headcount was one of them. And it was actually very similarly mentioned at Delta Airlines, a very different company. But I'll be curious to know if this is a theme we see emerge where it's the call out of specific a weakening labor force as a result of the presence of AI. Now, Wells, of course, in the way to differentiate it from the other big banks is you look at right now at the exposure like Bank of America has. It's diversified across so many businesses. Really just has its hand in everything financial, where Wells is primarily a more U.S. and really commercial-focused bank. And so for that reason, there's also being read through as perhaps a bit more exposure to if we see this overall situation, of course, the cap implemented, it could perhaps sway a bit more on Wells Fargo or some of the analyst commentaries I saw today. But again, we're all hypothesizing on a situation that we could still see evolve in the next 6 or so days.
Yeah, and certainly, with that announcement, even prior to it, looking for any signs of credit stress was a big focus of investors in all of these reports, and they do seem to largely be holding up. Now, what's looming is any determination on that January 20th date for this potential cap and what it would mean for borrowers for these big banks, but Wells Fargo down more than 4.5% right now. We also got an update in the latest with the NVIDIA chip story with the H200 shipments to China. It's not a huge update, but an update nonetheless, and we are seeing NVIDIA shares down pretty significantly today for NVIDIA.
Yeah, and if you look at the heat map today, I think it illustrates exactly why markets are lower. I know that
we're due for a good day.
Blame to the banks. I mean, look no further than big tech, and NVIDIA could be continuing to face
I remember
resistance
last week, I think.
Surfacing
I don't know if anybody caught it.
Chips are still being restricted in China.
Last week I was sitting here saying, we're due for a good $2,000 a day. And then later on that day, bam!
Companies to not buy the chips unless absolutely necessary, but it does come after the Trump administration, of course, did recently formally approve the H200 chips for export to China under certain conditions. And despite that approval, it's going to
Magnificent remembers.
We'll continue to see from China then basically responding by blocking the chips at the border. Now, analysts do believe in Beijing may be trying to gain some leverage. I think that's all this really frankly is. But if NVIDIA were to allowed back fully into the Chinese market, it would represent a pretty major financial win, not just for the company, but also for the U.S. government, who does collect now a 25% fee on those chip sales. So it's not, of course, expected, but I think that anytime you see snags in that
pretty world today.
Weakest tech, which is now
how's Jenny Horning?
Also does
how's Jenny Horning?
There's a lot of bullish enthusiasm tied to an expectation this situation would get resolved. Doesn't seem like, especially from the reports we got today, that China, of course, was going after cybersecurity, that we're seeing a resolution as soon as perhaps the street would have wanted.
We are seeing a lot of levers being pulled in this ongoing story here. Another one that stuck out to me is that
girls in blue.
China cannot receive more than 50% of the total amount of chips sold to American customers. So even a
I accept both profiles today.
In fact, as those numbers would change regularly. But NVIDIA under some pressure today, down about almost 2%, about 1.9%. Lastly, let's talk about Intuitive Surgical. They did a preliminary release of their fourth quarter results. It's not their earnings report. Their earnings report is coming, but it's not being well received.
It's not, and so this name, I will say that to its credit, we had such expectations for its Da Vinci system that you look at its earnings, its most previous earnings report, we saw a huge spike tied to everything related to Da Vinci, and now today giving back a lot of that strength on really the fact that their preliminary fourth quarter results and full year 2025 results.
Da Vinci.
They noted expanding
the heck is she talking about?
System placements and revenue gains still. But procedural expansion was definitely still notable. We saw worldwide procedures using Da Vinci and
Da Vinci procedures
18% versus last year. Da Vinci specifically, those procedures rose 17%, while Ion procedures jumped about 44%. And in 2025 overall, combined procedures did increase approximately 19% versus the year prior. But for the full year, they do right now expect roughly around $10 billion in revenue. That was an increase of roughly 21% again from 2024. Driven by these increased system placements, but preliminary instruments and accessories also were higher. But again, all of the
so the Da Vinci procedures is a type of minimally invasive robot-assisted surgery where a surgeon uses a console to control robotic arms with tiny whistle brushes. How dare you?
At least
there you go.
All-time highs in the last several months. This name has not seen highs since
AI is going to get rid of the doctors.
This was not the catalyst they needed. But I think Da Vinci is just like reading this press release. It's the most amazing form of utilizing AI. These basically minimally invasive procedures that have no error rate at this point. That is still, I think, fully intact. It just a lot of expectations were riding on these numbers, and now perhaps we're pricing that in for their actual fourth quarter report.
It will be interesting to see on January 22nd when they report
No
how
matter
much
what
of
your
a
lifestyle
reaction
is,
we see, as they've already gotten quite a pretty substantial preview.
do not let
to some
health
of those
issues
numbers.
get in the way of your living. The Da Vinci Xi. Robot-assisted surgery with fast recovery and enhanced precision, even in hard-to-reach areas.
Like my boots?
The Da Vinci Xi is an advanced robotic surgical system used for minimally invasive surgery. 4 surgical arms consisting of tiny instruments with wrists at the tip allow surgeons to accurately perform procedures in complex areas with precise movements and better dexterity. A special high-definition camera attached provides magnified 3D views of the operating area, leading to a high degree of surgical accuracy and patient safety. The robot is comprised of 3 main components. The first part is Surgeon Console. As the workstation, the surgeon controls all instruments with full dexterity using master controls and pedals through viewer display. The second part is called Patient Side Cart. The first robotic arm holds the endoscope, whereas another 3 robotic arms are attached with surgical instruments. And the third component is Visual Cart, which is the image processing unit composed of advanced vision and energy technologies used during operation. Robotic-assisted surgery using the Da Vinci Xi can be applied to a wide variety of conditions, including thoracic diseases, urological diseases, abdominal diseases, gynecological diseases, head and neck diseases. The 4th generation of the Da Vinci system yields benefits, including better access due to free movements of nearly 360 degrees on 7 axes, more precise surgery with greater range of motion, enhanced safety due to a sophisticated camera that provides better visualization of vessels, nerves, and muscles nearby, resulting in reduced blood loss and less complications. Built-in tremor filtration to eliminate the surgeon's involuntary movements. Faster recovery with less pain and a quick return to daily life. With years of expertise and experience supported by cutting-edge robotic technology, the surgeon teams at Bangkok Hospital can transcend the restrictions of conventional surgery with the assistance of intelligent surgical solution.
Let's get her done. I've been wanting this operation for a long time. I'm tired of living in this man's body. Okay, we're at support on Tesla. We're at support. The spies at the VWAP. /ES is at the 63 EMA. Move up the calls to the 69.15s. Pay close attention to what I'm getting ready to do. Trick shot, 69.20s. What time is it? Oh. Last hour of the day. 69.20 is looking good. Oh. Now we're at the 9. We'll get some water.
Did you expect to see the market sort of vacillating between the policy announcements that we've been getting over the last couple of weeks? I mean, particularly when you look at Truth Social, some of obviously the president's announcements, particularly when you look at what's been happening as far as foreign policy, the geopolitics is concerned, what's happening over in Iran right now. Is some of this on your bingo card?
I think this is actually right in line with what we were talking about with investors to expect in 2026. Anytime you enter into a midterm election year, what you start to see is politicians start issuing out their trial balloons of what are going to be the stories that were going to help their party secure the election for the midterms. I think that's part of what we're seeing here is we're going to see a lot of policy balloons, some of them geopolitical, some of them things like the credit card fees. Where they're doing a bit of A/B testing in terms of what works and what gets their bases moving. What we see historically is these midterm years, they tend to have the biggest drawdowns. They also tend to have the biggest recoveries, and it's because a lot of these policies they get thrown out there as ideas. They don't actually make it through Congress. They don't actually become law, and the market tends to recover pretty quickly from them.
So, Jason, if several of these policy proposals don't actually materialize, how should investors think about these headlines and react to them without getting whipsawed?
I think the avoiding the whipsaw is just not getting yourself whipsawed, and that means looking through a lot of the noise that's coming out of Washington, looking through a lot of the noise that's coming out of the other parts of the leadership, and really focus on where is the cash flow today or in the future, and being very careful to keep very long-term focused and not allowing yourself to get emotional or overly driven by the policy announcements.
So, Jason, if it's a case, and I've heard other people talking about this today as well with respect to this flurry of headlines, throwing spaghetti at the wall and waiting to see what sticks type of mentality, what do you make of the broadening out that we've seen in this market? This degree of rotation where it's not necessarily red across the board. In fact, there are pockets of this market which are holding up quite well. I mean, you look at Bitcoin today, you look at oil and energy off the back of some of the Venezuela and Iran headlines as well. I mean, you've got utilities up as well. Materials and industrials are performing quite well. I mean, can we get to 750, 8K as some have been throwing out there with this kind of momentum, or do we really need the Mag 7 to start pulling their weight again?
I think it's pretty hard to get to those higher numbers without the Mag 7 doing some of the lift. But the other thing that we've been talking about for the last year or so has been this idea that AI leaves the Mag 7 and it really becomes a driver in other businesses. I was listening to the previous segment talking about bank earnings and the potential impacts on employment. I think that's something that we're very much looking for as investors is where does AI leave from being that proof of concept, that pilot program, and actually start to drive earnings. And I think what we're expecting to see, and I think what investors are expecting to see is that should start to roll over in 2026. And so you can see a bit more of that broadening out. Remember back to almost this time last year, the announcement of DeepSeek came out. All of a sudden, it looked like AI was going to be cheaper. Maybe you didn't need the best chip. Maybe you didn't need the best AI. What did you see outperform? You saw international outperform. You saw industrials outperform. You saw healthcare. It was these businesses that are really hoping to leverage AI for their core business rather than the manufacturers themselves.
So Jason, as we see this sort of AI, move from hype to actual execution here, and that will establish who the winners and the losers are, knowing we need the Mag 7 to move higher, but also seeing that we are experiencing a bit of rotation and a broadening out, where are you finding the most effective diversification right now?
Yeah, so as we think about kind of where the headline risks are, there's certainly going to be risk on policy. There's going to be risk around Fed. We're looking for cash flow, kind of everywhere we can find it. So within diversifying alternatives, we're looking in areas like private credit, but also more idiosyncratic cash flow generators. We're looking at even some trading strategies where we can get some cash flow off of alpha and really change the risk profile. They're not lesser risks. It's not necessarily any safer than fixed income, but it is a different risk, and we think incorporating that into the portfolio makes a lot of sense. When we think about currency risk, what we're looking for is that international equity exposure, or even within the large cap segment of the U.S., those businesses that have significant non-U.S. revenues, they translate that back. And so thinking about how do we get that diversification through cash flow predominantly.
Yeah, dollar yen at nearly at 160. That's been good for an export sort of driven or exposed market like Japan. And, part of that broadening out, as we've been discussing, has really been shifting to EM parts of Europe and also Asia, as you mentioned, with some of the DeepSeek 2.0 type of stories we've been seeing coming out of there, particularly with some of their alternatives to the US domestic players. What about the economy, Jason? How are you seeing things holding up right now? Because, it did look as far as the retail sales that they're holding up, the consumer continues to spend. And if I could sort of add to that question, does the market need 3 rate cuts in the system this year if, things aren't falling off a cliff?
Yeah, this is a great question. The economy, from our standpoint, looks fine. It's not gangbusters. Atlanta GDP is throwing out this 5% number. 2% of that looks like it's exports. As we've seen over the last year and a half, that can be a pretty volatile number. Overall, we think the economy feels pretty fine. Unemployment, kind of right in line. Inflation, kind of, in the right direction, even if a little sticky high. We don't see the economy as being a significant driver of the markets this year, because we think it probably just kind of hums along. On the question on rate cuts, I think we're probably in the camp that we do expect a bit more pausing, and we've suggested that for the last several months, that the Fed was probably really going to take their time. There isn't apparently a 5-alarm fire that they really need to cut rates to get to a very accommodative stance, and I think you're seeing that out of some of the Fed speak.
Jason, thank you for being on our show today. It's been a pleasure talking to you, and thanks for that broad look there as well. Jason Blackwell from Focus Wealth Partners. And coming up next, we'll turn our attention to tech with Caleb Silver and dive into the recent headlines around Google and NVIDIA. Market on Close will be right back.
opportunities don't stop when the market day ends. So neither do we. Schwab gives you round-the-clock access to over 1,100 of the most popular stocks and ETFs, plus a wide variety of futures markets. All with 24-hour support from trading specialists who understand the ins and outs of 24-hour trading. No matter the hour, you can trade brilliantly with Schwab.
I'm Diane King Hall on the floor of the New York Stock Exchange. When markets react, we are live with analysis that matters. Watch now, only on SchwabNetwork.com.
Sometimes 450 back down to top. Profit.
Goes for where you invest. Level up and invest smarter with Schwab.
We're at $475.
Welcome back to Market on Close. I'm Marley Caden alongside Sam Bottas in New York. Shares of Rivian are falling today after UBS downgraded their stock to sell from neutral, but did raise its price target to $15 from $13. UBS believes most of Rivian's AI-related news is out and also thinks that expectations may be too high for the R2 SUV launch. As we take a look at where Rivian stands today, it is trading down about 7.5%, and it's at $17.43. Even that new price target from UBS is lower than where it's currently trading. Tesla also under pressure today, down 2.5% at $435. BYD lower, and Li Auto as well. So a move to the downside for the EV stocks today. Rivian, the biggest move of all. I do want to send it over to Sam in New York, who is standing by with our next guest.
Thanks so much for that, Marley. Well, I'm very pleased to say we are joined by Caleb Silver now, the Chief Business Editor, People Inc. and Editor-in-Chief in Investopedia. Thank you so much. Your title is becoming longer.
Yeah,
it's becoming a mouthful.
Keep it short.
Your business card must be very big. We're talking about sort of the chip wars playing out. I mean, obviously, NVIDIA v. Google. It seems like the market narrative is one of a sort of a changing of the guard, a shift in some of the leadership. But is it as simple as that? I mean, do we give credence to that? Or is it just the fact that there is a big enough pie to share around now?
Well, it's big enough and the market has expanded a lot. When you think about these two companies, think about these two different things. GPUs, that's NVIDIA's territory, right, the graphic processing units, and then think about what they call TPUs. Those are the tensor processing units, also called the application-specific integrated units if you want to go way deep into the chips. And they're really producing two different things. NVIDIA is producing for the enterprise, for cloud computing, for these big AI data centers, while Google is focused really on these applications, and Gemini is front and center in that. You can't really use a lot of those TPUs outside of the Google universe right now, but that is the universe that's growing. Those are cheaper, those are much more efficient than the big GPUs that NVIDIA makes.
Right. Google's TPUs are largely tied to its own cloud ecosystem. Does that limit their long-term growth potential in the space compared to NVIDIA's broader GPU applications?
Yeah, for now, but
Boom.
that could remain the case forever. They wouldn't have gotten into this business if they were only producing for themselves. So imagine being able to take some of these TPUs or the application-specific units to other types of software and programs. A lot of it is designed to empower and improve Gemini. So think about the other ChatGPT or OpenAI applications or LLM applications that it could be useful for. It's very software-oriented. Yeah, I have a feeling that it's going to be able to be more to help other products going forward to give it more market share.
Yeah, and obviously Google's been getting a lot of praise for Gemini. Was it Mark Benioff had some pretty interesting words that we won't repeat here, but I mean, you know, it's been why we've seen so much bullishness around this name, and obviously now we've got the Apple partnership. Just talk us through how you're thinking about this one as well. And I mean, particularly when you think
If every day was like today.
You know, obviously it's a very good short-term move, but is it the long-term solution?
I would never
You want to be partnered with the
ever frown.
that has the largest market share, and that's Apple. Also Samsung worldwide, but here that's Apple, and if they're going to continue to develop Siri and make it more generative.
If every day was like day. Excuse me. If every day was like today, I would never frown.
Attention. We saw Alphabet become a $4 trillion market cap company. Is there growth in AI really more targeted at defending their core search business and their all-important advertising business rather than actually making them a direct competitor to NVIDIA's leadership?
Yeah, great question. But if you've listened closely
it's a good question.
earnings calls with Google and listened to the commentary from its leadership, search is not its business anymore.
That's why we hired her.
When it comes to that, it is in the business of
25 more
generating
minutes.
AI and empowering that ecosystem so that it becomes the dominant way we experience Alphabet and Google-related products. So the search business is dying. We're playing for Google Zero across the publishing industry, and I think that's what Google's playing for as well. You can just tell by its staffing count in the search area. It's moved a lot of that staff to focus on AI and Gemini.
I want to take it to sort of 30,000 feet. I mean, we were having a fascinating conversation, and really the narrative in this market has been one of broadening out. I mean, some of the questions at the back end of 2025 around, the valuation, the circularity of this financing, and that sort of seen a shift into maybe the picks and shovels, maybe who might be the winners and losers here, who's building the infrastructure, who's making the material to go into the data centers, the cooling, etc., the energy needed to power all of it. I mean, for some of these names that you and I have just been discussing as well as Marley, I mean, NVIDIA, Google, Apple, I mean, does it start to get a little bit more demanding? I mean, we just had a guest on who was sort of saying we need these guys to pull the weight to get us to that 7,750 by the end of the year in the S&P 500. But I mean, given what we've seen as far as this sort of underperformance, compared to some other names since October, Halloween, as I said, does it get a little bit more challenging from here, do you suspect?
Yeah, and the big stocks have to do the big pulling. That's what they're there for. They're the giants in the industry. That said, think about what's happened since October. The fact that a lot of these stocks fell off 10, 15, 20% in some cases. Look at an Oracle and other stocks like that. That was a pretty big correction for a lot of these stocks. Guess what? The stock market went on to make more record highs because it was a broadening out. There was a sector rotation. We saw financials finally starting to rally. We saw for the first time last week Dow theory confirmed, right? Dow Industrials and Dow Transports rallying at the same time. We should have a little party down here with hats, get Peter Tuchman involved, because that's what you want to see as a long-term investor. Broadening out, you want to see bench points, you want to see double-digit scoring from all your players, and the fact that the market was making record highs without these stocks, that's very good news for investors.
Yeah, absolutely. Hey, Caleb, it's always a pleasure to have you on the set. Thank you so much for popping by.
Thank you.
All right, Caleb Silver there, who wears many, many hats. So one of those is Investopedia. Marley, I'll send things back over to you in Chicago for now.
Thanks so much, Sam. Important for us to note today, Google Alphabet, the only member of the Mag 7 who is in the green right now. Coming up next, we've got Options Corner for you. Alex Coffey will join us here in our Chicago studio to take a look at options activity on Netflix after reports that it's working on a revised offer for Warner Brothers Discovery. That's next on Market Up Close.
Kick off the morning with the data and the decisions moving markets. Morning Trade Live breaks down the macro moves driving the price action, from Fed policy to global growth to inflation prints and geopolitical risk. Smart, fast and always live from Wall Street to your screen. Morning Trade Live, where the markets meet the macro, weekdays at 10 a.m. Eastern on Schwab Network.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Do you like using charts when analyzing your stocks? Our technical analysis webcast series breaks down different charting techniques like trend analysis, price patterns, moving averages, oscillators, and much more. Best of all, you can ask questions directly to an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
I'm Kevin Green, and I track options flow daily, identifying who's buying, who's selling, and how it's going to impact the markets. Watch live on Schwab Network at schwabnetwork.com.
Trading at Schwab is powered by Ameritrade, giving traders even more ways to sharpen their skills with tailored education. Get an expanding library filled with new online videos, webcasts, articles, courses, and more. All crafted just for traders. And with guided learning paths, stacked with content curated to fit your unique goals. You can spend less time searching and more time learning. Trade brilliantly with Schwab.
Welcome back to market on close. According to Bloomberg, Netflix is working on a revised term sheet for its Warner Brothers Discovery offer, has discussed making that offer all cash for its studios and streaming business. The updated terms are designed to expedite that sale process, with expectations that it will take months to close, and the ongoing opposition from Paramount, Skydance, and politicians trying to get ahead of that, some of that, with that all-cash offer. But we will be talking about Netflix today. It's time for Options Corner. Alex Coffey joining us here, host of Next Gen Investing, to take a closer look. I love this story, the ongoing saga that never seems to end. We had Paramount Skydance filing a lawsuit in Delaware to get the terms of their deal disclosed. Now Netflix may have a new deal that whether or not they'll disclose, I don't know. I don't know if the lawsuit applies to that. But we are seeing Netflix move to the downside, about 2% today.
Yeah, so this is potentially accelerating the timetable a little bit. I thought it was interesting to see, Netflix has recovered a little bit off of its lows, but not significantly, maybe 0.5% or so. But despite that, you look at the overall market has basically cut its losses in half. So it does tell me that there might be a little bit of a reaction to this story with this shift potentially towards all cash, one accelerating the timetable. But usually with that kind of change, there's a reason they had it structured the way they did before. This would likely add, something like $10 to $12 billion in debt I've seen to the balance sheet. So it does change the economics of this just a little bit. But because of this, it also kind of turns it into a bidding war again. So this may not be the end of this story.
Oh, it's never the end of this story, I think, is sort of what we've learned since we started covering this story. But you bring up a good point. It does change as the financials change, as they try to get ahead of some of these Paramount Skydance moves. It could see some negative impacts for Netflix investors, at least in the short term. But as we take a look at the chart, and we've talked pretty extensively about how Netflix has had some substantial moves. We were talking off camera about one of your biggest losses of all time was in Netflix. We're not seeing allegedly. We're not seeing huge moves to the downside because of this news. But in terms of the technical setup that we're looking at with Netflix in 2026, what's it looking like here?
Yeah, Netflix, and particularly around earnings 2022, and really at times before that too, had been extremely volatile around earnings. So we have that coming up next week. And this box on the right-hand part of the screen represents that potential volatility in a 1 standard deviation range. So high to low, you're basically targeting, based off of that current implied volatility, somewhere between $80 and $96 in just a 1 standard deviation range of outcomes. Of course, there was a move in 2022 where I think the stock was down like 40% in a single day. I mean, that was well outside of 1 standard deviation. So this is by no stretch a limit. This is saying perhaps a likely outcome would be that it falls within this. That said, we've looked at this chart throughout the week on different names, from Boeing to Apple, and this is the most negative of that set of 3. You look at where currently Netflix sits. It's below both the 1-month moving average and its 1-week moving average. The teal line represents 1 week, is the lower of the 2 moving averages. That purple line is the 1-month moving average. So all of this stacks up where it's like, okay, stock price lowest, short-term moving average second lowest, and then above that is the 1 month, a little bit longer, which is the 1 month time frame we're looking at. This says downtrend, and you look at today's move, it's a down move. You go into this event where there's a lot of uncertainty, not only over the performance of the company, but also around this deal that's just taking up so much attention at the moment. Investors are a little bit uneasy going into that, and it's reflected by, I think, the trade over the last 20 plus days.
And as we look at the options activity in Netflix, it is a highly traded name in terms of options action, whether or not it has headlines. But when we have these ongoing headlines, especially this one and this move to the downside, what are we seeing in terms of open interest and the weighting of puts to calls?
Yeah, over 500,000 options traded today. It's definitely in favor of calls. You have about 400,000 calls traded, only 150,000 puts trading. So over 2 times the amount, actually over 2.5 times that amount. To 1, but the sizzle was pretty in line. It's exactly 1 right now, so that tells me that the activity today is not abnormal relative to the last weeks of activity. And if anything, we'd expect this to start to climb into next week as we get closer to that earnings event. Now, I did some assessment of some of the other dynamics, strikes that stuck out to me, Marley, and I went ahead and just skipped this week. The majority of the volume right now is still in this week's expiration. But Netflix takes center stage next week around earnings, and still about 15% of the volume of today's trades took place in next week's expiration. The highest combined volume, not a surprise, big round number, near the current share price at 90. Highest single contract was the 93 call, however, and that led to the highest call volume, highest put volume actually at 90, which is slightly in the money, which I thought was interesting. From an open interest standpoint, the 85 put just slightly out of the money, highest open interest. The highest call open interest is 100, and that was also the highest combined open interest as well. Max pain down at 90, or up at 90. So that's the area where the most options would be set to expire worthless next week. A small up move, which makes sense, right? Because a lot of call buyers are maybe looking in this 90 range, the 93 range. Put buyers may be hedging in the 85 or so range. If it goes to 90, all of those don't work.
Yeah, we're only $1.50 off of that today. Just the move that we're seeing today, if it made up those losses, we'd be over that $90 threshold.
Exactly.
Alex, thanks for breaking that down for us. Of course, their earnings are coming on Tuesday from Netflix. We'll have all of that coverage for you here on Schwab Network. But thanks to Alex Coffey for joining us for Options Corner today. I do want to send it back to Sam in New York, though, and find out who we'll be talking about for overlooked stocks.
Well, Marley, George Sillis has his eye on Adient today, heading into the close, and he'll break down the news about that and what you need to know about the stock coming up next on Market on Price.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you an active trader? Our active trading webcasts are designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
I'm Jenny Horn. We go beyond the headlines, tracking the trends, sector moves, and fundamentals shaping the markets in real time. This is Schwab Network. Subscribe at schwabnetwork.com.
How's it going?
First day, so...
Sometimes,
Next. Try it again.
You could have done better.
Please.
Same goes for where you invest. Level up and invest smarter with Schwab.
What's up, Carl Nation? It's your #1 broker with the best full-service wealth management skills in the biz.
Actually, I'm seeing something from Schwab.
Uh-oh.
Yeah, Schwab lets you invest and trade on your own.
And if you want, they can even manage it for you.
Not to mention, Schwab has a team of specialists for taxes, insurance, and estate planning, all with low fees.
We're experiencing technical difficulties.
Carl.
Schwab, a modern approach to wealth management.
Stay connected to the markets with Schwab Network.
Tune in 24 hours a day, 7 days a week on schwabnetwork.com.
And on all your favorite streaming services. Schwab Network. Available anytime, anywhere, on any device for free.
Welcome back to Market on Close. I'm Sam Bartis, live from the floor of the New York Stock Exchange. It's time now for overlooked stocks. We're looking at Adient rallying today after UBS upgraded shares to buy. So I'm joined by George Sillis, Senior Markets Correspondent. So George, it's not the most sexy or exciting company, but that's why I really love this segment, because we learn so much about stocks and companies that are in the business of things that basically we use every day, just don't talk about enough. So talk to us about Adient.
Yeah, in fact, one of the things about this business is it's one of the actually leading suppliers globally for manufacturing seating systems for automobiles, like mechanisms and frames, cushions, restraints, but also airbag technologies that are built into automotive seat technologies. So it's not, as you mentioned, the sexiest concept or product out there, but nonetheless, it's something we utilize if you own a passenger car, even a commercial vehicle that's out there. If you look at the breakdown of sales, majority of their sales include big OEM names like Ford Motor, Volkswagen, Stellantis. Those three companies alone comprise of around 35% of sales. Overall, in the last year, the stock has performed quite well, I would say, compared to some of the other automotive manufacturers that they compete in the same space with. That includes Lear, Magna International, Thermgen is another one as well. This stock, Adient, is up about 40% over the last year. It's coming off some low levels. If you look at the 5-year chart, it's down about 36%. But it looks like overall improvements, both from an operational standpoint, but at the same time, their sales OEM markets are starting to improve geographically, including China. A couple of things to note is prior to the outlook increase from UBS, they increased their price target to $30 from $22, from neutral to buy rating. They actually see a quite compelling risk-return profile for Adient in terms of valuation. If you look at both the debt and the equity combined, equity for the business overall is around $1.7 billion. As well as the debt, which is around $2.7 billion. So its debt to equities are 1.7 times its equity. They actually see that the forward earnings multiple for the stock is quite cheap, around 10 times this year's earnings and 7 times next year's earnings relative to those enterprise value metrics. So that's what they're saying in terms of the valuation. It looks compelling. The other thing is if you look at the earnings estimates, which again is part of this valuation update from UBS, they're expecting as a business $2 per share for 2026 fiscal year, but next year that's bumped up to $3.05. So that's essentially a near 50% increase in earnings, but they're expecting to do that on a very low single-digit revenue base. So that supports this whole concept that I think UBS is looking at, is improving EBITDA margins relative to sales, better operational execution. The other thing is, if you look at their last conference call going back to November, the company actually has about 37 manufacturing facilities in China. But interesting enough, they talked about generating around $1.4 billion in sales to OEMs in that country. So I think that is a primary catalyst as well, not to mention that there's potentially some onshoring benefits that Adient may secure if, again, the favorable aspects of U.S. manufacturing improve their prospects to scale up their production domestically closer to one of their biggest, if not their biggest, OEM customer, which is Ford Motor.
Yeah, I mean, that's sort of the thing that sort of stood out to me as far as the note was a beneficiary of this sort of whole onshoring type of story, as you mentioned. I'm just seeing also here, I mean, it operates around 200 facilities, operations in about 30 countries, as you say. Is there anything to suggest that these have been sort of subject to tariffs, or, you know, as part of that whole onshoring, the sort of move that we've seen? I mean, if they're sort of investing more here in the US, if they're having to compete with anybody else in this space in order to, look for some of that market share here domestically?
Well, I think if you look at what the company's declared going back to their 10K last quarter, they've spoken really about operational efficiencies, reshoring many of the production facilities, so they may be getting favorable tax treatment. You have to think about, part of the Trump and congressional big beautiful bill that is improving, capital depreciation of investments here in the United States. So as they've been moving some of their facilities back to the United States, generating better tax benefits, but also bypassing some of the tariff constraints.
7 more minutes.
Some of the other major auto part suppliers that they compete with. Lear is another one that also, if you look at Magna International, these are 3 companies now that have been improving their rates of return over the last year. In fact, all the automakers, General Motors, Ford, Toyota, for instance, they've actually done quite well in the last year from a stock performance standpoint. So I do suggest that there is some favorable policy backdrop that's improving the margin profile for U.S. manufacturers, either parts, the other verticals, but nonetheless the end suppliers of autos, Ford and GM and Stellantis, which again is another customer of Adient's seating systems. But I think that is also part and parcel of why they're showing some earnings growth estimates that are quite robust relative to sales, which are quite modest. The other thing is, just going back to what UBS is looking at, if you just look at the sales last year, it was around $14.7 billion. Stock is only trading at an equity valuation of 1.7. Price to sales is very cheap on this name. The debt levels are a little bit high, but they do have about $980 million in cash. Which they're actually utilizing to buy back shares. So that, to me, says that they're very confident in their abilities to generate profits going forward because they are buying back shares irrespective of the fact that they have about 2.7 billion in debt.
Okay, shares in Adient trading almost 10% higher right
Well.
now. Change, and we are up 40% or so over the last 12 months. Thanks so much for giving us across that one. Really interesting business. I'll send things back over to Marley for now in Chicago.
Thanks so much, Sam. We are nearing the end of our market session. We'll be bringing in Kevin Green to break down the levels he's watching on the S&P 500, as well as today's action. That's next on Market on Close.
Real-time access, data-driven analysis, from U.S. equities to global macro matters. Schwab Network connects the dots. Watch live. Subscribe free at schwabnetwork.com.
Opportunities don't stop when the market day ends. So neither do we. Schwab gives you round-the-clock access to over 1,100 of the most popular stocks and ETFs, plus a wide variety of futures markets. All with 24-hour support from trading specialists who understand the ins and outs of 24-hour trading. No matter the hour, you can trade brilliantly with Schwab.
I'm Alex Coffey.
And I'm Jenny Horn. This is Next Gen Investing, where we track the trends shaping tomorrow's market.
From tech to energy, crypto to consumer, we focus on what's driving investor sentiment right now.
Clear analysis and forward-looking market coverage every trading day.
This is a make or break level for this stock.
That could certainly be a short to near-term catalyst.
Next Gen Investing, 1 p.m. Eastern.
Only on Schwab Network.
Boom, boom, boom.
Sometimes, you know, you could have done better. Same goes for where you invest.
That's what they always say.
Level up and invest smarter with Schwab.
Morning Movers brings traders the biggest headlines to start the day, from volatile overnight swings to the earliest analyst calls. Get your watch list ready. 8 a.m. Eastern, Morning Movers, only on Schwab Network.
The recoveries have been pretty good.
What moves markets? Download the Schwab Network app.
Here at the end of the day, I think I could have got at least 6 or 7 scalps. Made up for the whole day, probably the whole week.
Sam Bartis on the floor of the New York Stock Exchange alongside Marley Cade in
Marley.
Chicago headquarters. We've just got a few minutes left now in today's session, so let's welcome in Kevin Green, Senior Markets Correspondent, to help to close out the day. KG, obviously we've been looking at a degree of rotation in these markets, broadening out, a bit of a mixed picture on the headline, but I just want to get your thoughts on oil right now. We've seen the prices plummeting just in the last few minutes or so. It doesn't look like it's taking the oil majors or the related stocks down with it, but just talk us through what the headline is here as far as the catalyst. It looks like Trump might be holding off on Iran for now.
Well, I think that's the implied message for the market at this point in time, which is why we did see a $2 drop in the price of oil. President Trump did say
Be a pretty big move to go in there and start pushing Iran around.
Iran is going to stop the killings and these executions for whatever matter that he's kind of referring to here. And so we are seeing oil move to the downside, that geopolitical risk kind of getting taken off the table, at least for now. I think you have to have this in a broader context. You are still seeing a lot of embassies in Iran, as well as in neighboring countries, starting to be evacuated by not only the United States, but also European countries as well. So for now, it looks like we are seeing a little bit of a pullback, but I think that we probably have a couple of days to see if this actually does resolve itself, or if this is just one of those blips on the radars. And we have seen in the past, when it comes to geopolitical events and President Trump, some misdirection. And so I think the market, once again, seeing a little bit of a pullback for crude, but I don't think it's completely discounting the fact that we might see some action on a military basis in the future here between the two countries.
And KG, as I'm looking at the S&P, we're not seeing too much movement in any of the indices on this particular news. But as I was just looking specifically at the S&P, we're pretty close to where we started the day after some, intraday moves here. What levels have you been keeping your eye on during the action today?
Yeah, we've seen a lot of volatility, and Sam kind of talked about this. The broadening out trade or this rotation trade continues to stay into effect. And over the last couple of trading sessions, it has been a little bit more defensive with energy because of the geopolitical risk, consumer staples, real estate, healthcare actually catching a bid here. So kind of going into the close, we were able to hold that 6,900 level, at least for now, going into the close. And what you really want to be able to try to focus on is the 6,930. I think that's going to be a key area of resistance. Now, unfortunately, when you're looking at that 15-minute chart, you are seeing a breakdown in the trend where we are now making lower lower highs and actually breaking that sequence of those higher lows as well. So we did test the key area of support, that 20-day moving average, the 6,900 level. We are trying
that went by fast.
A little bit more over the last couple of minutes and see if we can try to recapture some of these losses. But I think this rotation
Okie dokie. Well,
anything that's holding us up. And the Max 7 stocks are,
I think I could have made more today than if I'd been at it a little bit harder. I think I could have done a little bit better today. I truly do it. I think it was a good-looking market, no matter how bad they were talking about it. But once you got stuck in a trade, you had to play it right or you'd get stuck. So I'm going to get out of here, and I'll catch you all later.